Okay, welcome everyone. Let's get started. And since this is Chair White's first appearance before the board, and likewise Jim Schnur's, where is Jim? Jim Schnur's. Since his appointment as the Commission's new Chief Accountant, I think it's only appropriate that Chairman Doty, that you open the meeting by welcoming them on behalf of the whole board and with any other remarks you may wish to make, and then we'll proceed with the day's schedule.
Well, thank you, Steve. Of course, everybody in this room knows that the support and the counsel of the SEC is absolutely critical to anything that we can do or hope to do at the PCAOB. And with that in mind, it has seemed to me, watching the Commission over time, that the job of the chair of the SEC has expanded so that now it is expected that the chair of the SEC will be thinking about everything that has to do with the capital markets all the time. There are very few points of rest or points of repose in the Commission's agenda now. And while Mary Jo White is, of course, up to that task, it reminds me that we're very lucky to have a piece of her time. This is a part, and it's an important part, of what Chair White and Jim Schnur and the Commission are about, but it's only a part. And so for her to take time and for Jim Schnur to take the time to come and sit with us and hear to see how the Investment Advisory Group works and to hear what you have to say is an special privilege. It has also meant a great deal to me, I would have to say, want to say that she's available. I have been able to get her on the phone, talk to her, and get her counsel and her views when I needed it, and that is a very important thing for the chair of the PCAOB. She and Jim have both made a special effort to reach out to board members and to involve themselves in what the mission and the plans of the PCAOB are. So, Chair White, we're grateful to you, Jim Schnur, with 2 weeks on the job for being here. And with that, I'll turn it back to Steve.
Chair White, would you like to make any brief remarks?
Just very, very briefly. First, thank you for inviting me. I was trying to figure out with Chairman Doty in the hallway why I wasn't here last year. I think I must have been in some foreign land doing some of those things that maybe do require that bandwidth of the SEC chair. But delighted to be here. I see what's on your agenda today. I'm sorry I can't be here for the whole meeting. We'll catch up through Jim Schnur and Brian on all the topics. Really mightily interested in all of them. The PCAOB, this advisory committee to the PCAOB really could not be more important to investors and to the SEC. Auditors are clearly, and I talk about it all the time as they remind me, are just critical, gatekeepers in our system. You may have seen some reflection of that really almost from the time I arrived, obviously working on kind of the back end, but we did form a new task force in enforcement on financial reporting and audit. It's also known as shorthand the fraud task force, but it really is, aimed at making sure the SEC on the enforcement side is really doing its part to keep gatekeepers up to snuff. We have an operation called Operation Broken Gate, which you may know about, which is also again focused on auditors who, fall down on the job, and so could not be a more important set of issues. And obviously enforcement's only a piece of it. What you're talking about today are very important pieces of it as well. I think audit performance standards, and I think I've said this publicly a time or so too, that the PCAOB is working on, I think are very important priorities for the PCAOB. Look forward to seeing that work carried forward. I noticed that one of your topics on the agenda is also addressing the relationship between the auditor and the audit committee. This is of particular interest to me. I think that clearly I regard directors and audit committee chairs and members of the audit committee as very essential gatekeepers as well, who have to do their job right in order to protect investors and the integrity of our financial reporting. I do think that the PCAOB, I've thought this for a long time, and certainly that view has only been underscored since I've been at the SEC, that the PCAOB and audit committees and audit committee chairs ought to be really linked arm in arm as strongly as possible, really have the same objectives. So the more we can do in that space, the better. Let me just end by thanking you for all of your service on the Investors Advisory Group. Thank Steve for chairing this. Thank Chairman Doty and the other board members for their leadership. With that, I am here to listen. You might not have thought so because I went on a little longer than I intended, but thank you for inviting me.
Well, Chair White, thank you. And as I recall, last year you were legitimately, totally, heavily involved in sequester. We appreciate your having attempted to make it, but we totally understand that there was a far more important issue to be dealt with at the time. And with that, now I'd like to welcome everyone to today's 5th annual meeting of the Investor Advisory Group of the Public Company Accounting Oversight Board. We know how busy all of you are, and we appreciate very much the time you've taken to participate in today's meeting. In particular, I want to thank the working group members for their work on the topics we will be discussing throughout the day. Their presentations reflect a thoughtful consideration of the issues, and I anticipate a productive session. At the outset, I want to provide the standard board disclaimer that the views we express today are our own and do not necessarily reflect those of the board or staff of the PCAOB. The topics we will be discussing fall under 3 broad headings: the audit firm business model, how to improve audit quality and the relevancy of the audit, and the relationship and role of the auditor with the audit committee. I, too, want to extend a warm welcome to Chair White and Jim Schnur. We look forward to working with you, and we certainly welcome you. In addition, we're pleased that Brian Croto, the Commission's Deputy Chief Accountant, is here with us as well. Brian, thank you for your ongoing participation and interest in these Investor Advisory Group sessions. I know that Chair White has to leave at 10:45, so I will be brief in my remarks before recognizing my fellow board members. And I appreciate your having gotten here earlier than we anticipated. That's very much appreciated. These Investor Advisory Group meetings are important to the PCAOB because they allow us to hear from those who have a well-recognized commitment to investor protection. The board's mission, as clearly stated in the Sarbanes-Oxley Act, quote, is to protect the interest of investors and further the public interest in the preparation of informative, accurate, and independent audit reports. Your views help the board in considering and establishing its agenda. While observers generally agree that audit quality and effectiveness has improved due to the Sarbanes-Oxley Act and the PCAOB, additional improvements need to be made. As noted in our 2013-2017 strategic plan, quote, PCAOB inspections continue to find high rates of deficiencies at the global networks. This is true at the international level as well, where survey results demonstrate that regulators around the world are encountering similar issues with respect to audit quality. As I think most of you know, Lou Ferguson chairs the IFPR group. Many of the topics we will be discussing today are issues of concern to investors worldwide. I have the opportunity to see this firsthand as chair of the Investor and Other Stakeholders Working Group of the International Forum of Independent Audit Regulators. This particular investor group consists of the PCAOB and audit regulators from 8 other countries: Canada, France, Japan, the Netherlands, Singapore, South Africa, South Korea, and the United Kingdom. Certain common themes include, by way of example, a need for an expanded auditor's report that includes more content and broader disclosures of key issues, improved audit firm transparency, governance, and the need for more audit staff training in key areas, the need for auditors to exercise more independence, objectivity, and professional skepticism while conducting an audit, and how auditors and audit committees can better serve the interests of investors. Also, I would like to note that today's first topic, the firm's business model, will likely be a priority subject at the next IFPR plenary meeting in Taipei in April. Now let me very briefly outline how we organize the day. Each topic will be presented by a working group, after which the presenters will lead a discussion among all members. We will end with an hour of general discussion, and the general discussion session will provide an opportunity for each member of the working group to bring up additional topics or issues that were not discussed during one of the day's panels. Finally, I would note that today's meeting is open to the public and is being webcast, and as a result, please identify yourself before speaking. Also, slides and information connected with the presentations will be posted on the PCAOB website. Now, Let me turn to my fellow board members for any statements they may wish to make, and in alphabetical order, we'll start with Lou Ferguson.
Thank you, Steve. I just wanted to talk briefly about my experience last week. I spent a week in Toronto with the members of IFIAR and with the leadership of the largest 6 global audit networks. We were talking about the economic model of the firm. We were talking about inspection findings that they have, and we were also talking about particularly this sort of evolving both role of audit around the world and the evolving nature of these audit firms, what's happening. One of the topics we talked about that I thought was particularly interesting was the beginning of rotation in Europe. The European Union has put in place a directive that will require rotation starting in 2016, but it's already beginning to happen in countries, and particularly in the United Kingdom, it's beginning to happen. One of the things that they're finding, that the Europeans are finding, is that when there is tendering, there appears to be a decline in audit fees from between 20 to 40% in most countries. It's not so true in the United Kingdom. And one of the reasons in asking the question, why is it not happening in the United Kingdom, one of the speculations is that there is, because the United Kingdom has a sort of unified reporting system now where both the audit committee and the auditor itself has to put out a fairly elaborate report. The audit committee's report is a really quite elaborate report that they have to put out. That auditors are very concerned that they have very high quality audits to help them do that. Secondly, the other factor that appears to be important in the United Kingdom is the fact that a lot of audit committees are chaired by former auditors, which is not the case in most other countries. So there seems to be more of an understanding of what is required for the audit. But the firms are concerned about this. They're concerned about that. So we talked about various kinds of ways of dealing with this. Some of the regulators are talking about requiring sort of a 2-stage tender. That if you're going to have a tender process, that the first thing you do is you pick the auditor on the basis of quality. Secondly, you then negotiate the price. But first, you make a choice of auditor on quality factors, and then you pick price. Or, for example, if you have several audit committees have a system where they appoint, or they have a point system, like 100 points that's assigned to the audit bid, and only 30 of those can be related to price. Another concern that was expressed to us about the rotation and tendering is that, for example, in a firm like Ernst & Young, which audits 3 of the 4 large oil companies in Europe, it audits British Petroleum, Total in France, and Eni in Italy, and it will lose all 3 of those clients under the rotation regime. They're very, very concerned that there will be tens of thousands of their employees who have worked for years on these accounts that, frankly, will have to be redeployed. And that's true in other things where, for example, if you have big banks, Deloitte in Spain, which controls the banking industry, as they lose those clients, the deployment of these resources, and there's speculation about whether there'll be mass movements from one firm to the other, so in fact all you have is the same team rotating. But in any case, these are the kinds of things that are being considered as part of the ongoing rotation. So it's going to be very interesting to see what the consequences of mandatory rotation is. Some of the firms believe that, in fact, contrary to what its initial intention was, which was to increase competition, that in fact it will increase concentration, because the early experience appears to be that the winners of these tenders tend to be the 2 firms that have the largest share. So when a 3rd or 4th ranked firm loses a client, it tends to go to one of the larger firms, which may in the long run actually increase concentration rather than decrease it. So these are just some of the issues that I heard about last week, but I thought that you all would find interesting. So, Steve?
Jeanette Franzel?
Thanks, Steve, for your continued leadership and chair of this group, and thanks to all of you for being here today. We really do value the views and the recommendations provided by this group and by other investor representatives through our SAG and through our other outreach. My first IAG meeting was right after I was appointed to the board in 2012, probably 2 weeks after I came on board. And then we waited about a year and a half before we had another one. so I actually went back and reviewed all of those meeting materials from those 2 meetings that I've attended as a board member in an attempt to analyze what have we done and what have we accomplished along some of the lines of the topics discussed here. It was an interesting analysis because I often get frustrated by the slow pace of the work at PCAOB, the difficulty that we have sometimes articulating the good work that we do and putting out information to the public about that, and the difficulties of just bringing it all together. And some of this does involve my multi-year efforts, but I was pleased to see that we've got a lot going on in areas that I think are important to this group. And I think it is worthwhile for us to put together some kind of a framework to analyze what kind of progress are we making or have we made in the topics that are important to this group, and what else do we need to do. And I went back to the survey from the March 2012 meeting on the role, relevancy, and value of the audit. And I think, Joe, you and some others worked on that. And, those were really interesting results. And I think that would be a survey worthwhile to redo again. We're probably not quite ready to do it yet because I don't think we've accomplished enough to be able to measure progress. But when I looked at the survey results and compared it to the comments that were received, it was very insightful. So I guess I would encourage you all to take another look at that and think about whether you think doing another survey along those lines would be valuable. Again, I guess I would suggest we haven't accomplished enough yet for that to be meaningful, but I'm really hoping that we can, in the next year, really accomplish a lot and bring in some of these efforts that we've been working on. So the role, relevancy, and value of the audit, topics that we think about all the time and that we try to work on here constantly. Independence, objectivity, and professional skepticism. Again, we've got a lot of activities that we've been focusing on, a heavy emphasis on professional skepticism in our meetings with the firm leaders, and I think the firm leaders are really finally, or have finally, grasped that concept and tried to work it into training. It took a while. At first there was resistance, but we've been really emphasizing professional skepticism, and we've published some things on that, and board members have spoken at various conferences, and I think we're making some progress in that area. And certainly in our outreach with audit committees and their oversight of the independence of auditors, we've certainly emphasized that. This is an area where we can never stop our work. And so that, again, is something from the 2012 meeting that was very relevant and that we continue to work on. Audit quality indicators, I think this is an extremely important project at the PCAOB. I'm a little bit disappointed about the delay. I think that we were hoping to have something out months ago on this. But it turns out that this is really a complex topic, and so the staff continue to delve into the complexity, and the firms at the same time are starting to delve into this. And so that's the good news, and I think we and the firms need to have some transparent results on this real soon and get something out. And I appreciate this group's input about the need to have indicators that are audit-specific in addition to firm-specific, and so I hope that we've got some results on that in the near future. PCAOB general and inspection reports, we're still working on that, and I think you'll hear about some of the progress. We're actually having a meeting in D.C. tomorrow on that. Audit firm governance and incentives, again, we've got ongoing work, but we need to do more. Auditor interaction with audit committees, I think we've made a tremendous amount of progress there. So, again, I think that all of these topics that have been presented in the last 2 meetings that I've attended are extremely important and relevant, and they continue to be so. And we really need to develop some kind of a framework, I think, for analyzing our progress, analyzing our performance, and then matching it up against some of these topics. So again, I thank you for being here. I look forward to the discussion and to continuing to move forward on many of these issues.
Jay Hanson.
Good morning. Thanks, Steve. I don't have a prepared statement. I just want to be brief and welcome all of you and appreciate the effort you put into the preparation for today, and look forward to the discussion. Thanks, Steve.
Chair White, the way we've scheduled the morning, recognizing you have until 10:45, I've asked each working group team leader or co-leader to present a 5 to 7 minute summary of their presentation so that you get a full and general overview of each topic, after which we'll have a fuller discussion of the first topic, which deals with the audit firm business model and incentives. But before doing that, let me ask each member of the working group to go around the table and very briefly introduce themselves. And why don't we start, Norman, with you and work our way way around the table so Chair White, who's got all your bios, can meet you directly.
Great. Thank you, Steve. Thank you, Chair White, for your time this morning. I'm Norman Harrison, Senior Managing Director of FTI Consulting. In my career as a practicing attorney, banker, and fund co-founder has involved a lot of work with the issues we discussed at this board. So happy to be here. Thank you.
My name is Michael Head, recently retired from TD Ameritrade, one of the larger retail broker-dealers, and currently am a resident instructor at Creighton University in Omaha, Nebraska, teaching accounting and auditing related classes.
Chairman White, I'm Lynn Turner. I currently serve as a trustee on one of the 100 largest pension funds in the world, sit on our investment committee, audit committee, and shareholder voting committee as well.
Chair White, I'm Damon Silvers. I'm the Policy Director of the AFL-CIO.
Chairman White, I'm Tony Sondhi. I run a financial consulting firm, and I'm currently a member of the Emerging Issues Task Force of the FASB, and I also serve as Chairman of the Corporate Disclosure Policy Committee of the CFA Institute.
Good morning, Chair White. I'm Ann Yerger, Executive Director of the Council of Institutional Investors.
Good morning. I'm Kurt Buser. I'm the Interim Chief Financial Officer at the Carlyle Group.
Good morning. Pete Noctway, CFO of Legg Mason. We're a $700 billion traditional asset management firm and former audit partner at Doty.
Good morning, Chair White. I'm Robert Tarola. I'm a former audit partner from a big firm, a former CFO from 3 public companies, public reporting companies, and now serve on the board of a mutual fund group and an operating company and on the audit committee. And I do turnaround consulting for companies in financial distress.
Chair White, I'm Mercer Bullard. I'm a professor at the University of Mississippi School of Law. I run Fund Democracy, which is investor advocacy group, and before teaching, I spent about 10 years in private practice at the SEC.
Good morning. Skipping the SEC people, hoping I know them. Okay, and I do. Last year, who knows?
I'm actually regulated by the CFTC and the SEC, so I have a double whammy. But I'm Larry Shover, CIO of an alternatives mutual fund, and I'm also a contributor to Fox Business News.
Good morning. I'm Joe Carcello. I'm an accounting professor at the University of Tennessee. We're on a governance center there on this group, and as you know, on the SEC's Investor Advisory Committee.
Thank you for both.
Hi, I'm Barb Roper, Director of Investor Protection for the Consumer Federation of America.
I'm Grant Callery, retired 2 years ago as General Counsel at FINRA, and have been doing some work since that time with an outfit here in town called the Yellow Ribbon Fund. We're trying to develop a financial planning pro bono program for wounded warriors and their caregivers at Walter Reed, and also been doing some work with the Association of Governing Boards of Universities and Colleges and their consulting group.
Brandon Becker. I'm Executive Vice President and General Counsel of TIA CREF, and in a former life I was Director of something then called the Division of Market Regulation.
And then joining us, Robert Butner is a Managing Director of Newbrook Capital Advisors. He'll be joining us shortly, and then later on today, Judge Stanley Sporkin will be joining us this afternoon. With that, why don't we move directly to our 5 to 10 minute overview presentations. And Grant, why don't we start with you with respect to the audit firm business model.
All right.
Why don't you take between 5 and 10 minutes? We'll go through the 3 different subject matters, and then we'll turn back to you.
Okay. We will. I'm not going to do, since the group will be making its presentations while Chair White's here. I will just sort of give a touch on the various topics and give a little introduction. This seemed, when we were trying to put the groups together, to be a very popular topic. I think when Steve came out with his solicitation for topics and volunteers to work on the subgroups, I think we got about half of the entire Investor Advisory Group. And as we talked through what we wanted to do, we were focusing on wanting to provide, and this is something that Barbara Roper had said, I think, at last year's meeting, to give the PCAOB, look at things that this PCAOB could delve into and could become interested in, work with from a practical standpoint, rather than just sort of talking off in the stratosphere, and looking at it all as this group is supposed to do through the lens of an investor, whether it be an institutional investor or individual investors. And the purpose today, I think, is these topics are wide-ranging, and some have a lot of, as we've heard, a lot of the topics that the board's dealing with have a lot of different facets to them. But I think if we could get a good, robust discussion today to give some information to the board members and to the PCAOB staff that they could take and work with, that would satisfy, I think, what we would like to accomplish. And I think also if it could lead to generation of discussion within the board, between the board and the auditing community, and board and the auditing community and the commission, that would also be helpful. We realize that a few of the topics that we've got on the list are somewhat sacred cows and are difficult to work through. But as some have said, sacred cows make the best hamburger. So we'll see if we can get a little movement there. I think one theme that you will see through the topics and as I look through our slides again, is there will be a lot of discussion of topics that were contained in the 2008 report of the Advisory Committee on the Audit Profession, the ACAP. And this was a bipartisan group that was appointed by Secretary of Treasury Paulson, and included actually a number of the people around this table. And I think when they went if you look at their final report, they expressed optimism that under the oversight of the PCAOB, the recommendations would receive proper attention. Now, obviously, that's one of those reports where everybody's trying to get their little piece in, so there's some hedging going on. But I think that one of the reasons that report is still very important is while the PCAOB and others have directed a significant amount of attention, there are still a lot of recommendations, and that was really a true blue ribbon panel of knowledgeable experts in the area that have still to be worked on. And I know, as people have said, it's sort of a tough slog to get through it. And there is significant work to be done, but I know that Chairman Doty, in a speech he gave earlier this year at the Baruch College Financial Reporting Conference, talked about the importance of the firm business model and looking at those issues, and said that these are emerging reality for all of us, is the need to understand the effect of these trends and pressures on audit quality. And so I think this all ties together at the end of the day in audit quality from a different group of perspectives. The slides that we will be using as we talk through these topics have been prepared by 4 subgroups of our working group, and I think that they have been distributed, and I think there's a lot of thoughtful work that went into them, and some things that hopefully the discussion today will augment that. But I think that on the documents themselves, it's a pretty good start. And what we've done is we've got 4 groups. The first one is sort of the international landscape, and that will be led by Joe Carcello. And it's basically looking at international initiatives, the ACAP report, where the U.S. is and where international organizations are on issues like the engagement partner signatures, expansion of the audit report, independent non-executives on governing boards, transparency reports, and audit firm rotation. And I think the slides sort of show that the U.S. is maybe a little bit behind the curve on some of those issues. In just coming to conclusions, you may not, without preordaining the conclusion, we ought to at least work through it with the interested constituencies. The second is consulting creep, and there seems to be a reemergence after the audit firms spun off their consulting groups in the post-Sarbanes-Oxley world. And there are issues around that. Again, the conclusions are things that we got to figure out, but I think that it's important to look at those, and Brandon Becker will lead that discussion. The third is auditor transparency and the various aspects of that, which will be led by Mercer Bullard. And then the 900-pound gorilla in the room, who should pay for the audit, and Lynn Turner will take the lead on that. So that is basically an overview of what we're going to talk about.
Thanks, Grant. And then Ann and Joe, maybe you can give the 5 to 10 minute overview on how to improve audit quality and the relevancy of the audit. And since Chair White will not be able to stay beyond the first session, feel free to explain that in as much detail as you'd like initially.
Joe and I are going to split up the summary of our recommendations. Our subcommittee had 6 recommendations, and as you look through, I think, the bulk of the slides, you'll see there's some overlap. We as well dug into the 2008 ACAP report from the U.S. Department of Treasury, which I should disclose I did sit on. And we looked at the report and other issues with the prism of how can this enhance audit quality and the relevance of the audit. And interestingly, there's obviously, obviously there is overlap. I think things that people feel would enhance maybe the governance of the firms, we believe also would enhance audit quality ultimately. So one of our recommendations is that we urge the SEC and the PCAOB to work together in consultation with all the appropriate bodies to analyze and explore the feasibility of the firms enhancing their own governance, whether it's by the addition of independent directors with full voting powers and or through perhaps the creation of advisory councils, which I believe some of the firms have done this. We obviously recognize that the firms are structured as private partnerships, and as such, they're not subject to the governance or disclosure requirements of public entities. However, we believe the really special place of the firms, and unique place really in our capital markets, warrants, we think, some higher standards for their governance and their transparency. And we believe in the end, I think that independent directors and advisory councils could enhance the tone at the top, enhance management oversight, and we think that in turn would improve audit quality. So that's one of our recommendations. Another recommendation touches on the going concern issue, and as we're all aware, in August, the Financial Accounting Standards Board issued a new standard regarding management's responsibility to evaluate an organization's going concern status. The standard places the responsibility for making the assessment on management, who may be extremely reluctant for lots of very valid reasons to make that call. And it also sets a probable standard and a 1-year time horizon from the date the statement is released for that determination. Some users are very concerned that this new standard will actually result in fewer going concern opinions and ultimately with information being disclosed too late to be of real value to investors. Well before this August pronouncement, I think it's probably been 2.5 years ago, this committee addressed and discussed the going concern issue in the context of the financial crisis, and we, I think, concluded that there was fairly abysmal performance of that standard in that context. So I think that this is a long way of saying the new standard really heightens investor concerns about the quality of the going concern analysis. The PCAOB, and we commend it, recently issued a staff audit practice alert on its own standards for auditors, considering a company's ability to continue as a going concern. I guess I'll state my own personal view is that certainly CII, we would oppose any weakening, further weakening, or any kind of weakening really of the PCAOB auditing standard, and indeed I think CII would support an effort to heighten the auditor going concern analysis. And that's really to ensure more timely and meaningful disclosures to investors. And our final recommendation touches really the SEC directly, so I'm happy that you're here. As you know, shareholders have filed proposals at companies for decades now, and for I'd say maybe a dozen plus years they have filed proposals addressing auditor issues. I think in specific proposals asking for the ratification of auditors have been on ballots for many, many years now. In recent years, there's been a ratcheting up of interest in shareholders filing proposals on auditor issues. In particular, we've had shareholders filing proposals covering different types of auditor issues in the recent years, including auditor rotation and auditor independence reports. To date, all have hit the ordinary business roadblock at the SEC, and companies have omitted these proposals from their proxy materials. Our subcommittee sees real value in the direct shareholder feedback that is provided through shareholder resolutions, so we would encourage the Commission perhaps to ease off the brake a bit as it's analyzing auditor-related proposals, particularly ones addressing public policy issues that are being debated really around the globe today. And Joe will cover the next three.
Thanks, Ann. That's a wonderful overview of those three. If you would, Chair White, I want to add just a couple of bits of color to what Ann said. On the audit firm governance bodies, I would encourage you, if you have not already done so, Ernst & Young has done this globally. It's required in the United Kingdom. Ernst & Young has chosen voluntarily to do it globally. The group is chaired by Mark Olson, who I believe you know. Deloitte has chosen to do something voluntarily in the United States. The group is chaired by Dan Gelser, who was a member of the PCAOB for a number of years. In speaking with both of them, I would say their experiences have been very positive, and they believe these groups have been very positive for the firms. In terms of the auditing standard, as Ann alluded to, the FASB has now used the word probable. The auditing literature talks about substantial doubt. If you go into the academic literature, which is pretty voluminous on this, there would clearly be a higher threshold on probable than substantial doubt. So as Ann alluded to, in all likelihood, the information content to users will go down if the PCAOB was to adopt that same language. In terms of shareholder proposals, I think you see immediately that at least 2 of your 5 colleagues might find appeal to let the market speak, which is really what we're getting at with shareholder proposals. Rather than putting in place rules, it would allow the shareholders to speak on various things, and right now their voices are being silenced on some of these issues. The other 3 recommendations that we have, I wouldn't be a good college professor if I didn't have handouts. So handouts are coming around. So the first is to implement an expanded audit report that provides meaningful incremental information to investors. So as this comes around, you'll see on the first page is a letter to the chairman of the PCAOB, Mr. Doty, from Chuck Bowser, talking about when the GAO adopted the requirement that GAO auditors sign their name. And I've highlighted relevant sections of this letter, but the one part that I'll direct your attention to is the 4th paragraph, the 2nd sentence. So that one change resulted in a significant improvement in the quality of the audit work and the report. The next letter is from Sir David Tweedy, who was a partner of a major firm for many years, chairman of the IASB, certainly a well-recognized person. And again, I've highlighted various aspects of this letter for your benefit, but language in by having the partner identified would weed out weak auditors because his or her reputation is now on the line. These all seem to be useful benefits. If you look at the, I'm still on the first recommendation, the next 3 slides are on the second one, but if you look at the criticisms of this recommendation, there's discussion of enhanced liability. I think, as you know, as an attorney, if there's litigation, the partner's identity is going to be easily discovered. There's concerns about consents. With the help of Pete Natchway, we think we have a good proposal on that we'll get to later. There's also concern that some of the firms have shared in comment letters about the personal safety of partners. As someone who has personally identified herself in the past when prosecuting people like Sigmund the Sea Monster and the Butcher, I doubt you have very much sympathy for that. But anyway, there is that concern.
I do not recall those particular defendants, but okay.
So that's our first recommendation, in addition to the three that Ann had. Another would be to require the audit report to include to implement an expanded audit report that provides meaningful incremental information to investors, in addition to the signature. And the last three slides I have are excerpts from audit opinions in the United Kingdom. As you know, this expanded audit reporting already exists in the United Kingdom, and we have a year of experience now. And the first is from Rolls-Royce, which is obviously getting a lot of attention. And if you look at that last paragraph talking about the estimate is acceptable but mildly optimistic. Now, if you're a user, that's clearly incrementally valuable information to you. I don't think any reasonable person could look at this and not conclude that that's incrementally valuable information. The next slide is from the BP audit opinion, talking about the scope, and really I've underlined at the very bottom there, some very specific work that the audit team has done here, in this case the senior statutory auditor, in getting comfortable around some of the high-risk areas in this engagement. And then the last is for Britvik, and talking about materiality, and I'll just let you look at that on your own convenience. And then our last recommendation, our sixth recommendation, is to implement a rebuttable presumption. So the presumption could be rebuttable, that the auditor of an issuer will be inspected, and we have some specifics in here, but essentially if there's a large decline in fees or if there's abnormally low audit fees after you size and industry adjust. This gets at what Lou was talking about, and we have some very specific data from Audit Analytics that we'll present later today. In talking with senior leadership of a number of organizations, this is clearly a problem. And it also, I think, dovetails with one of the other groups we'll hear from today. If you think about the Sarbanes-Oxley Act, in my opinion, the Audit Committee is the linchpin of that act. And the reason it's the linchpin of that act is to basically remove the CEO and the CFO from negotiating the fee and dealing with the relationship. I think in too many cases that role has been maybe not officially, but in practice that role has been abdicated, and the CEO and the CFO is still driving the relationship, or the Audit Committee views their role as getting the cheapest audit fee. I don't see how that can possibly be in the best interest of investors or consistent with good public policy.
Thank you very much, Ann and Joe. And then why don't we move on to Bob Tarola and Tony Sonde on the relationship and role of the auditor with the Audit Committee.
Good morning again, both Chair White and the members of the PCAOB. I co-chaired a committee with Tony Sonde and supported by Kurt Buser, Norman Harrison, Michael Head, and Peter Knockway. And our group explored how the intersection of the roles of auditors and audit committees could provide more confidence in the financial reporting system. We reviewed the current state of regulation and reporting, the efforts underway by a number of advocacy organizations to enhance transparency, and our own experience working with and serving on audit committees. The result was a series of observations and questions that we will put before the IAG later today. But the main message from our review is that there is opportunity for auditors and audit committees to enhance each other's role in the reporting and disclosure framework. For example, the work of the audit committee could be made more transparent. The evaluation of the audit committee's work by auditors could be made more specific, and the protection of the independence of each could be made more clear. As a result of that, we're going to pose 4 questions to the group later today. They are, Should the Audit Committee report on its role alongside the CEO, CFO, and audit firm? In other words, should the Audit Committee report in 10Qs and 10Ks instead of just the proxy statement? Should auditors be required to assess and report on the duties and operational effectiveness of the Audit Committee, or should some other body take that responsibility? Should the auditor's evaluation of the Audit Committee's role reported to the full board, or more publicly than just to the board? And should the auditor be required to assess the objectivity of the Audit Committee and expect that the auditor's independence be protected by the Audit Committee? So those are the questions we'll be asking. Our group believes that a highly capable and functioning Audit Committee is central to audit quality. We therefore encourage the regulatory bodies that have audit oversight, two of which are here today, to seek ways for auditors and audit committees to continue to support the effectiveness of their interdependent roles. And we look forward to a robust discussion. Thank you.
I really am here to listen, but let me just say one thing. First, I think it's you can't overstate the importance of the Audit Committee and functioning at the highest possible level. I mean, one of the, and I've said, certainly alluded to this publicly, that the staff is working, on, the Audit Committee's report, and probably early in the year a concept release will come out on that, and would look forward to everybody's comments on that as well. So we see many of those same issues and are quite actively engaged on them.
Tony, did you want to add your co-lead this one?
Thank you, Steve. Just a few brief comments. And many of them have already been covered by Robert rather well. I just wanted to add that if you take some of the issues that Robert has mentioned about the Audit Committee and its role, its competence, the question we should be also thinking about or asking is it a component of an evaluation of the internal controls at the entity? Another question that, as an investor, has bothered me a great deal is this growing divide between GAAP measures and what is discussed in earnings conference calls. So from a perspective of earnings and valuation, what we're talking about and what people are asking about in the earnings conference calls has been very, very different from what we see in the financial statements. So the question to me on that issue is, how do we ensure that the Audit Committee and the auditors are looking at those aspects as well? And then the last piece that I want to that I would like to emphasize is the issue of this growth of principles-based reporting. And I certainly agree that we need more of that, but the question that comes to me is, what is it then that the Audit Committee should be more aware of with respect to the fact that we're moving towards principles-based reporting? And then from the auditor's perspective, if the substance of an agreement and if the substance of the practices of a company matter at least as much, and maybe in some cases more than expressly written contracts, then how does that affect auditing? And what should the Audit Committee be aware of with respect to that? So I think these are concerns that come from this role of the auditor and the Audit Committee. Thank you.
Thank you, Tony. And before turning to Grant, Chair White, certainly appreciate your understanding on forbearance. In terms of how we run these investor advisory groups, as you can tell, these issues are brought to our attention by this group. I do understand and am sensitive to the role of the Audit Committee in terms of the jurisdictions involved. And the primary jurisdiction is clearly with the SEC, and therefore we tend to focus on the role of the auditor regarding the Audit Committee. Having said that, we do not control this group. And there was an overwhelming desire on the part. There was an overwhelming desire.
It goes without saying.
I know you know it goes without saying. But having said that, we welcome the input of everybody, and therefore you will see and get unfiltered opinions from all of the members of the participants today. And now, having said that, let's move directly, Grant, to your group on the audit firm business model, and we'll take that through 10:45, at which time I know the Chair White has to leave.
All right, I will take my watch off and look, because my primary role here will be to make sure that each of the subgroup folks maintains their 15 minutes. As you will clearly hear, I said that I thought that the principal purpose of this was to, sort of open the discussion and have all sides viewed. You will clearly hear among the members of the group, as Steve alluded to, there are those who have very strong views on some of these issues, and so this is our large subcommittee, and these are the 4 topics that I had outlined that we were going to go through. And I will hand the magic clicker over to Joe Carcello, who will lead the discussion on the regulatory initiative.
So my role here was to try to just do a review of what's going on around the world. And so let me try to go through that relatively expeditiously. So the items to be covered, some of these we've already alluded to, is audit engagement partner signature, expanded audit report, independent non-executives on firm governing boards, preparation of transparency reports, and audit firm rotation. So audit engagement partner signature has been in place in much of the developed world for many years. Australia, Taiwan, China, in some cases for quite a number of years. The European Union varies by country. But on a global basis, in many cases for at least 5 or 6 years, even on the short end. Evidence of the effect of partner signature requirement, as you can imagine, academics love to do research. That's how we get tenured and keep our jobs. Audit quality improves and audit fees increase after the adoption of the signature requirement. That's a paper I did with Chan Lee that was in the Accounting Review. We looked at the United Kingdom. We basically looked at the effects before and after, and that's relatively recent. And then there's a forthcoming paper in Contemporary Accounting Research by Robert Neckel, 2 other authors, that partners whose reporting is aggressive or conservative in the past, that behavior tends to persist over time. So if you're an investor and that matters to you, you now have a sense of a partner's DNA. And it does extend to the partners or the clients. In that paper, there's also evidence that the market prices this, that it does matter to the market. There are challenges to implementation, obviously. One challenge is that consents are needed in registration statements, and the partner may have left the firm. That's one of the things we're hearing is a major roadblock, and I don't take credit for this. I think, Pete, you're the one who suggested this, and I appreciate it very much, is that the SEC could designate consents as evergreen unless financial statements or the nature of the audit report has changed, and that's generally a rare occurrence. Again, this is one of the recommendations that was included in the ACAP report. Second item is expanded audit reports. An expanded audit report has been in place in the United Kingdom since the fall of 2013, so we have about a year of information. Have a couple of quotes up here. One from the chairman of the audit committee, certain that the quality of the audit has improved. The reaction of the audit firms has been positive. Their position's been enhanced. Initial reaction from investors has been very positive. And again, that's the chairman of one of the regulatory bodies in the United Kingdom. Again, there are challenges to implementation. One of the objections is that new information may be communicated in the audit report. Some people feel very passionately about that. I've never really fully understood that objection. It strikes me as that new information is what creates value, and providing value to users should be the goal of the audit report. The IAASB's proposal relates related to an expanded audit report is progressing more rapidly than a similar PCAOB proposal. So we already have this in the UK. My guess is we'll have this around much of the rest of the world, because a lot of the rest of the world patterns after IAASB, and we're moving more slowly. And again, this is an ACAP recommendation. Independent non-executives on firm governing boards. Again, I've alluded to some of this, been in place in the United Kingdom since 2010. Although subjective, I've had conversations with senior people at the FRC and the ICAEW. Both have been very positive about the effects of this, and I've talked about how EY's implemented it. Other firms have chosen to implement it throughout Europe, even though they're not required to. Some have chosen to implement it only in the United Kingdom. Deloitte has established a similar advisory committee composed of I&Es in the U.S. Talked about that. There is challenges to implementation. That could be disclosure of proprietary firm information, but it would strike me that confidentiality agreements could potentially solve that, and this was an ACAP recommendation. Preparation of transparency reports. These have been required in the European Union for a few years. Again, there could be disclosure of proprietary information here. If that's a concern, then aspects of the transparency report could be limited to being filed on a confidential basis to the PCAOB, and again, an ACAP recommendation. And then the last, audit firm rotation. EU, as we heard earlier today from Lou, is implementing a form of mandatory firm rotation. There's some of the specifics there. Italy has required audit firm rotation every 9 years since the mid-'70s. Mandatory rotation existed in Spain from 89 to 95, although then they moved away from it. And South Korea has required auditor rotation every 6 years since 2006. Brazil has increased the rotation period from 5 to 10 years. There clearly are pros and cons on this. I would say of the ones I've put up here, at least on our group, there's probably more disagreement on this than on the others as to whether this is a good idea or not. There would be loss of issuer-specific knowledge if there was mandatory rotation, but you would potentially have an increase in auditor objectivity, and so you'd have to trade those off and weigh those out. Okay. To Brandon for consulting creep.
Yeah, we've got a little time. So, are there other members of the working group who would like to weigh in on any of these issues? We do have a period for just open discussion later, but if there are thoughts that other people from the working group have on what Joe has said, we could take a few minutes of that before Brandon proceeds. Lynn?
Just 2 quick points. It'd be interesting to know in the case of the foreign countries where the audit partner is disclosed, France, Taiwan, etc., how often the SEC is required a consent be actually signed by the partners when those companies have filed a registration statement, as opposed to the consent being signed just by in the name of the firm, which I think is what is almost always done. So the notion that all of a sudden here in the U.S. we've got to treat the audit partners different raises a serious question as to why. The second thing is on the loss of knowledge. If you look at any particular audit, 85% plus the work is done by senior or lower level accountants. Very little is done by the most senior, and the partners only spend about 5%, or as in the case of one of the PCAOB inspection reports, they said it was like 1%. So, and those people often turn over. We've seen some stuff in recent court cases where those people are turning over quite rapidly. So the people who do the majority of the work, there isn't a loss of knowledge about the firm that isn't already going out the door. And so this notion of loss of knowledge, I think, is somewhat a figment of some people's imagination. Partners, yes, and when partners change, they typically exchange data between one another, but they get rotated every 5 years now, so there is not that amount of inherent knowledge. And even where we see that knowledge hasn't turned out to prevent problems.
Grant, if I might, a couple things. One on the expanded audit report, and I think what we've seen over in the UK is that's actually working pretty well. The question here, and as most of the group that's been around for a few years knows, I always point out that there's an F in my title, not an I. So that's the F stands for financial. The I generally in our types of firms would stand for chief investment officer. So I always make sure and go around and talk to those folks, and what do they actually look at, and what are they concerned about, and what do they think of this idea? And in general, I was quite surprised to hear that a number of our largest portfolio managers thought this could be a good idea. The challenge will be substance over form, and do we end up, no disrespect to the lawyers in the room, but lawyers have roles at public companies and at the audit firms, and does it end up being a lot of legalese and boilerplate versus something meaningful? I think that's the challenge. The other challenge was put out by someone who runs our small cap business, so he's managing $40 billion of assets under management investing in small companies. And his point of view was, it better be substance over form, because if it's costing these companies $250,000 to $500,000 a year, extra time from the accountants, extra time from the lawyers, that's meaningful to a lot of the registrants out there. It might not be meaningful to Fortune 250, but the Russell 4000, it will matter. And then on audit firm rotation, and this is a real tough one in my mind. My former firm, we went through a risk analysis, and in deference to those who've left sooner, Jim, or more recently, I've been out for 7 or 8 years, but back in, I'd say the time frame starting about the mid-'90s, there was a very rigorous process of risk identification amongst clients, which industries, clients within industries, and virtually every time there was an auditor change, where we're the new, my former firm was the new auditor, that almost a priori became a high-risk audit. And until there was 2 to 3 years under the belt, particularly for the largest, most complex companies. And my last role while I was at Deloitte was auditing one of the 3 largest clients of the firm globally. There were 200 partners globally that touched that audit. Forget about all the other staff, et cetera. So the issue of institutional knowledge is really important, and making sure that doesn't get lost. Thanks, Grant.
Okay, Brandon?
Thank you. We're turning to consulting creep, which is a topic of some interest that has grown. We know that as a practical matter, the various codes and policy statements allow auditors to provide consulting services that do not conflict with the auditor's independence, and that's standard. But in the past, we did see a consultancy build up where the level of consultancy revenues constituted just 13% of total revenues in '81. It had grown by 1999 to about $15 billion, and we saw a significant increase in the number of restatements during that period of time, broadly referred to here as the Enron effect. After Enron and after those disclosures, we saw a pullback from consultancy. Most of the large firms either divested, sold, or otherwise disposed of their consulting activities. Nevertheless, since that time, we have seen a variety of standards put into place, and I think it's important that we pause for just a minute and take a look at those, because that's going to be an important issue in the next couple of slides. We do now have a regulator setting standards. We do have SOX. We have more robust audit committees, a better definition of independent standards. We've seen a firm fail. We are developing additional disclosure of fees. So the context has changed in terms of the regulatory oversight of consultancy activity and of the firms themselves. Nevertheless, what we see as a practical matter on the ground is a return of the role of consultancy as the big 4 firms, including tax services, have increased to about $65 billion in fiscal year 2013, a 5.5% increase over 2012. And the acquisition of consulting firms such as PwC's, Booz & Co. We can see that graphically here, and here is where I'd urge you to take a pause, and you look at the blue line, which is audit revenues, versus the green line, which is pure consulting, not consulting plus tax, just pure consulting. And you can see that from 2010 to 2013, a gradual increase in the consulting fees into the mid-30 percentiles and a gradual relative decline in the audit fees. And part of the question that is before us and the debate in general is, in light of the additional controls that we just saw on the prior slide, is this a source of increased concern? You can see it more graphically here when you put all non-audit revenues into a bar chart, and you can see that, for example, it ranges from about 55% at KPMG in 2013 to hitting 60% for Deloitte in 2013, so that the numbers are significant in terms of the non-audit fees. Now, that gets us to the question that is really forefront, which is, should we care? And the reasons why we think we should care, or at least have some concern, is talent management. Does this really change the incentives, particularly as we've talked about governance and a partnership structure? Does the draw of consultancy revenues basically suck out the talent into the consultancy side of the business as opposed to the audit side? Does it change the governance, or do we have good governance controls that allow the firm to still focus on its audit leadership as opposed to getting the next consulting dollar? It's sort of a marginal revenue analysis. If your marginal returns are greater in your consultancy, is the firm going to tip its focus into the consultancy world? And that is played out in part because of the partnership model and the difficulty of cross-subsidization. Market risk, a firm may decide to exit audit services, further reducing competition in the field, and a broader public interest concern. Are we creating adequate incentives on audit quality, core audit services not met because we see an increased focus on the consultancy role? Having said all of that, you still then need to think about, well, what, if anything, do you want to do about it? Even if you do decide that you're concerned and you decide that the reforms post-2002 weren't adequate, what might you do about it? Well, one approach is to cap non-audit services permitted for audit clients. The other we mention is whitelist of non-audit services, specific services an auditor would be permitted to provide. Basically, in both of those areas, you're trying to make sure that within the construct of an audit firm, you have a sufficient economic driver that it's the audit that's driving the revenues and focus of that firm. And to use a rough metaphor, the consultancy is the frosting, and that the cake remains the audit work. The strengthening of the audit committees basically is, again, a focus on how does the audit committee itself police the audit services. I think that has gotten stronger. And then ultimately mandating audit-only firms. So eliminate the ability of audit firms to provide non-audit services to any client. That's a structural division. The Commission tried it in 1936 with broker-dealers. It's an interesting experiment, lasted for a while. But it's tough to think about drawing those bright lines within financial services firms because of the cross-fertilization. It has an intellectual appeal, but then if you go back to the talent management concern, have you just created a world where now you've limited the revenues of the audit-only firms so that, fine, that now you start off in your first year going to the consultancy side because you don't want to join the audit-only firm because you've already been tapped out and you've got a ceiling there. It's not unlike the debate that's going on about banker compensation, whether it's here or in Europe. We did not have an answer to any of those questions, but we thought they were really interesting. And I think if we had to put it together, we would say that, and I want to let the rest of my colleagues jump in here, that the driver of concern is, do you have the revenues and the talent that is still focused on audit, or do you tip that scale where you become a consultancy firm? So the cap on the amount of consultancy has some appeal or some balance, because at the point that you're a 70% consulting firm and a 30% audit firm, there is the tail wagging the dog becomes a real concern for us.
Chair Doty, and I think we want to make this as interactive as possible as long as we fit within the 10:45 time frame for Chair White. But Chair Doty...
It's Brandon, it was a very crisp presentation, and congratulations on the balance. It may have been the best summation and condensation of the concerns that we ought to have that I've seen anywhere. I take it latent in this, though, is that none of your team believes there is hard evidence or dispersed evidence of a database type for any of this, that these are things people may have seen and may have been worried about, but we don't yet know the extent to which the concerns are with us. And if that's true, I would be interested in whether the group thinks that perhaps the initial efforts that we should be making in this area are special focus in their inspection.
Well, I don't want to speak for all my colleagues or try and prove a negative, but I think it's fair to say it's hard to go beyond anecdotes to hard systematic data. Now, as the old saying goes, you collect enough anecdotes and you've got data. But we did put in new controls in 2002. It is a creep. It is not a dominance. It would be good, I think, for the board through its inspection program to try and look for where those tips are occurring. And I think it is integrated. I'll just finish and let the rest of my colleagues join me in, I think, the governance conversation. Because whether it's a non-executive member of the governance board or the audit committee oversight, a robust governance process, I think, can help address some of these issues, but needs to speak directly to these issues. And I would think the inspection process could look at that also in terms of whether that's effective or are we kidding ourselves in terms of window dressing.
I think what I'd like to do is, Grant, I'd like to let you monitor the clock for your group
I am
to ensure that we get through it, because we've got a number of cards, and I'm going to let you recognize your team as you see fit.
And Barbara and Kurt were the other members of this subgroup. So, Barbara.
So first, to your question, Chairman Doty, I would say we will have data when the system blows up again. But I think there's a sort of regulatory philosophy behind this. Yes, we have new controls in place since 2002, and yes, we still have a persistent concern about lack of professional skepticism and concern about, persistent low-quality audits. And I think one of the reasons, is that regulation works best when it's not swimming against the stream of financial incentives. And so you have to care about all of these issues related, across the topics of this committee, but all of these issues related to the compensation of the auditors and the audit firms and the financial incentives that govern their work, precisely because if you're swimming against financial incentives that work against the quality of the audit, all of those regulatory provisions we've put in place are not going to be effective.
So some of the things I think would be very helpful to see is really the outcome of the audit quality initiative work that the PCAOB is undertaking. Especially looking at issues like, make versus take issues, I think would be very helpful to the analysis. In the end, I think a lot of this, though, is dependent upon very good judgment by the audit committee. Putting in specific rules to prohibit bad behavior is often difficult in such far-reaching type items. And so having the audit committee, that initiative that you're undertaking, I think is really critical, because that's going to put the right tone and the right people in place to make the complex judgments that have to be made, in each individual situation.
I guess just one final point there. I think Barbara's probably correct, unfortunately, that the next time this really comes to the fore is when there's another blow up, and we want to get out ahead of that. So, Jim, I think to your question, if the PCAOB has the ability to, as part of their inspection program, to look and talk to the firms about what is happening, the incentives, the independence, is the balance that we're seemingly
creeping toward. I mean, you could think of almost a situation where, you over a period of years, you have the consulting rise to a certain level again, and then all of a sudden the firms all spin their consulting firms off like they did in the early 2000s. And as you're approaching that point, and people within the firms start seeing that that's in the cards, then what does that do to the internal structures of incentives and independence, and where are people's mindsets within the firm? So I think to the degree that you can gather information, as imperfect as it may be, because it's, as Brandon said, it's not easy information to gather, but to sort of, as best you can, get your arms around where the creep is going, and are there warning signs, I think that would be helpful, because the worst of all scenarios is you get to another place where there's an absolute blow-up. Anybody else? We've got just a... Oh, okay. Actually, I don't know that we have time to do that. So why don't we move on to the next two presentations, get those done, and then we'll come back and remember everybody who had your card up to put it up again. The next piece of it is the transparency, and that is Mercer Bullard. Pass you the baton.
Yeah, we wanted to just initiate some discussion on the issue of auditor transparency as to their own financials. And what you see here is, again, going back to ACAP, the recommendation of ACAP to follow the lead of the EU's 8th Directive, Article 40, which is to provide basic information about ownership, legal structure, corporate structure. And I note that corporate structure is extremely important in the accounting industry, as you probably know, in that the largest four firms have dozens of different entities in different countries. So that becomes important in terms of the way you approach financial disclosure. And then finally, the financial information that we're all familiar with, because it's similar to what is already provided under SOXA. I went back to ACAP to sort of pick up what the general tenor of the report was. It's hard to really know, because it's my understanding the vote was as to every recommendation in the report. So it's hard to really tell where people stand. But I looked back at the co-chair's introductory letter, and I found a comment that I think sums up much of the report and applies specifically to this issue. The co-chair said, the major auditing firms are key actors in the public securities markets. They must comply with the same principles of transparency that we ask of other major market actors, both for the sake of the credibility of the market system as a whole and for the credibility and long-term health of the firms themselves. And I think that captures one of the arguments that is made in favor of more financial transparency, and that is that here we have entities that are essentially not necessarily quasi-governmental, but certainly serving a public function. They have an exclusive public license. But ironically, with respect to the things for which they are responsible, they do not comply themselves, and that they are auditing others' financial statements and do not make their own public. Another irony I found was that we often hear of the claim by these firms that legal liability threatens their financial existence, which is interesting in that that claim would seem to have to be based on seeing the financials that they think would be threatened, yet those are not disclosed. And of course, the financials of Price Waterhouse are not going to look like their average operating company. You're not looking at hard financial assets, but it would be interesting to look from an accounting point of view as to exactly how a liability, a potential legal liability, would threaten their continued existence. Perhaps it's an excess of dividends being paid in the form of compensation, but it certainly would be interesting to play out that argument in the context of more disclosure. Another aspect that I found somewhat eerie is that I also teach in the area of banking regulation, and the four accounting firms dominating the audits of the S&P 500 look strangely similar to the four largest bank holding companies, holding more than half of bank holding company assets. And I don't want to push the analogy too far, but of course the financial statements of the four largest bank holding companies are the most legally scrutinized financials in the world, whereas the four largest public company accounting firms financials receive no scrutiny at all. Along the lines of if it acts a bit like a duck, does it really look like a duck? Well, interestingly, if you look at the requirements for registering as a reporting company, it's not clear to me, at least before the Jobs Act, why these firms were not required to be registered. I haven't done that much research into it, but they certainly had enough beneficial owners to trigger the 500-person limit and certainly had $10 million in assets. Today, with the limit being 2,000 investors with a maximum of 500 non-accredited, they probably don't trigger registration anymore. But it's not just in that respect. They look very much like public companies. Ernst & Young and Pricewaterhouse are two of the largest 10 private companies in America, and they each employ more people than every private company in America, with the exception of Aramark, which you know is providing poor university food in a lot of areas of the country. So the large number of employees doesn't necessarily mean a good thing. And this is, I don't really have a strong opinion on this. This is really to sort of stimulate discussion. So given that bit of a background, let's look at where we are. And of course, you've heard a number of times that where we are is the division of fees among different categories in Form 2, which now, having been through it, I think if you wanted to bury the signature or the name of the person doing an audit, that would be a good place to bury it if you don't want people to pull it out. But I thought it would be useful in this context to actually look at one of these disclosures, which is a last-minute addition and a separate handout in your charts. The top shows the part of Form 2 where you actually see the data. And what you actually see there are numbers 25, 5, and 0 that represent the percentage of all fees billed to clients, which is obviously not intuitively obvious. If you dig into it a little bit and you think a little harder, you would realize that if you want to know the percentage of fees charged to audit clients, you would put the 5 and 5 together. It would be 10 over 35, which would be about 29%. The reason they're both rounded to 5s is that they are actually rounded to the nearest multiple of 5, which actually means that if they were on the low end on numbers 2 and 3 and the high end on number 1, that could actually be a total of 15% as opposed to 29. If you rounded the numbers down for the audit services and up for the other services, it could actually represent 67%. So given the rounding, what you really have is what appears to be a 29% percentage of non-audit services. But in fact, because of rounding, it could be anywhere from 15% to 67%. I don't think this would really satisfy any data presentation test, and certainly could be improved in that respect. It's also important to see that the flip side of this, of course, is the issuer disclosure. Here we have the issuer disclosure looking very different, to the dollar, and I chose this in part because it shows the trend that Brandon was just illustrating for us. You can see from 2012 to 2013, you see an increase, an uptick in the tax fees, a decline in the audit fees. It makes me wonder whether, with respect to the data we looked at before, there's really been a change in audit as opposed to a decline in a change in not audit as opposed to a decline in audit. So you've really got to figure out which number is actually moving there. And again, what that shows, again, not intuitively, is a 21% relationship. But again, what's interesting about both of these, and this is true of SEC disclosure universally, and it is admittedly a pet peeve of mine, is that there is no context. There's virtually no disclosure in which what you get is data in the context of what other people are doing. So if you look at the dollars or you look at these percentages, not only are the top ones misleading because they're rounded, you have no idea where that firm stands in relation to anyone else. Is that a large number? Is that a small number? Is it off the charts? Is it meaningless? So again, I think that's not particularly useful information for accomplishing the very limited purpose for which it is provided. With those thoughts, I also thought we'd look at the UK requirement. Again, it looks very much like the, not surprisingly, the EU 8th Directive Article 40 requirement, which is the governance, the corporate structure, ownership, and then the same financial information. But when I went in and actually looked at the UK requirements for a couple of the big firms and then compared them to the EU requirements and then compared them to our Form 2 and our issuer disclosure, the UK is actually much better. They have year-over-year numbers. They're not lined up in columns next to each other, but they also are described in very plain English terms that make it very clear as to what is the percentage of what. If you actually wanted to target any of this disclosure at a retail investor, the UK I would probably give an 8 or a 9. I'd probably give the EU about a 5, and we'd probably get about a 3. So even on the front of the disclosure we're currently providing, which is extremely limited, it's somewhat wasted in that it's not really making the point that the supporters of this kind of disclosure wanted to make. Other issues we might want to consider is to think more thoroughly about the relationship between the total percentage of non-audit fees and what we might think about conflicts of interest. Is a firm dominated by non-audit fees? You don't get that at all from the U.S. disclosure because it's completely empty as to what else is going on in the firm. So this was, again, just to kind of stimulate initial discussions or think about where we are and what our current disclosure is doing, and then also maybe think about the reasons that we might want to look at requiring, as was suggested by ACAP, a much more fulsome disclosure of financials, which, by the way, the UK also requires. The UK has profitability numbers, which you don't see anywhere else, for example. So that was all I had in case anybody has any other thoughts. I know we're running short of time, but maybe we've got some initial input.
The other members of that subgroup were Ann Yerger and Ann Simpson, who's not here today. Ann, do you have any thoughts to add to what Mercer said? Okay. Well, then why don't we move on and make sure we get the fourth topic done, which is the who should pay for the audit, and that's Lynn Turner.
Let me go ahead and start while we're waiting for the thing to come around. But first, maybe the best way to do it is set some background and talk about some of the reforms or things we've gone through in the past in this country in the last 100 years or so. We started out a little over 100 years ago with the 1909 panic that ended up with the creation of the Federal Reserve and resulted in the first accounting standard setting in 1917 that was actually drafted by the profession and really the beginning of standard setting in the private sector in the United States. And then, of course, we all know that we had the 29 crash, which gave us the 33 and 34 Act and the requirement for an audit again in the private sector, although that law, as initially drafted, was going to have the auditors in the government sector, and only a late change to that law left it in the private sector after Senate Banking Committee hearing. And then in the 60s and 70s, some of those of us old enough to remember will remember Penn Central and equity funding and national student marketing, which brought us the Public Oversight Board and the initial inspection of firms by another firm, brought us the creation of the start of what's now known as the quality control standards that govern the quality controls that are the subject of Part 2 reports by the PCAOB, and also, for a few years anyway, initial disclosure of the consulting fees, not in terms of dollars, but at least in terms of percentages. Then in the 80s, we had the S&L crisis. Steve lived through this, again, up on the Hill, and knows it well. It led to our first audits of internal control and the COSO framework that we now use for assessing control. And then in the 90s, we also had corporate scandals. Started off with the Waste Managements, the Sendens of the world, if you will, and kind of erupted into Enron and WorldCom and many, many, many others. And that led, of course, to SOX. Some of those are early on problems for Enron, and as well as an investigation of PwC led to the new SEC auditor independence rules at that time as well. So all along we've had these problems, had reforms, had problems, had reforms, problems, reforms, and yet today we're kind of in the same place we've been for the last 100 years. We still get very fine PCAOB inspection reports that cite some very serious problems with audits. They're very troubling to an investor community. I've talked to our CIO at our fund, a $47 billion fund, our portfolio managers aren't even relying upon the audit report because they see very little value in them. And I think that's true, and we're moving to indexing, which even reduces the need for the audits as well, and raises a real question about what is the value of the audit in today's environment, where many of the big problems are never identified by the auditors until it's already been identified by a hedge fund or a reporter at the New York Times or Journal or someplace. So with that kind of in background, I do think the big issue and the elephant in the room, ultimately, the one we don't deal with, we've done all these reforms, we've tried to deal with it through independence rules, I know that one all too well, but at the end of the day, we always come back to the same issue and problem, and we've never fixed it. And it's because at the end of the day, we refuse to take on what is the elephant in the room and the tough issue, and that is who pays the auditor. And it's not just who pays the auditor, but more importantly, it's how do you line the auditor up to where their interests are being viewed as those of the investors and get that alignment. And what's troubling about that is about a year or so ago, this month, the National Association of State Boards of Accountancy, their board was holding a meeting, and they had a great debate at that meeting. And the debate was, whose interest does the auditor serve? And the chair of NASPA was arguing that they serve the investor's interest. But one of the senior partners in one of the big four firms was arguing that the investor or that the auditor had no public interest, had no obligation to the investor as a matter of law. And that is very troubling when you see a senior partner at a big four firm arguing that in that type of venue. But that's not the only place. You can go to the court filings in Florida a few years back where one of the big top six firms, BDO, was found guilty 3 times. That case was tried 3 times, and all 3 times the jury found him guilty. And in that case, though, BDO filed a brief with the court that again argued they didn't have an obligation under law to the public whatsoever. And so you've got this great disalignment, which is why we end up with the problems that we do today, and that should be no surprise to anyone when you really get back down and think about it. So the question becomes then, how would you go about realigning that interest and taking on the elephant in the room rather than kicking the can down the road and always just nibbling at the edges and keep coming back for over 100 years now and having the same darn problem again? And I've given it some thought, and here's some ideas. One, just as some have argued with the credit rating agencies, I would eliminate the requirement in the 33 Act for an annual audit of the financial statements. Just get rid of it. And, initially that sounds, whoa, do I really want to leave all those CFOs out there doing their thing without any oversight? But research has shown that about 70-75% of the time the CFOs actually are doing the right thing, and I think they would. I have that level of trust. Now, 20-25% of the time, though, research has shown on a number of occasions, not just once, but on a number of occasions for the last 15 years or so, that they do cook the books by a material amount. We've seen survey on that. That's true. But the problem is those surveys also show the auditors aren't finding them. So on that percentage, why pay the cost of the audit if they aren't finding them? So I wouldn't do away with the audit because I think there is value if it's done right. If it's not done right, it's misleading, and it's worse than no value. It misleads investors into making wrong decisions and wrong capital allocations, and very costly not only to investors but to the country. So I'd replace it with a government mandate in the law that says every 3 to 5 years investors get a right to vote on whether or not an audit. And I think almost all the time investors would require that and vote to have the audit, but it changes it from being a federal mandate to being a decision made by investors. So you're only protected as an auditor as long as the investors are willing to vote for it. And then I'd also give the investors the annual right to approve the auditor has been selected by the audit committee. So you have now all of a sudden really changed the alignment as to who's saying you got to have an audit. It's no longer a government mandate. It is investors. And if the auditor isn't getting the investors what they want, gone. So then that keys up the issue of, okay, how do you pay them? Well, we've got a vehicle for doing that. The PCAOB collects a fee today from the companies. We can do the same thing and put it into a pot of money. I would still, people ask me, who would you have negotiate the fee? I would still have the audit committee negotiate the fee, which most often is not done today. There's a false sense that it's done because of SOX, but that's not true. I participated in a conference put on by FEI and CFO Rising in Vegas a couple of years ago. Maybe casinos was the right place to do this one, but any rate, the question that got asked to the audience, there's about 300 CFOs, controllers in the room, and the question was asked, how many of you negotiate the fee in the terms of the audit engagement letter, the audit contract, versus how many of you that's done by your audit committee, either chair or as a group? And of the 300 or so people that we had there was, I think, 5 or 6 that said the audit committee did it, and the rest of them all said they're actually doing it. So I would turn around and make sure as to who's going to negotiate that fee. So you're, again, breaking the tie to direct to management. You're breaking the tie as to who signs the check. The audit committee would negotiate it, present the bill to the PCAOB. PCAOB would turn around and pay the bill, and that would then start to make your alignment directly between the auditor. I would also give the PCAOB the right in that scenario that if they found a really bad quality audit, as we've seen in some of these inspection reports, they would have the right to demand that the auditor be changed out. And there's 2 different sides to rotation, but at the end of the day, what it's all about is, are we getting good audits? This ensures that if the PCAOB, in fact, factually finds a problem with the audit, they're given the right to demand the audit committee replace the auditor. And there's other things that I would probably do as well. Certainly, the point Jeanette made about audit quality indicators, I couldn't say more that that's been 6 years since we issued the ACAP report. 6 years, way too long to have to wait for that. That's not a 6-year project. The staffing realignment, there has to be something done differently. We're still having, 85% of the work done by fairly junior level people, good people, very talented people that these firms hire, but they are so far in over their heads from the audits I've seen. I've been retained by a number of U.S. trustees to take a look at them, and what I'm seeing today is very, very discouraging. And they just aren't getting on top of it. They're in way over their heads. So I think and I think we've seen some of this also in the PCAOB inspection reports as well. And the QC standards have got to be updated to take care of that and make that change. I do think Paul Volcker's concept of an audit-only firm, which he really developed out of Enron and Arthur Andersen, where he sat on their oversight board, I think is a valid point, probably a much more valid point than rotation. I think that's something that has to be considered. I commend Chairman White, if you're working on the audit committee report. Harvey Goldsmith and I wrote that while we were there, and it's long overdue to redo that report. It was a step forward at the time, quite frankly, as far as we could go and get something passed at that point in time, but it needs major revision, major rework at this point in time on that. And I do think we got to redo the auditing standards in terms of auditors have got to start looking at more of the external data than what they currently are, which is usually negligible or next to none. And that's why the hedge funds and the New York Times reporters find it and the auditors don't. So with that, I'll leave it at
Okay. Well, we said we were going to get to a couple of sacred cows, and we did. The two other members of that subgroup were coming in on time here were Brandon and Bob Buettner. Either of you have any comments on follow-up to Lynn?
I would just ask Lynn one question. Lynn, you brought up the concept of indexing. So to what extent do you think that this move towards passive investing, were all of these to be adopted, and obviously investors at that point would be voting on whether to have an independent audit or not, to what extent do you think the indexers would be more inclined to vote against that, obviously not bearing direct responsibility for a 10% position that might collapse?
Well, I can use our fund as an example because we index to in essence, the Wilshire 5000, and we have both a significant passive as well as a significant index fund, and I actually chair our committee that oversees our shareholder voting. I don't think it would change our voting because our voting guidelines and what we use to vote and how we make our decisions on voting is based upon, in essence, what we're seeing going on with the audit and how we feel about that. Unfortunately, today, we don't get the information we need to make a real informed decision, which gets back to Jeanette's comment about audit quality indicators. You're asking us to do a blind vote today. And if we had the audit quality indicators, I still think we would be taking a look at those. In fact, I know we'd be taking a look at those and still voting yay or nay on this. I think most of the time we would vote to pay to have an audit because it does give you that assurance, but we'd also have the trigger if we didn't like what we saw, then to say, no, we want someone else. And we get on the phone a fair amount with other large institutional investors. And we've been on the phone with a number of them about audit issues. I can't help but think that if there was something that showed a problem on an audit, that we wouldn't get on the phone with other people and kick it around and decide whether or not to vote against the auditor. We've been on the phone with others, Damon and his people and others on audit issues, so I don't think it would change. The whole thing with indexing is once you go to indexing, the value is in where the market's going and what's driving the market up and down, not so much of individual companies.
In the interest of time, I'm going to cut you off, give Brandon a couple minutes.
And then, we have 4 minutes. And can I just preempt Brandon and ask a question, if that's all right? Sure. And then we have a lot of tent cards after the chairman leaves. So we got an hour for discussion.
We have an hour for discussion.
Yeah, but I would like to touch upon the economic guidance of the SEC and the cost of the benefits of what we're dealing with, and realizing that we can't answer this in 4 minutes. Whether it be Joe with you on transparency or Brandon with you on the consulting creep, or Lynn, if each of you could talk just for 2 minutes in terms of how you would recommend that we measure the benefits versus the costs and how we deal with the Jobs Act as we go through these various recommendations, I'd appreciate that. And then, as I say, we'll wrap this up in 3 minutes because I know you've got to get out of here at 10:45. Anybody who care to respond to that?
I wouldn't pretend to know how you deal with the D.C. Court of Appeals, but I think you look at the inspection reports and you look at the history of damage to compute your costs and benefits, because if you just look at the out-of-pocket expense of dealing with consultancy, the numbers are going to be wildly skewed in terms of the expense side of the ledger. You got to look at what happens when this stuff blows up. And then I think, but I'd love to get the courts to accept this, you've got to do a distributional analysis, because small shareholders and retail people get hurt disproportionately in those situations. My guys aren't heroes, but my portfolio managers can see stuff. It's those who are caught disproportionately are the retail get hurt when this stuff blows up.
Okay. Barbara had one comment.
So I actually have spent a fair amount of time looking at that decision, and it doesn't, in fact, require you to have data that you don't have. It requires you to have a good story about why this is a necessary regulation, about why you think it is reasonably likely to work. It requires you to have made a good faith effort to collect data, but where the data is not available, it doesn't stop you in place. And there have been a couple of decisions now, one at the CFTC on commodity pool operators registration, the SEC's on, was it conflict minerals, where the analysis has passed muster with the court. So I don't think, I think it's really useful to go back and read those decisions and see what it is that they're saying. And I don't think you have to be afraid to act where there is not data available, as long as you've gone through the reasonable steps of collecting data and can explain in reasonable terms why your approach makes sense.
Sir. Steve, I think, was your question sort of generally how to look at the Jobs Act? Or well, in terms of determining how effective it is, one area in which it directly affects the accounting is that I've been trying to look at whether confidential filings are allowing firms to hide and then see if the SEC catches accounting issues. And, of course, a firm that had that problem earlier in the last decade was one of the reasons that we had that confidential filing provision. So I think that would be something very useful to look at. A recent study came out showing that there's a massive amount of insider trading going on based on SEC comment letters that are coming out to the public later than they're coming out to executives. So one would expect perhaps the same thing is now happening with respect to their confidential filings. And also, for personal reasons, I'd like to see that because I've been trying to research this issue. It's almost impossible to do a red line version of one registration statement against another, which is yet another reason why I think the SEC should require that every amendment to a registration statement be redlined, like everyone else at this table has done with a Word document, have words that have been eliminated crossed out, and have words that have been added shaded, so we can actually see what the changes were.
Grant, you got the final word, and then it's time to take the 15-minute break.
Okay, we hope this has been a useful discussion, and we do have an hour when we come back when we'll go through in the same order so everybody can get their tent cards ready, and we'll go through the 4 issues. And thank you all for the presentations.
If I may just say, this has been enormously useful, and I do intend to watch the exchange in the next hour. I'm sorry I can't be here live, but I think I can see it, right? So, I definitely will. So I appreciate it very, very much. Thank you. It wasn't easy to stay quiet as I did either, so you can get through it. So.
In 15 minutes.
Should have asked a switch on that.
Tony Sandy, if you'd... Tony? Nina? Could we get everybody back in the room so we can regroup? A gong. All right, Grant, if you could take it away. I know that when we broke, there were a number of tent cards up.
There were.
If people could put them back up, and then you could recognize them in whatever order.
Right.
I think we do have another good hour worth of conversation on this topic, and then we'll break for lunch.
Okay. Why don't we go through in the same order we did last time? So for your tent cards, we will start with what Joe covered, the international landscape, which is kind of the what's going on around the world, and some of the ACAP recommendations, and we'll do the questions or the discussion from the group in that same order of the 4 topics. So starting with the international landscape, tent cards up. Where'd they all go?
I might just
sure.
opine very briefly on that. I think the recommendation that some objectivity or subjectivity, if you will, be put into the audits, similar to the 3 examples that you pulled out, the Rolls-Royce example, the Bridvik example, are extremely helpful. certainly to someone like myself who does invest funds and who does pay close attention to audit quality, I would say that if something similar were to be adopted here in the U.S. in our accounting profession, there are very few people who historically read audit reports, and that there should be some requirement that if we go down that route, there should be a means to publicize those subjective and or objective or additive work that was done by the accounting profession so that investors are aware of the auditor's interpretation of how management is presenting their financial statements. Thank you.
Barbara.
So I agree, and I thought it was particularly interesting when Lou Ferguson was speaking earlier that the presence of that requirement in the UK appears to have had a measurable impact in terms of the different effect of auditor rotation in that context. And the statement that auditors who have to provide this more robust reporting then want to make sure they have the audit to support that is exactly what we're talking about in this context of how do we change the incentives to improve audit quality.
Okay. Any others on topic one? Oh, yeah, Lou.
Yeah, just sort of adding a little bit to what Barbara just said. The experience in the UK was quite interesting because the original requirement did not require auditor rotation. It required that the audit committee tender every 10 years or so, and then if it kept the auditor, it was permitted to keep the auditor forever if it wanted to, but if it kept the auditor, it had to explain why it was keeping the auditor. And the experience, particularly with large issuers in the U.S., in the UK, that the FRC found was that audit committees were very reluctant to have to explain why they were keeping an audit firm. And so rotation began to happen even in the absence of a rotation requirement, which I thought was quite interesting. Now, of course, it's a different landscape because rotation will be mandatorily required under the new EC directive.
You had mentioned in your opening comments about the possibility, or are they actually seeing audit teams following when there is a rotation?
Not yet, but one of the interesting questions will be, for example, for big banks in both Barclays and HSBC are changing auditors there, and there really are only two firms that audit banks in the UK, KPMG and Pricewaterhouse. And so the question is, will they simply swap or not? And if another firm comes on, either Deloitte or Ernst & Young, they don't have strong banking practices in the UK. So the question is, what do they do? How do they get those people if they happen to be picked to be the auditor?
And if they do that,
are they going to try to hire the team and things like that? So there are a lot of issues. The other issue that's kind of interesting in the UK will be there was a great deal of buzz about these the auditors' reports this year, because they, particularly in things like Rolls-Royce and a company called New World Minerals, the auditor actually opined on his view of, for example, the riskiness of some of the financial statements. But one of the questions being asked right now is, okay, what do we do for an encore? What happens next year? And are we just simply going to repeat the same thing because probably the company hasn't really changed very much from one year to the next? So I think will this historically, or in retrospect, will this turn out simply to have been kind of a flash in the pan, or will it actually lead to more thoughtful audit reports each year? And I think that is unclear.
Damon?
Yeah, I just wanted to note that there's a great deal of there's a significant amount of overlap between this part of this working group's report and the next working group's report, and to the extent that the folks from the commission are paying attention and so forth, I think this is really noteworthy because it really suggests strongly that there's a sort of common body of policy recommendations here that different groups of people working independently will come to in terms of the partner signature, the expanded audit report, and the issue of independent directors on audit firm boards. I wanted to observe two things about sort of taking off from that. One is that in relation to the expanded audit report, it's been mentioned a couple of times earlier today by members of the working group that there's a concern about boilerplate, which is a concern I share in these areas if it's not real clear what it is we're asking for. In my view, what gets you away from that is a requirement to discuss the most significant matter of concern that arose in the audit process. I think the examples that are attached here seem to get you there, in our society, which is different than the British public company landscape, we may really need to mandate that more directly in order to get that outcome. The other thing I wanted to observe, which I'm not sure when to observe it in the course of all these things, but I've got the floor now, which is that really the PCAOB should be, I think, listening to a lot of what is said in this presentation and throughout this morning as really kind of disturbing evidence of important voices in the investor community and in the auditor community that are represented on this committee, feeling increasingly agitated that public company audits are simply of diminishing relevance, and that there are reasons structurally for that, and some of those reasons seem to be bringing back conflicts of the past, but also, I think, a growing sense fed by anecdotal experience on the part of a number of different people in a number of different situations at major companies that auditors are simply providing a false sense of security and are not getting at the real problems that exist in public companies, and then those problems surface later, and people are harmed, in particular smaller investors, and less, and as Brandon said, less well-informed investors are harmed. The depth and the urgency of that concern, I think, coming out of that leads to recommendations of the kind that Lynn went through earlier, seems really kind of obvious from these recommendations, and particularly when contrasted with, I think, kind of what you would have heard had the similar group of people been gathered, say, 10 years ago. Because, in fact, the similar group of people was gathered 10 years ago, made many of these recommendations 10 years ago. The way in which these concerns have grown over time, I think the PCAOB ought to be attentive to.
Okay. Tony?
Yeah, I'd been thinking earlier about a couple of other comments, and one of the things I wanted to talk about was the issue of the cost and the cost that the small firms are facing. And one of my concerns with the FASB has been their decision to form that private company group, which is now creating some separate accounting standards for smaller firms. And I know that as investors and at the CFA Institute, we've always been against that because we're concerned about what effect that has on financial reporting. And I realize, I understand the cost concern that was mentioned. Unfortunately, it's not only had the effect of creating and issuing some standards that don't work very well, but in at least one case, the impairment of intangibles, some concerns mentioned by small firms have led to the diminishing of the accounting for even larger companies. So that creates, I think, a very significant problem. The other issue that Damon was just mentioning about the concern that whether people are using audits and so on, not quite the indexing issue, but another issue that people have raised is the use of non-GAAP measures. And I would just like to remind people that all those many of those non-GAAP measures actually are adjustments to GAAP measures. So I don't think that we're not paying attention to auditing. We're just using it differently.
Joe.
Just a very quick response to Lou. Lou, your point about what happens next year as an encore is a fair point. Obviously, as we say in academia, that's an empirical question. But just to give you a sense, and I'm sure you've had some of these same conversations privately, my conversations with at least some of the regulators in the United Kingdom is, although they're pleased with first year, they don't think they're at the end state they want or that they envisioned. And the sense that I get from listening to them is that some of the companies there realize, and the audit committees realize, they're not where they need to be yet. And the reaction has often been, well, it's the first year. This is a start. So if that's accurate, and if we see that going forward, that augurs well for the future. But, we'll have to wait and see.
Okay, I don't seem to see any more tent cards on this topic, and we're 15 minutes in, so that's good. Consulting creep. Here come the cards. All right, why don't we just go down, Norm?
Thank you, Grant. First, briefly, just a word of thanks and praise to you and everybody on your group. It's really a great presentation. A lot of, as you mentioned, top drawer issues, none of which are of recent vintage, but they don't diminish in importance over time. So I'm glad we're having these discussions this morning. I wanted to briefly follow up on an observation that Chairman Doty made in his comment following Brandon's presentation about whether perhaps the issue of consulting creep should be explored further through the inspection process, and I would suggest that it should, and that in particular a potential related phenomenon of what I'll call fee creep should be included in that. And what I mean by that is I think we know we're certainly still in an environment where reporting companies are working their auditors pretty hard for reductions in audit fees, and I think we have to acknowledge that what very often happens in those circumstances is that there is some form of an implicit or explicit agreement to provide a break or some reduction in the audit fee in exchange for some willingness on the part of the company to send business to another aspect of the firm, tax return preparation or the tax provision work or some form of consulting services, which may or may not raise an independence issue with a capital I, but certainly at least raise one with a lowercase I, or potentially some form of conflict. And it raises a number of issues, and including what significance do we attach, or what is really the meaning of the categorical disclosures of fees if there's in fact been some trade-off or subsidy or transfer occurring through this process. It reminds us that to the broader issue of firm culture and incentives that are driving the economic model, it reminds us that the three or four segments of an audit firm are not independent actors. They're part of an integrated business. And I think that's something we also need to be mindful of as we look through these. And the issue we've discussed in this forum many times of whether we're still in an environment where we have audit firms that also offer tax and advisory services, or whether we have advisory or consulting firms that also offer tax service and audit services, which I think is an important question. And it also touches on the issue that Lynn and others alluded to, and that is getting some further visibility into who's really in the driver's seat in terms of negotiating the fee. So I think that it would be a topic well worth some effort in the inspection process. It will involve peeling back the onion a few layers, but I think when you begin to do so, you'll see there are a lot of important questions here, and you may, depending on how you decide to approach it, come up with some interesting data about how fees are negotiated and allocated, and whether there is in fact some form of transfer or subsidy occurring that might raise some significant issues.
Mike.
Obviously, the three topics of rotation, consulting creep, and the level of fees and who should be paying the fees, it's almost impossible to separate the three, because when you turn one lever, I think they impact the other two levers. But some observations as I listened to the comments and as I read the presentation, and my own experience of dealing with audit committee and the selection process and who's negotiating fees. I have to kind of start where Lynn ended up. I personally, because I was part of a team in the negotiation process with the audit committee and supporting them, where early on the audit committee made the stance of we are not going to pay our audit firm for any services other than auditing. I think that's the key, and I think that should not only be what the audit committee through their discipline adopts, but that it should be mandated is a little strong term, but strongly encouraged by PCAOB and the SEC, because I think if you get that right and the coexistence of consulting in these large firms, that the consulting, at least the way our firm, and we used EY, the way our firm would draw upon those consultants that had the subject matter expertise to complement in the risk assessment and execution of the audit, and we didn't have the worry that they had a pass to the halls to sell their consulting fees, because that was usually why the conflict was there, is they wanted to bring them in to educate management, quote unquote educate management, when what they really were wanting to do was have a way of convincing and showing their subject matter expertise that could lead to non-audit fees that had much higher realization and profitability than what the audit fees did. And by still allowing that, but they knew they were prohibited, we were not going to hire them for consulting, then the true wanting to educate management and improve the quality of the audit and supplement the team became much more effective for us. And we felt that led us down the path of then the rotation would be driven by quality of audit, and the fees would be driven by quality of audit. But I do think if you took, and in my case, I was supposed to be the data gatherer. I was supposed to coordinate with the audit committee and the CFO and others involved in making sure the fees and the quality of the audit and independence and objectivity all were accomplished. I can tell you from practice, under the current scenario, that is a very difficult task, because the CFO does believe that the services being provided is directly related to the product they're supposed to be providing to the shareholders and to the board, and you can't separate that accountability for the product from the fees totally. But I think if Lynn's model was more of the pooling and the fees came out of a pool not controlled by management or even the board of the audit committee, and it was, then you could get the CFO fully engaged, knowing that the fee wasn't being controlled by the negotiation between the firm and the auditee. Then the negotiations would be the right team, the quality, and if they aren't delivering that, would they ultimately then want to put the bid out for services? I'm afraid if you mandate rotations and try to address the consulting without addressing the fee, you're going to get unintended consequences by turning the dials separate from it. I think you have to address the fee at the same time. And I know I ramble a little bit there, but because I think it's so complicated and intertwined, you can't leave the payment of the fees out, or you're going to get unintended consequences on the other two topics. Thank you.
Okay, we've got 4 more tent cards and about 12 minutes for this topic, assuming we're going to divide them equally. So if everybody could shoot for 3 minutes. Lynn?
First of all, on the slides, there was a slide that said Enron effect and had the KPMG, EY, PwC spinoff. My point on those is it wasn't Enron effect because all of those were negotiated or basically sold before Enron ever popped up. What drove the people inside the firms to sell those was the value that they thought they were getting at that point in time. They all thought they were getting 5 to 7 in the case of PwC, I think maybe something like 15 to 20 times revenues. And it was the dollar sign that in each one of those cases caused the firm to turn around and decide to sell. In fact, in the PwC case, we'd met with them in December of '98, and they vehemently opposed any condition or attempt to force a sell of the business. Then we issued an enforcement action against them over independence in January of '99. They started to lose substantial clients, including some big ones, and within like 48 hours of when they'd been called by, I think, 3 of those big ones, they called us up and asked for a meeting and came in and announced that they were going to put an article in the Wall Street Journal saying they were going to sell their consulting practice because it was the right thing to do. And in that article, they talked about how not having consulting was the right thing because it was the audit that really counted. And so it is amazing. It was all about the dollars that pushed those things off. And if you look at where we are today, it's all about the dollars in terms of acquisition of underwriters, investment bankers, et cetera, and that's what drives them, and that's why Paul Volcker is so strong about the audit-only firm. I think Paul's probably right about that one. I did have a discussion 2 years ago with the senior partner, the top government relation partner for one of the Big Four, and he indicated to me, because they had a big consulting practice, that the consultants were actually absolutely driving the leadership of the firm crazy over what the consulting firm side of the practice wanted to do or not do. And certainly we saw this in the Anderson case, and as you well know, Jim, what that led to in terms of arbitration and the outcome and the ability of one group to control the other group. And so I think those factors all have to be considered in what you do. But at the end of the day, it's like the mole game at the circus. Certainly I was involved with the audit independence rules we did in 2000, and we knocked down a bunch of them. We picked off all the big ones at that point in time, and between what we did and what Steve did with SOX, it took those all out, and with the spin-offs it went down. They pop right back up again, and now it's in risk management or other areas. It will keep doing that until you take on the elephant, because it's the elephant in the room. It's who pays that drives the conflicts and the problems, and most importantly, human behavior. And this is all about human behavior and how people act given the incentives. That's 100% of what this is about. And if you don't fix that problem, you can do all the independence rules you want. You'll have another mole popping up.
Tony.
I'm thinking back to what Mercer did so well with how carefully you need to look at tables and disclosures of information, and I was wondering whether we have, one, the right metric in terms of comparing what's going on with consulting versus the audits, and second, whether the information the data, I should say, that we have on the fees and the revenues is actually reliable. I remember, as Joe pointed out earlier, that when you're an academic, you need to think about research, and my interest would be in terms of the empirical information I can get and the empirical analysis that I can do. And there is one thing I've always known about accounting allocations, and that the only thing you can really say about them is that they're arbitrary. So I don't know whether the numbers we're getting are reliable. So the fact that they may not be growing that much or may be growing that much is something we can't say unless, as somebody else, I believe, or maybe it was Mercer, pointed out, we really do need information from these accounting firms about their financial results that is reliable and transparent. Then I think we can understand. But there really is a substantive issue about the quality of the work being done in audits versus the quality of the work done by their consultants. And as Lynn points out, the consulting folks certainly do drive what's going on in some ways. But whether we have the right metric to evaluate them is, I think, an open question.
Pete?
Yeah, thanks. So absolutely agree that there's got to be the right tone at the top in these firms and trying to find the right balance between the sacred duty that they have as auditors and, again, whether there was really a choice of ultimately having the concentration that we have or not is water under the bridge. But at this stage, we've got concentration in the big four firms, and they audit substantially all of the major companies in the U.S., and they've got to acknowledge the fact that that is a sacred responsibility to the investors around the country. But having been there, I don't know how in the world you do a complex audit today without deep experts in a variety of areas. And CPAs are simply not trained to deal with the complex valuation issues, the complex tax issues, the cybersecurity and systems, et cetera, et cetera. So we can either have a world where we force them out of these businesses, and then they're going to hire third parties, and now you're going to have how many different experts coming from a number of different firms to come in and audit these things, or we figure out a way that they can live together. And part of living together is going to be you can't have top talent. And I'll go back to one experience that I had formerly at Deloitte, where I led the valuation practice when FAS 141 and 142 came out, which were on fair value. And the whole reason that the firm asked me to go do that, because I didn't know spit, I'll say, of about valuation, binomial models, et cetera. But what I did know was where we needed that kind of expertise to be deployed on complex audits, and how did you connect the dots between the valuation folks, who frankly the practice wasn't built around audit support. Occasionally they did audit support. The majority of what they did was deal with Wall Street and helping to design complex financial instruments that met the rules, or they were valuing power plants and dams for companies that were acquiring those types of things. Doing audit support was kind of a hobby, and it had to go from being a hobby to being, no, this is really important if you're doing this and the audit side of the firm is relying on you. And so, again, just a multiplicity of areas where that comes into play. So how do we ensure that there's access to those world-class kind of resources inside the firm when you need them? And it's not going to be just purely audit support, because you're not going to keep the top talent if that's all they're doing.
I mean, that's I think a really, I mean, it was part of what Brandon went through of the what are the solution lists that we've got, and how do you blend them? Because I think what you're saying is either you go to this model where every time you get something that's outside of the regular wheelhouse of the auditor, you're bringing in an outside third party, and that has to impact costs, it has to impact efficiencies, all this kind of thing. And how do you balance that against, say, the firms needing to have this talent in-house, be able to use it, and when they're using it for non-audit purposes, then that drives the growth of the consultancy again, so you get into this whole cyclical thing. And if anybody around the table's got the answer, that would be a great one. But Mercer.
Yeah, in looking at some of the disclosure that I had up on the slides before, there was one thing that really struck me, was that there was nothing about any of the non-audit fees that were paid to the non-auditing firms. And to really understand what the relationship, you would need that data point. And one reason it's not provided may be that everyone assumes, and this may be the case, that when you hire an auditor, that auditor does all of your non-auditing services. Now, if that's the case, think about that for a minute. That means that every time a company chooses an auditor, they just happen to find, they're using one of the top four, that the one that they chose to do their audit also happens to be better at all of the non-audit services than all of the other three every single time. Now, if you ask an antitrust lawyer about that, they would say that can't be true. That's an economic impossibility if there's real competition. And then the explanations would not be very nice. One would be outright collusion. It's probably unlikely. Another might be a more benign form, which would be it's a tying arrangement. If you do the audit, you've got to do the non-audit services, or vice versa. Another theory might be it's just flat-out influence. We will buy your non-audit services if you give us a soft audit, which, of course, is the theory behind the disclosure in the first place. And then the last theory would be that, well, they're so intimately connected that when you get somebody to do your audit, then you should have them do your non-audit services. Well, that's exactly how we chose the things that you were prohibited from doing under SOXA. So if that's true, then those things, if they're that closely related, should not be allowed to be done at all. So just the fact that it seems that all of the non-audited services are always being provided by the auditor shows there's something just deeply wrong with the economics of that relationship. And I think it would be essential to know whether that really is the case. And if it's the case, what possible economic explanation could there be?
Jim?
Just a couple of fact points. One, to Norman's point, we do look in our inspection process in the risk selection of audits at swings in compensation where there has been, we think, a suspicious adjustment of compensation one way or the other. That goes into a factor-laden determination that, along with identity of the engagement partner and a lot of the issuer, the registrant, the industry, a lot of other factors. So it is something that I think we've looked at, we're going to look at more. We are, of course, we're out with a consultation paper on estimates, which serves up the question that you're on that Pete Notchaway mentioned. And we are, among the long list of things that standards has to address, is the supervision issue. How does an auditor supervise someone whose skill is simply not his own? Recent discussion on all of this, on the estimates and a roundtable, led to an interesting exchange in which it was proposed that, well, you really should simply separate the opinion of the non-auditor, and that should be part of an understood non-audited part of financial presentation. We are hoping that groups like this are going to give us a better sense of how to slice the onion and how to deal with this problem of what the auditor supervises in these areas where the auditor is not expert.
Okay. Try to do these quickly. Damon?
Actually, Grant, we can, this is such a highly topical subject matter that if you want to go 15 minutes over, we can take 15 minutes out of the open discussion at the end. Because I think if there are questions that people want to ask, your issue has traction with respect to everybody here, and quite frankly, internationally as well.
Just don't want to be blamed for getting, getting in the way. It's not as bad as getting in the way of the cocktail hour, but getting in the way of lunch might be bad.
I'll put the gavel down with respect to lunch, but if you want to go 15 minutes over, I know that I got a question that I want to ask, and if it's toward at the very end, that's fine.
Okay, Damon. Still try to move quickly, but
I get the point. For those of us who've been around this subject and were present during the debates over Sarbanes-Oxley, this has a peculiar feel. This conversation has a peculiar feel to it. I don't know whether it's true that in order to do a complex audit of a global firm, you need to have all the subject matter expertise inside your firm. I would suggest that is in general not the direction in which large organizations of all kinds have moved in the last 20 or 25 years. Certainly it's not the way we run our federal government. We don't have all the expertise that our government needs to do highly sensitive things inside the government. Some people think that's a bad idea, but it's a fact, we don't. So I don't know if that's true, but it seems to me if you're making that argument, you've got a heavy burden in the context of the way things actually function in this world today. I also think that we around this table are at a disadvantage in this conversation that arises out of what was discussed earlier this morning, which is that we don't really know anything about the internal finances of the firms we're discussing and how the audit function and the consulting function interact. The PCAOB may know, and the inspections may get, Steve's shaking his head, I guess maybe you don't know either. But we certainly don't know. Those of us around this table, at least certainly those of us who've not been partners of Big Four audit firms. But I think there is something we do know, and that is that there is a fundamental contradiction between what we ask audit firms to do when they audit public companies, and what audit firms are asked, and what those same firms are being asked by those companies to do when they hire them as consultants. The purpose of an audit is to answer
the question of whether is to answer without regard to what is in the company's interest, the question of whether or not the financials are accurately stated. You don't answer that question with the qualification of maybe I shouldn't answer it accurately if maybe that would not be in the firm's interest to answer. On the other hand, when you're hired as a consultant, you are hired to act in the interest of your client. Now, I don't see how those two things really coexist in a manner that benefits the public within one firm. I don't see how you do it. And I think that the subtext of this meeting is a very troubling one, which is that if it's true that the economic model of the big four audit firms requires that coexistence, then that economic model cannot get the job done that we are here to help the PCAOB get done. And that is a big, deep problem if that's true. And I think Lynn was kind of alluding to it earlier in his part of the presentation, putting some rather sacred cow-killing responses to that problem. I'm less convinced of what the solution is than I am sort of impressed by the depth of the problem that is being identified here in a somewhat indirect way.
Lynn? Someone made the comment, I think it was Norman, about you need the expertise to do these audits, and I couldn't agree more with that. You do need to know what you're doing in some of these areas. Unfortunately, with the junior level staff doing some of this stuff, seeing them work on derivatives and all just kind of makes you cringe at times. So I have no problem bringing the expertise in, but there are good consulting firms. There are people, some of the top expertise in many of these areas don't reside in the Big Four. And when I sat on the board of Sun Microsystems and we decided to go to another party, we found mistakes in our financial statements that our auditor, with all their expertise, especially in the tax area, didn't find. And so going to someone else, sometimes you can, and quite often, you can find expertise in valuation. The best people are not necessarily inside the Big Four. So this notion that you've got to go to a Big Four firm for this expertise is ridiculous. And in our case, we actually found that the expertise was better with another firm and cheaper even. So it is amazing. You don't have to have it. The firm could go hire people if they need to go get that expertise and bring that expertise in. And we look at audits like J.P. Morgan a year or so ago where they totally missed on their derivative trading over in London. If they had all this expertise, where was it and why weren't the risk management and lack of controls over there identified? They had all the expertise, but it didn't happen. And so I have no problem if someone wants to turn around and to deal with Damon's issue, give the auditor the right to hire someone from the outside, bring them in, and then there's the issue that Jim appropriately teed up, the supervision of those type of people. One of the problems we're finding is when the expert comes in on a case from the firm, they aren't necessarily supervised that much. It's kind of like, come on in and tell us what the answer is, and we'll go on down the road, auditing, and because you're within our firm, we don't need to supervise you. And there's problems with that. So this notion you got to go to one of the Big Four for this expertise is such a misnomer and so misleading.
Tony?
Thank you. I also wanted to comment on what Chairman Doty had said about the evaluation of subject matter experts. I served in 2008 on the expert advisory panel on the measurement of the fair value of illiquid securities. And, it was very clear there, the people who knew what the value of an illiquid security was, were the traders and the people who were, working on the floor there, and their ability to have a conversation with the auditor it's like an alien talking to somebody on Earth. And I don't mean offense to anybody. It's just that they don't talk the same language. The same thing happened with the measurement of whether we have enough capital during that crisis in 2008. Deferred compensation of some of the management being part of the equity. The auditors have an expertise in equity. They have an expertise in deferred compensation. But they hadn't been asked about the risk aspects of it the same way. At the EITF in the last year, and I will be very, very clear, the caveat is that I don't have enough observation yet, but one of the things I'm finding, for example, we spent 2 meetings discussing an issue. We put up a draft abstract. We got 74 comment letters asking whether we knew what we were talking about, and as a result, the third meeting, we completely changed the way we were looking at the subject, the topic. It was no longer a tax issue. It was an investment or a fair value issue. So I think that there are people in audit firms whose expertise is extraordinarily at odds with some of the information we need to have a good audit. And so I come back to what Chairman Doty said. Whether they monitor them, whether they evaluate the subject matter experts, the point is it's not clear that they have that ability to do it.
Kurt, excuse me.
Maybe to potentially repeat a little bit of my prior remarks, but I think whether or not there's a causal issue here is important to understand. Does consulting creep cause audit quality deficiency? If it doesn't, and we can't prove that, a lot of this isn't really what we're focused on. I think over the last 10 years, a lot of good work has been done by this organization as well as by the audit firms in terms of being focused on improving audit quality. We need to know whether or not that's working, and we need to know whether or not consulting creep actually causes a problem on audit quality.
Joe?
A lot of good comments from everybody. I think, Chairman Doty and board members, I think this is a pretty complicated issue, as you've heard from the comments. One thing that's not clear to me as I've listened to people is if we're differentiating between the type of non-audit service, and I think you need to think about that carefully. So there's non-audit services provided to audit clients. I think there's a mistaken belief that audit clients no longer have non-audit services as a result of Sarbanes-Oxley Act. Based on some of the work I've done, that's very inaccurate. So as you know, Section 201 of SOX bans many types of non-audit services. But there's a lot of types of non-audit services that aren't banned. And so the issue is whether the preamble in the SEC rule that implements Section 201 is really being followed in terms of the spirit of the law, not just the letter of the law. And we could have an interesting conversation around that. But that potentially has a direct effect on independence because that work is being provided to the audit client. Okay? So that's one piece. There's a second piece, and the second piece is consulting work that's provided to non-audit clients, not to the audit client. So the concern there is that over time, I think we used this morning at some point, maybe 70% of the firm's billings is consulting work. You have a consulting firm that does a little bit of audit. So the concern there is around the culture of the firm. And as the culture of the firm changed in such a way that audit work is damaged, not for any one particular client, but across the board. And this is really what Kurt just said. Is there evidence that that's happening? I don't have any evidence one way or the other. One thing I do think you have, based on what Greg Jonas is working on, as I understand it, one of the AQIs that they're talking about are firm surveys. Now, Greg and I have a little debate back and forth as to whether the right group to survey is people who currently work for the firm or people who have recently left, but we'll leave that aside. But certainly I think you can get a sense of the culture inside organizations via these surveys, and that's very important to you. A couple of other things. one thing that does trouble me, I've talked to the firms about this, but the behavior doesn't seem to stop, is firm advertisements. Okay, now you might say, well, why should we worry about firm advertisements? If I'm willing to put something out for public consumption that says I'm sleeping in the same bed as you publicly, meaning my best, what's good for you, client, is good for me, firm, what am I willing to do privately? And just within the last week, I've seen an ad from a major firm in the Globe and Mail. I've seen an ad for a registered firm, but not a major firm, in an airline magazine with this type of language, which is, to me, a bit disconcerting. Around the issue of outside vendors, whether the approach is to use outside vendors rather than to have the expertise in-house. And I don't think there's any question, as Pete and others have said, you can't do an effective audit today without skill sets and valuation systems. Data analytics is increasingly important. And I would caution those who just argue we'll just use outside vendors. We see this with comp consultants. The outside vendor likely either is working for the company or wants to work for the company. To think that these people are going to be lily white, I think, is a bit naive.
Brian?
Thanks very much. And I should start by just saying that the standard disclaimer applies to me as well. Joe actually just made, I think, most of the point I wanted to make relative to the growth of non-audit services and consulting, and I think it is important to understand how much of that is being sold to audit clients versus non-audit clients. While our issuer fee disclosures may be imperfect, I think they do provide a good amount of data, and I know that we look at that closely over time. Audit Analytics aggregates that, and as we look at it, it has stayed at relatively flat rates over the last few years. Since 2005, I think the average rate is about 25 to 30% relative to audit fees for non-audit services. Now, that doesn't mean we shouldn't focus on what's in that 25 to 30% and also keep an eye on whether it's growing. But I think bifurcating the concerns into how much of this relates to the strategy of firms, where they're headed more globally versus how much of this relates to selling non-audit services to audit clients, I think is an important distinction. Because if we're going to start talking about whitelists or caps or those types of things, I think understanding that data in enough detail on the types of issues that we have relative to the types of services is very important. Thank you.
Okay, two more. Marty, you've had your... Lynn never took his down, I don't think. So. Which I'm not sure what that says, but we want to get Lou in.
Thanks. I just wanted to address a couple of the comments made about specialized skill, which were really important comments. But first of all, the risk assessment standards that the PCAOB issued in 2010 require firms to assess as part of the risk assessment in an audit when that audit requires specialized skill and knowledge. So as part of the risk assessment, looking at that audit client's business to know when you need special valuation skills, appraisal skills in an oil firm, Exxon, energy, engineering skills, et cetera, as well as IT skills in complex data security environments. So the auditor has to do that. We've seen execution problems in that through inspections, where they don't always recognize where they need those skills, but the requirement is there. And then separately, there is a standard certainly for the use of specialists. And the auditor, if he has a specialist in the firm, the auditor is supposed to supervise that specialist sufficiently so that he understands that the work supports the conclusions reached. Once again, or if they have an engaged specialist, they can go out and get a third party. They still have to review that work, although that standard is weaker and we think needs to be improved. This is another area, though, of auditor performance issues. We think there are standards there, and inspection shows a lot of cases where I think the point that was made, essentially accepting the work of what the specialist does and just putting it in the files has been too much of a problem. And so these are areas where we're addressing. In case of valuation, as Jim mentioned, we have a staff consultation paper out on auditing accounting estimates, and that's basically what financial statements are, and fair value measurements. and we're looking for comment as to how auditor performance could improve in that area. And the subject of specialized skills certainly came up at our special SAG meeting that we had just a couple of weeks ago. And we're also planning a staff consultation paper to go out sometime near the end of this year, early next year, on the use of specialists and how firms can do a better job in terms of what the audit performance procedures should be regarding overseeing specialists and making sure their work is both qualified and properly reviewed. Lastly, the engagement partner on a job is supposed to have the sufficient knowledge of that industry that he or she's in so that they can understand what a specialist has done. So all of these things are being addressed, but clearly there are auditor performance issues in these most complex of areas, which tend to be where there are serious problems and risks to the statements. So I wanted to share a little bit of that. And Steve, can I just take 1 second more on just a lot of things came up in this report about in this meeting about auditor reporting and transparency. Just to say where we are.
Why don't we wait until the last hour, because in terms of we'll have the open discussion, because I do want to get Ann Yerger and Lou in on this as well.
Okay.
So we'll give you the last hour, and you can recap on that.
Lou?
We've got a whole hour. Thank you. You know, when I look at the question of non-audit services, and if you assume that auditors are rational economic creatures, it seems to me one of the things we have to look at is what are the contribution margins of these businesses? How profitable are they relative to the audit business? And it seems to me you have to look at that two ways. One, contribution margin to the firm as a whole. Look at the group together. Are they contributing at the same rate? And secondly, what's the contribution margin per partner? And what we were told, at least last week in Toronto, by the global leadership of these firms, that in the last couple of years, actually the consulting practice has been less profitable than the audit practice. And nobody quite knows why that is, whether there's more competition than there is in audit, but it is actually less profitable. The other thing is that 3 of the 4 big firms in doing consulting do not do either implementation work or systems integration work, which is the kind of work that is enormously highly leveraged and leads to very high profits per partner. That was essentially the business of Andersen Consulting, and that drove Andersen Consulting apart. But 3 of the 4 big firms, Deloitte is the exception. It does do, and it never got rid of its practice, it does do this kind of work. But if that's the case, most of the businesses that these firms are in appear to me to be less leveraged and less leverageable than the audit business. So things like valuation businesses, actuarial business, the IT stuff is, particularly if it's writing software and things like that, it's less leverageable, which may be part of the reason that it's less profitable. But I think you can't really understand this stuff economically unless we really understand where the dollars go and where the dollars are being driven.
Ann?
Very briefly, Damon, like you, I sort of have gone through the wars since Enron, and just the large numbers, the trends that you pointed out, Brandon, are obviously, I think they're troubling. The question is, are they serious? And it strikes me that there's 2 things that need to happen, and it all involves data. First of all, it strikes me that the Commission needs to be, I think, as you said you are, evaluating the numbers that are disclosed, but then I think also doing a really deep dive about whether those items that are currently excluded from being provided to audit clients are still appropriate today. And I don't know the answer to that, but it strikes me it's worth looking at given these larger numbers. And then for the board, just going back again to the 2008 ACAP report, there was a strong belief that in terms of just the transparency issue, Marty, which I suspect you'll talk about later, that at the very least, the PCAOB should be getting detailed financial information from the firms so that you can understand what's happening and what's driving business decisions and what might be setting the tone at the top. And I don't believe the board is, at this point, getting that kind of information, but it strikes me it's extraordinarily important, and rather having sort of anecdotal evidence about what's going on would give you really substantive information that could help with regulation.
Without commenting specifically on what we're getting and not getting, this forum and the other public meetings we've held, I think, confirm that we are keenly interested in getting within the economic structure of the firm and understanding what's below the skin and how it's working. It's a subject that occupies us.
Steve, do you want to have the last word? Or we didn't get to auditor transparency and who pays for the audit, although a lot of the who pays for the audit has been woven into a lot of the other comments. We could open those up as part of the open discussion if you'd like later. Would that be what do you think is the best way to proceed?
I'll raise my issue later. Why don't we see if there are any questions on the last item, and if not, then I'll raise my question.
Okay.
But Jim.
First of all, I have disclaimer as Brian said as well, but clearly, based on my own experience, I think the fundamental question here is what issue do you think you're trying to solve in terms of where is the problem? Is the problem the mere size of the consulting practice in relation to the audit practice, and the fact that the DNA of a consulting practice is markedly different than the DNA of an audit practice. They don't really have professional standards. They're not subject to inspection. They're not subject to enforcement. They don't typically have the liability issues that an auditor faces. As opposed to, is there a conflict or an independence issue at a particular client because they're providing non-audit services? Those, to me, are two different things, and the solutions or the recommended solutions to those are very, very different.
Well, since nobody else has their 10 card up, let me just ask a final question. That is, Brandon, you and a number of others have talked about what they use the term cross-subsidization between different business lines. And you brought that up in the context of why should policy changes be considered. I'm interested in terms of what cross-subsidizations between business lines you're most concerned about. And then, Damon, you referenced conflicts of interest. Norman, you talked about it being part of an integrated business. Mercer, you raised the issue as well. So very briefly, if we could finalize this section by talking about whether it be the cross-subsidizations, the tie-ins, the marketing advantages, or others, that would be helpful.
Sure. I think cross-subsidization is just a large category to capture a lot of what's already been discussed here, which is subject matter expertise, whether or not you're providing a net deliverable to the client that on an all-in basis is more useful for that client. Of course, it's sold as being beneficial and more efficient. Damon made the point about outsourcing and the fact that you don't have to have it within the same enterprise. The question is, can you build walls to maintain the integrity of the audit process sufficiently while still getting the benefit of the integration of the services? And I do think that the discussion nicely highlighted that those walls can be just as important even if you're outsourcing. That outsourcing, the corporate form isn't going to determine for you the possibility of the overreach, because whether or not you go to XYZ consulting firm outside of the audit firm itself, they're still going to be wanting to sell their products, sell their services. So I think that set of cross-selling efforts are always going to be with us, and you got to look for walls to maintain them.
Anybody else have any comments?
Okay, well, I guess that is a wrap for this morning. I mean, I hope that the board and the staff got some valuable inputs here. You know, one takeaway that I have is there's definitely a need for data, and whether it's something that the board can collect by itself, whether it's the board and the commission working in tandem. I think Ann's comments were spot on, that, you know, you see this thing and you say, are we going back where we were, and are we going back to problematic areas? And without those specific data points, I think it's difficult to make those conclusions. And there are intelligent, I mean, what Kurt said, you know, you can't just jump to conclusions without the proper reason. So I think to the degree that you can gather this information and make it available, so you can make, you know, good judgment decisions as to, is there a problem, and then if there is, how do you address it, because they're all tough ones. So hopefully that this will lead to some of those conversations.
Do you want to have the final word?
Yeah, if I could just jump in for 1 second, just in terms of study, whether this is something, Joe, you and your group might want to look at, or Steve and your group, the idea of a company losing its chief financial or chief accounting officer and then hiring the audit partner on that has been something that I've looked at for years in the investment business, something that's always sort of raised concern anytime I see a CFO change, but more significantly whenever that company that is experiencing the CFO change then turns and hires their audit partner. And it might be useful to see what the post-hiring performance of that company is, both in the public markets and obviously from the standpoint of their reported earnings. And I would be more than happy to give a few examples to whomever might like to look at that study from situations I've been involved in to sort of kick that off. Just a thought.
Well, we'd welcome that. And Grant, I want to thank you on behalf of the board for a really excellent discussion on this topic. I think you brought a lot of fundamental issues to the board's attention, to the commission's attention, and I think you've done an outstanding job. So with that, why don't we take an hour for lunch and be back here at 1:05. All right, Ann, we'll turn to you now, and you and Joe, and on the topic of how to improve the audit quality and the relevancy of the audit. I appreciate the work you've done, the slides that everybody has. So why don't you go ahead and start.
Joe is going to set the stage for us, and then we have divided our responsibilities between 6 of the subcommittee members. And who has the clicker?
I do. I don't know how I got it.
Okay, so our subgroup focused on possible recommendations that we think have the potential to meaningfully improve audit quality. And so we had a number of iterations from the members of our group in terms of ideas that might move the needle in a substantive way. And we ended up with the 6 recommendations that we presented briefly this morning, which we'll expand on here over the next 45 minutes or so. And as Ann said, we're breaking these up by person. And so the first one was supposed to have been thrown to someone not in the room. Ann, do you want to handle it, or you want me to handle it? Come back to it? Okay. So we'll let Ann take on the second one.
Right. Audit partner's signature or name. I know the topic of the signature that was already sort of briefly touched on this morning, and in a way I don't want to unnecessarily belabor the point, but I do want to emphasize that our subcommittee strongly supports the PCAOB rule mandating the engagement partner's signature or name on the auditor's report. This is not a new issue for the PCAOB, which has already proposed the change and recently announced it will be reproposing the change, I believe. This is not a new issue for this committee, which has long and consistently supported this change. Nor is this a new issue around the globe. As we saw earlier this morning, the EU, Australia, Taiwan, and China require this transparency, and at this point, frankly, the U.S. is looking like a global laggard. This is also really not a new issue in the professional context. As we know, under SOX, the CEO and CFO must certify that published financial statements are a fair representation of a company's financial condition, and that the financial process doesn't include any deficiencies or material weaknesses. And signatures are also standard in other professional contexts. Lawyers sign court documents, doctors sign prescriptions. My own personal view is that nothing sharpens the mind like a signature or a name on a document. I believe requiring this transparency would result in greater accountability. I believe it will result in greater due diligence and improved audit quality. And in turn, I believe this would strengthen confidence in financial statements. I do not believe that such a requirement would impose on signing partners any greater duties or obligations or liability than what is currently imposed on them as members of an auditing firm. I also do not believe that the consent issue should be an impediment to this reform. Indeed, I see it as a bit as a red herring, and I believe the board and others could readily find solutions for these very limited situations, and I think Pete and Joe earlier presented a really creative approach for handling this. In closing, I think I view this reform as low-hanging fruit, and I would urge the board to move forward.
Our next recommendation relates to fees, and we are recommending that the board implement a rebuttable presumption that would be communicated publicly that abnormally low audit fees will result in an inspection. There's a large body of literature that finds that audit quality is inversely correlated with audit hours, and prior research finds strong evidence that fees and hours are related. Higher fees lead to more audit work. There's no evidence of rent seeking on the part of the auditor. If issuers know that abnormally low fees will result in their auditor and engagement being inspected, there's every reason to expect that such lowballing behavior will be mitigated, and a reduction in lowballing behavior will increase audit quality in the short run, and arguably a more profitable profession will attract better entrants, improving audit quality in the long run. Just anecdotal before we go to the next slide. We talked a lot this morning about ACAP, and Lynn and Damon and Ann, am I leaving anybody out, were on that group. And I had the privilege of testifying before that group. Probably Lynn and Damon and Ann forgot my testimony, but one of the things I did is I took what the starting salaries were in the public accounting profession when I started in the mid-'80s and what the starting salaries were in law and investment banking. And then I basically incremented them to what the salaries were at the time I testified, which I guess was back in 2006 or thereabouts. And although you would expect, and it was the case, obviously accounting salaries was the lowest of the three in both time periods, the gap between accounting and the other two fields had grown at an increasing rate. And when I worked, you got paid overtime. So you now have a profession where both in terms of the absolute salary as well as the per hour salary is less attractive today than it was 30 years ago. And as you think about the expanding demands that we talked about this morning on valuation, business analytics, so forth, I just think in the long run you're not going to have a healthy profession if fees are constantly being driven down. So let's see if there's any issue to be concerned about. We'll go to the next slide. And this morning I told you that we would provide some data for you. So what we've done is we've looked at auditor switches and audit fee changes from 2010 to 2013 using audit analytics data. Now, one thing I need to make very clear, the firms 1 through 3, firms 4 through 6, firms 5 and 6 you could probably guess, but firms 1 through 3 and firm 4 are not necessarily listed in order of size. So it's not necessarily that 1 is the biggest and 2 is the second and 4 is the smallest. That's not, it's just firms 1 through 4 are big 4 firms. I'm not saying which big 4 firms they are. Okay? Is that clear to everybody? All right. So with that said, when there's a movement from 3 of the big 4 to a 4th of the big 4 or firms 5 or 6, a movement in that direction, fees go down 14%. When there's a movement in the other direction, fees go up 6.5%. It's a 21% swing. That's a big enough swing to affect behavior. You can look at some of the other swings if you just say, well, you can't really compare the big 4 to firms 5 and 6, so let's just look at firms 1 through 3 to firm 4. If there's a movement in that direction, fees go down 7%. If there's a movement in the other direction, fees go up 6.4%. Again, that's a 14% swing. Guys, these are big enough swings that this is going to affect behavior. And so I hope that you guys are monitoring this kind of thing. And I think in general, there's clearly an issue with audit fees. It's been an issue for as long as I can remember. I remember when I was on the SAG, I used to poke at the, I guess now going back of 2 or 3 chief accountants. To some extent, this is an issue the SEC has to deal with, but to the extent that the PCAOB was to signal that they would publicly inspect if that fees were abnormally low, I do think it would likely change behavior in a positive manner. Okay, the next recommendation is over to Tony.
Thank you, Joe. Here we're talking about how to improve audit quality and the relevance of the audit itself. And you'll recall that there was a comment earlier about a discussion where the partner of one of the accounting firms, the audit firm, was arguing that they have no public interest, and then there was a comment from someone about another accounting firm in Florida saying 3 times that they didn't have any public interest. So one suggestion, the recommendation we have here is that the appointment of independent directors would serve that public interest because we expect that the independent directors would be advocates for that public interest. And we also expect them to be disciplining mechanisms. But obviously, in order to do that, they have to be independent. Obviously, we know that in the corporate community, the better the corporate governance, the more the improvement that you can see. Greater diversity of thought in these types of bodies always helps. So that's another sort of reason why we expect it to improve. There is evidence from elsewhere that independent non-executive members of governing bodies do help, and they've been required in the UK for many years, and many in the UK are quite positive as to the impact of those independent non-executives on those boards. And both the FRC and the ICAEW have said that. And then finally, the ACAP, as usual. Maybe what we could have done is just simply said every single thing in here has already been done by the ACAP, and it would have been. But in any case, I do want to mention that. So that's that was the recommendation that I was asked to talk about.
And the last 2 recommendations, we're going to let Larry show over back cleanup.
I am happy. I got the 2 best slides in the whole thing here. When we were preparing for this, they both received a lot of support from just about everybody, and they are near and dear to my heart. You need to know that I'm a portfolio manager, and I manage money for somebody that's got $1,000 in an IRA to a pension fund and everywhere in between. At the end of the day, it's somebody else's money. It's not mine. So if we can do something to help with, especially the relevancy of the audit, I'm all for it. The first one is heightening the auditor going concern reporting. Audit quality is better if investors are provided with an early warning of impending firm failure. I know it's overstating the obvious, but it's important to keep that in mind. Investors are particularly concerned with fraud and bankruptcy given the large losses typically triggered. The need for improvement. Very few financial institutions received going concern reports before the financial crisis, and I don't think we have stats on that, but it was very, very few. And any reduction in auditor going concern reporting would clearly reduce the information set received by investors. Some have expressed concerns of impact of new FASB standard on related auditing standards. And the next slide, really important of the relevancy of the audit, allowing shareholder proposals on auditor issues. And we all do recognize that this is an SEC issue, not a PCAOB issue. But nevertheless, substantial enthusiastic support for this recommendation among all the subcommittees when we were preparing for this PowerPoint. Audit quality would improve by more closely aligning the auditor's incentives with those of users of the audit services. and we expect more informative audit reports produced by higher quality auditors, fairly compensated. And in many ways, this one recommendation, particularly if mutual funds were required to attend to, addresses a number of the other issues in our presentation. This enables private ordering rather than one-size-fits-all regulations, which has the benefit of greater tailoring to individual issuer auditor circumstances, and obviously it's important that it provides investor feedback to the regulators.
Damon's not back, Ann, so maybe let's go back to...
All right, our first but final recommendation is urging an expanded audit report. I could almost repeat all the comments I made about the signature. This is not a new issue for the board, which has been considering the issue. It's actually not a new issue for this committee. We have discussed it and I think supported it quite robustly, and it's not a new issue globally. As we've discussed, expanded reports are in place in other countries, and as we've learned, I think the Rolls-Royce example is a terrific one. It seems to be working in a really significant way. So, the issue of the quality of the auditor's report really has been debated for decades, and I think there is value from an investor standpoint in the current very blunt pass-fail model that's in the report. It's concise, it's clear, it's comparable. But I think it is clear today that the current auditor's report is just not satisfying the needs and interests of investors who really are the final and the ultimate customer of these products. As we surveyed the members, investors 2.5 years ago, 2 years ago, 3 years ago on this issue, there was strong support for enhanced auditor's report from the investor community. The CFA Institute has similarly surveyed its members and found the same thing. So this is a space where I think the investor's viewpoint is pretty consistent and clear that they would like to know more from the auditors. We do believe there's going to be an enhancement in audit quality if the auditor's report would be expanded, but I think there are also some other real benefits for investors from an expanded report. First of all, I view auditors as independent experts who have knowledge about the company that most of us investors can't get at. I think there'd be real value in gaining from some of their knowledge and expertise, and it would help investors analyze and price risks and make investment decisions. I think an expanded report would really heighten the perceived value of the audit firm work, something that Lynn discussed earlier, and I think it might give firms some leverage to affect change and enhance management's disclosures and practices. And I finally think that this expanded reporting would enhance the transparency and promote real confidence in audited financials. In terms of cost, Steve, you brought this up earlier. I think a lot of the things that we would like to see in that expanded report, sort of what was in the Rolls-Royce report, is probably already being communicated to the audit committees. So I don't know that I see this as a really expensive undertaking in terms of disclosing to the public. And I'll also note, I know there's a lot of debate about who should this expanded information be coming from. Should it come from the audit committee? Should it come from the outside auditor? And my view is there's real value in getting the insights from the outside auditor, the independent expert that's been retained by the firm. I believe there could be better disclosure as well from the audit committee, but I don't think that the audit committee should solely be responsible for this. And Damon, I'm sorry, I covered for you. Do you have anything you'd like to add?
No, I don't think so.
So those are our recommendations. Was broadly supported by our group, and we wanted to leave plenty of time to have a robust discussion around those issues.
The 10 cards as they go up, or shall I? Ann, why don't you?
Jeanette, would you like to start?
Sure, thank you. I have a question, and this is related to transparency and the new idea or recommendation that you brought to us today about evergreen consents. And I know this is not a PCAOB issue, but I would be curious to hear how you envision that would work in practice.
Pete, since I believe you were the
bells around my neck.
The brains behind that. Could you help?
Yeah, and this will be me practicing law as not a lawyer, but particularly SEC law. But the thought is that whenever a report the firm first goes into an SEC filing. So the consent has to be provided by the firm. If we move to the audit partner is now signing, and therefore the audit partner also has to consent, that so long as the firm is willing to continue to provide its consent in future years, even when that partner may no longer be with the firm, that unless there's been a change to the financial statements that were filed, some sort of restatement or other issue, that consent on the part of the individual partner would be evergreen. So not the firm's consent. The firm would still have to provide its own consent, but unless there was a change, and if there was a change in the financials, they had to be restated. Presumably, another audit partner is going to have to sign off on those financial statements. So then, if there's been a change, that new partner would then be required to provide their name and provide a consent.
Norm?
Thank you, Ann. I'll be very brief. I was a member of the working group for last year's meeting that addressed this topic. But the line in your presentation that requiring an expanded audit report would help investors better evaluate and price risk, it jumped off the page at me because I think I said last year as well that what intrigues me about this topic is I think it is, and especially in this body, the Investor Advisory Group, whose mandate is to advise the boards on issues of interest or concern to investors. And this is one of the issues I think that we deal with in this body that provides a perfect illustration of where the rubber meets the road and where a change in policy, a change in disclosure requirements would have a material day-to-day impact on the quality of work that investors do in assessing investment opportunities. Because the entire process of evaluating investment opportunities and deciding among them and making risk-adjusted bets on the future movements of securities is all about projections and projecting future performance of a company and security or its capacity to generate free cash flows and discounting those back at an appropriate discount rate and all of the processes that we're well familiar with. And that entire process requires information to assess risk and price it or build it into valuation models appropriately. And some of the issues that an expanded auditor's report could and ideally would touch upon, including, I think, as the group points out here, circumstances in which there was more than one option with respect to an accounting convention to apply, and an issuer chooses the more aggressive or more perhaps less appropriate of the two, is something that bears directly on an investor's confidence in the quality of the reported earnings, and that in turn feeds into an assessment of risk with respect to projections of how that company will perform in the future. So it's such an important topic. As we've talked about in prior meetings of this group, I think one of the risks you'll confront, or one of the challenges you'll confront, is ensuring that the requirements are written in such a way that they require actual discussion and qualitative assessment of the issuer's accounting conventions and processes. I think, Joe, the examples you provided in your handout this morning are perfect illustrations of the materiality threshold. How is it selected? Those are all inputs. They're not check-the-box type of inquiries. It's not a list of things that are yes or a no. It's actual qualitative, judgment-based reporting or expressions of views about the manner in which an issuer accounts for and reports its performance, that I think is directly essential to the work, the nuts and bolts that institutional and private investors do every day.
Thank you, Norm. I think, Michael, you might have been next.
And my comment is more of an observation or maybe some clarification and or why you didn't go a little bit further. And I might be misinterpreting it, but when you talk about enhanced audit firm governance by requiring independent directors of firm governing and advising bodies, is this of the public accounting firms advisory and oversight, or is this the boards of the companies that are being audited? I wasn't quite sure I was interpreting which body this is referring to, and wanted that clarification first, because I may embarrass myself if I go down a path and I interpret it incorrectly.
Of the accounting firms, Mike.
Okay. Then never mind.
Barbara? So, first of all, I want to thank this working group for actually coming to the committee with recommendations as opposed to questions, which we've had a tend to see. You know, the fact that your report includes specific, concrete recommendations, and I think very thoughtful recommendations, is impressive. And I strongly support those recommendations. And so, for what it's worth, you know, I know we don't in this body tend to take formal action on the issues that we discuss, but if we were to take formal action on these recommendations, I, for one, would vote for them. As I look at these recommendations, you know, I think it was at least 2 years ago, maybe longer, that during a discussion, I think at the SAG, we were talking about the auditor's signature. And I think I said, sign it, don't sign it, just don't ever make me talk about it again, because we had devoted so many hours to the issue of whether the auditor should sign the audit report. And, you know, I think actually this morning you presented some interesting data that suggests that it has more of an impact than I, you know, maybe acknowledged in making that statement, that investors are able to glean information from that. And I would say this has been on the agenda for such a long time. And if the board can't do this, then it's really hard to look at the rest of these recommendations and see how we're going to make progress on the issues that actually move the ball. You know, if you can't make a decision that there's going to be a signature, you know, I mean, I don't know. I just don't understand how this one is that hard. So do it or don't do it, but never make me talk about it again.
Well, who would like to follow that, Bob?
Yeah, do it. I was a member of this group, and I highly support all the recommendations except one. I want to qualify my support for the rebuttal presumption on low audit fees. My fear is, well, it sounds like price fixing, but my larger fear is that it's going to suppress innovation. I feel like I'm a knowledgeable purchaser of audit services, and if a firm came before an audit committee I serve, something with more like a cylinder business model than a pyramid business model, or something more like a daily auditing technology that can be implemented effectively, and that lowers the cost of the audit, I could very well go for it. So I have a little fear about the pricing recommendation suppressing innovation.
Do you want to reply, Jeff?
Yeah, you know, Bob's point is a good one. And just so the board knows, on at least some of these recommendations, I actually vetted these with very, very senior people in some of the major firms. And one of the people I talked to about this, Bob, raised exactly the concern you did, in that they believe that through technology, they'll be able to perform better audits at cheaper prices. And so although they appreciated the thought behind this recommendation and the concern of abnormally low fees on audit quality, they were concerned that a world where technology allowed you to do better audits at a cheaper price could actually be viewed as a negative. So when we started this, we had implement a presumption. The reason the word rebuttable is in there is exactly the reason, is in response to what you just said. So again, it still may be something you're uncomfortable with, but we did think about that. We wanted the flexibility to reflect the fact that technology may cause the market to evolve.
Bob, any further questions? Okay. Lou?
Yeah, I have a question about your very interesting suggestion about the rebuttable presumption here. It seems to me it's relatively easy to do that and see that when there's a change of auditors and you can see a percentage change. But absent rotation, that's an exceptional circumstance, at least in the United States. So what would the criteria be for looking at a company that's not changing auditors? For example, would you suggest that we look at all the companies in a particular industry and compare them? And what criteria would we use? I mean, how would we do this absent a change of auditors?
Yeah. Again, Lou, great question. When we started, we just had a decline in fees. And as I met with leadership of the firms, one of the things they said is one of the things they see in practice is that there are certain clients that every year say the fee is going to go down 5%. So it wouldn't trigger what we had initially. But after 3 or 4 or 5 or 6 years, it's a problem. So that's what led to the more, some would say wordy, which is probably fair, actual recommendation. And what you would have to do, Lou, and we just threw this out as a placeholder. I mean, you'd have to think about it in a lot of depth. But what you would have to do is certainly industry adjust. There's no question you'd have to industry adjust. And you'd have to size adjust. Because by far the biggest predictor of audit fees, I mean, the R-square is around 60%, is size. So you'd have to industry and size adjust. And then I don't know what the right threshold is. I don't know if it's the bottom decile or, bottom 5%. At some point it's in the eye of the beholder. But that's the general tenor of what we're suggesting.
Lou, any follow-ups? Okay. Curtis.
So I was interested in the governance recommendation and curious what the team thought about first power. So if I'm the director on a advisory group that has no power, will it mean anything? And then what power is important? I mean, what do they have to be able to do? They have to be confirm kind of who's the leadership of the respective firms. And then second, how did you think about independence? So to find people that are truly capable and that probably are fully independent of any relationship with the 4 firms might be tough. And so would you take exception to independence in that case, and if so, how?
Let me try to respond to that. Again, because I've had a number of conversations around this recommendation, both with leadership people in the firms and people at EY's group and people at Deloitte's group. So, one of the things I've asked people at these 2 advisory groups, Kurt, is, how do you know that this is real and this is not just a sham? And, they gave a reasonable answer. The advisory groups are still relatively young. And so it's hard to know, how they will play out long term. What I do know is that the leadership of these organizations show up, to the point of, the CEO and in this case it's a man, his deputies show up. There tends to be very robust discussions around the types of issues that we talk about. The sense that I get is that the firms legitimately do want this feedback. Now, at the end of the day, if the advisory group said, we think you should put a hard cap on non-audit services at 50%, would the firm follow that? I can't answer that question. That hasn't happened yet. So, I don't think this is a panacea, but it does seem to be playing a useful role, and the fact that at least 2 of the firms have done it voluntarily, I think, is encouraging. So maybe there doesn't need to be PCAOB action. Maybe it's just the bully pulpit. Jim could give speeches if he thought it was appropriate, because 2 of the 4 are already doing it. In terms of independence, that's a really good question. And probably Brian's the best person to answer that question, would be my guess. I don't know. I'm trying to think. The Deloitte group is Gelser, Ronnie Hainish, Phil Wiedemeyer, Zovana Pomrose, and then there's a 5th person who I don't know. and the Ernst group is Olson's chairing it, and then there's a number of very high-level people, but a lot of them are global. And I don't know the others. So I don't know if they're precluded from being on the board or audit committee of any client that Deloitte or Ernst would have, and how they're navigating that, because it's obviously a major issue. I'm putting you on the spot here, Brian. Do you have any insights on this?
I won't give a specific answer relative to any particular firm, but certainly it's an issue that would need to be thought about, and their role would be important in thinking about it and the role that they have relative to specific audits, whether they're in the chain of command. So there'd be a variety of questions to think about, but I don't want to opine on any particular fact pattern.
My sense is that it's at least doable the way these two firms are doing it. They've figured out a way to make it work. But the specific, my guess is you'd have just as easy an access as I would in terms of figuring out how they're navigating that.
If I can just add to that, I think you raised a really good point, and if I recall, I'm kind of looking at Damon and Lynn, because this is yet another one of the ACAP recommendations. There's a lot of discussion about this particular point, and I think the preference, at least within the subcommittee that it considered this, was that it would be non-voting members. They would be voting members on the board. But there were issues with the legal structure that might have precluded that, and I think we saw the advisory board as sort of an interim step. But there was also a belief that you don't have to have a majority of independent people on the board to really make a difference. So that in itself, even if it were one or two independent directors, that could make a big difference in terms of tone at the top and how the organization is governed. But I think I still will look at the advisory councils or committees, whatever they're being called, as a positive step in this evolution. Judge Sporkin?
I think you should be using the inspection power in order to do something. I think that shouldn't be a punishment. Firms shouldn't be inspected because its fees are too low. And I think that's a mistake to use the inspection power. The other real issue I think you have here is on the going concern. I've been thinking about this, and what bothers me is, the audit, the audit of the financial statements is historical. You're looking at what happened last year. But we're now seeing such dynamic changes in industries upon industry that we need a better model. For example, I was just reading in the paper the other day that there might be a change in the cable industry because HBO has now found a way to get to your home without going through cable. That might change the entire makeup of the cable industry. We've seen companies that go out of business or are affected immediately. BlackBerry and other companies, and so, of course, you can't ask the auditor to be a predictor of what the new business changes are. But certainly, there's got to be some way of looking at some of these industries and some of these companies and raising concern. I realize it's risk management. I realize there are other people that ought to be doing this, but it is a very, very big issue where people are trying to buy on the future, not buying on the historical. I mean, it may well be that BlackBerry or one of them had a great year, but its future is very dismal.
Thank you, Judge. Lynn, I think you're next up.
First, on the director point, the directors, I think, have to have the authority that someone mentioned, and there has to be transparency about them if they're going to be a worthwhile endeavor. Just putting a bunch of people on an independent board doesn't mean it works or doesn't work. We saw this. Anderson established a board and probably useful at the beginning, but lost its value and eventually went out of existence. To create it, you'd almost have to have a requirement of the PCAOB if you really wanted to keep it in there and keep it functioning, because we learned from experience that otherwise it doesn't work. On authority, you're almost going to have to give them some type of authority to review compensation, because the way the managing partners in these firms get elected, and that partner selects all the key partners around them and sets the compensation for all the key partners around them and has final say on that, unless you give that board some authority over compensation, that board will not have much impact whatsoever. And then, of course, you got to put some transparency around it and have them report out so you can see what they are or are not doing, or otherwise it'll be a waste of time. I'm in favor of it and was in favor of the ACAP recommendation, but unless you do some things around here, just saying, and some of the people that are already sitting on them used to be principals at that firm or have done a lot of consulting for the firms with some of their leading experts during the debate over PSLRA and got paid by the firms a ton of money for that. Not exactly what I'd call an independent person. So I think the notion that you got to define independent and look for other people other than that, or that they are not really independent boards. And so some of these people that are on them today probably aren't very independent as it starts with. On the second issue about the low fees, I'm not so worried about innovation as Robert is. You know, Volcker said the only innovation amongst banks in the last 3 or 4 decades are ATMs. I'd say the banks are probably ahead of the auditors. The Texas State Board, to Lou's point, the Texas State Board did adopt a regulation quite some time ago that says that you can't do an audit at a loss. Your fee can't be so low that you're not making margin on the work. I've talked to them in the past about that. I think they looked at one case, but that's all. They really haven't enforced it at all. But you may want to talk to them about experience. I actually think it's what's been proposed here is an excellent recommendation. When I was at Glass Lewis, we had screens on this issue, and we would screen across an entire industry segment, and we get the audit fee as a percentage of revenues, as a percentage of assets, and I can tell you when you run those screens, there will be outliers. You will see them stick out like a sore thumb. In particular industries, we would run additional screens, so like for retailers, we would also screen against the number of store locations and get a percentage there, so we would tailor it to a specific industry. But when you look at that, you can find the outliers, and they'll fall out pretty quickly, and it doesn't take a rocket scientist to figure out which ones are way down and which ones are not. So I think you can turn around and do that. As far as inspections being a punishment, I really don't view inspections as a punishment. I think the work you're doing on inspections is one of the highlights for you and one of the favorable areas where you guys have accomplished something. So, but I'd hate to ever see it teed up as an inspection being used as a punishment, but I don't think it is in this case. If you had real low fees and you fell on the outside, lower quartile on that screen, I think it begged the question, why aren't you turning around and looking at that? Because that gives you data that probably says they aren't spending enough time there. So,
thank you, Lynn. Damon?
Well, first, my thanks to my colleagues for picking up after me. I was at lunch with my wife and didn't realize that I was up next. So I've gathered my thoughts. I have a couple of things to say about this. The first is to repeat what I actually said earlier, which is in relation to the question of the expanded audit report. Just to put a further gloss on the recommendations that are here, it's only going to work, I think, if there's a requirement to disclose something. meaning that if basically the expanded audit report is a mandate to tell the public, tell investors if something is wrong. Right? The audit firm will, of course, say nothing is wrong. Now that requirement, that further requirement, may give the audit firm some leverage in private negotiations with the issuer, but it's not going to result in any new information. What will result in new information is the requirement to disclose, for example, the most every audit has matters that come up that are of concern to the auditor that are generally resolved in some fashion that's mutually acceptable. The requirement to disclose the most salient such matter. There's always one, right? And the notion that you can't say nothing seems to me to be something that would actually add value of the kind that the examples in our report outline. Secondly, I want to express my own reservations about and also, and not reservations may not be the right word, it may be sort of express the complexity of the matter relating to the audit fee level that's in the report. I'm quite persuaded that low audit fees in relation to a relevant peer group are evidence of shortchanging the audit, as Lynn just said. I don't think there's any doubt that one could set that up as a presumption when looking at some level of reduced audit fees. But what troubles me is the chair of the competition subcommittee of the Treasury Committee. What troubles me is I'm not sure how we would get from the current levels of concentration in large company audits to some less concentrated environment without price competition. And so I'm concerned that, and I want to make clear to the board that I think that this recommendation should be best understood as a recommendation to try to figure out a wise response to the problem of lowballing. Right? I don't know. Joe's nodding his head. I mean, and I think it was apt on the part of our group that we didn't set a number. Right? That we recognize there's a problem here and it needs to be dealt with, with some consideration of the other of countervailing issues that are in play here. Now, the final thing I want to say really is about the issue of going concern. I take Judge Sporkin's point that there's a lot of change in this world, and I think there's always. And this is we go through in our economy. We go through eras of rapid change and eras of consolidation. This is unquestionably an era of rapid change. I don't think that is really what the issue of the going concern opinion is about. I think that and I've been on the receiving end of this, so I have some insight into it. It really is about the question of is it really clear that it would be improper to let the audit, which is based upon the notion of the firm continuing, let that out there without telling investors that there's a meaningful risk that simply will not be true in the relatively near future, right? Generally, as a result of issues surrounding the ability of the firm to meet its existing debts as they come due during the next year. And I thought this was based on my own experiences in working with companies and their auditors. I thought this was a relatively well-established area in the auditing regime until the financial crisis, when again I had firsthand personal experience of Big Four banks that literally were not going to make it through the week without government support. Right? And then we're continuing to rely upon government support, implicit and explicit, at the time in which their financial statements came out. And yet nor was there a qualification. And yet it was clear that if the United States withdrew its support of those firms, they probably would not have made it through the week then. And so that strikes me as a situation in which there needs to be some change in strengthening of those rules. And I'm very concerned that, as was reported earlier today, that FASB is actually retreating and seeking to essentially codify the unjustifiable and, frankly, in my opinion, corrupt practices of the crisis.
Thank you, Damon. Tony?
Thank you. I'm not sure there's a lot left. I agree. I mean, Lynn has made some very good points about these auditor switches and fee changes and some of the analyses. My concern was something that I've had with this type of research. It says 2010 to 2013. There are two things that I'll point out because they're a little bit different from what Lynn said. One is what was happening to fees from 2009 to 2010. And I think that would be relevant in knowing whether 14.2 or 6.5 is, and therefore that 21% change, which I'm not sure about. But I don't know. I think the point is whether that makes sense depends on what the trend was. So picking the 2010 to 13 is something that at least I would like to know a little bit more about. And maybe the paper makes it clear. I'm just asking the question. Another point is that, and this is again anecdotal, if you open up a software firm or a cloud computing firm, say in Indiana or in Kansas, it's possible that firms 4 through 6 might have more knowledgeable person than firms 1 to 3. And that pricing differential is something totally different. So in that sense, I think some of these issues, the way you break these, the way you analyze this, is much more, maybe more relevant, may provide more useful information. So I just wanted to point that out with respect to that particular issue.
Mercer, thanks for being so patient.
I have kind of a detailed comment and then a broader comment on the governance issue. Of course, there's a lot of corporate securities literature on boards, and I think that Lynn sort of captured it, that you really cannot force independent boards. What you can do is set up the usual standards, relationships, family members, employment, and you'll create a lot more independence than you would have otherwise, so that's a necessary feature. But I think what you've got to do is you've got to have structures that have been shown, if anything is going to work, that will work. And one is going to be you've got to have some requirements as to how they're going to behave independently. Typically, that would be the authority to hire their own counsel or requirement that they have independent counsel, the authority to hire outside consultants and that they have the money to do so, and then requirements that they meet independently. Now, that last one, of course, begs the question, as do the hiring counsel and consultants, well, what are they using all these for? And you've got to identify what the issues are that you're going to make them responsible for. Without specific issues that they're there to provide independence on, then there's really no point in having them. So you've got to identify those, and then we've seen that what has an impact is requiring that they make findings. Those findings be public. They be in some kind of, hopefully, public financial statements in the future. And I think that you could also think of a couple of novel approaches. One would be that independent directors' compensation should be fixed. It always amazes me that somebody could be considered independent and have their income depend on the fortunes of the business. Not only should it be fixed, they should be guaranteed income for probably 6 months to a year after they leave, so you remove the threat of them being removed. You could eliminate any kind of deferred compensation, which is somewhat indirectly a subsequent influence. But these things seem obvious to me as ways to just create that kind of independence that you've got to do structurally. And then finally, you have to think about some kinds of liability. I mean, as you said, nothing sharpens the mind, and I think the expression is actually like an execution in the morning. But some kind of exposure to maybe their continued right to be on a board as opposed to monetary exposure, I think is necessary. You're not going to get the kinds of independence and people standing up to the owners of the company unless they've got that. On the broader scale, all these suggestions are really kind of answers to the question that was left hanging at the end of the last session, and that is, what is the problem? Tell me what the problem is that Jim was bringing up. And I think that that's fair. I'm a skeptic. I go into situations like this, and I say, if you have an advisory board, they will come up with recommendations. And that really tells you nothing by itself as to whether something is needed. On the other hand, in my career, I've seen the law develop coming from Enron and WorldCom in the early part of the century to the financial crisis in 2008, and all the promises in between those two that clearly were not solved, especially with respect to accounting. So it's hard for me to imagine that there aren't problems to be solved because accounting problems are at the heart of the financial crisis. I think that the question is being asked is what the problem is being solved is still a good one, because I'm not so sure that we've really pinpointed exactly what it is, for example, about the financial crisis that exhibits a failure of accounting. But I think that question really forces us maybe to focus harder on that. We've got to have a very clear, strong answer to that question, and it's got to be short, it's got to be concise, and it has to identify a specific problem, because the financial crisis had a real impact on a lot of Americans' lives. Some lost 40% of their retirement, and then they decided to get out of the market. So, these are the kinds of things that trace directly back to accounting. Money market funds, which is an issue I was looking at, was another example. We, with the AFL-CIO and the CFA, we wrote a letter to the SEC in January of 2008. And we said, there's probably going to be a problem with money market funds. You ought to do something such as requiring, let's say, streaming evaluations across all of the money market funds. And unfortunately, that went unnoticed. And now, coincidentally, we have a requirement like that, but it was a little too late for the industry. I really think we've got to focus our efforts more to get a clearer idea of exactly what the types of problems are that we think our solutions will solve, because Jim's right. We need, more than anything, we need an answer to that question.
Thanks, Mercer. Jay, thank you for being so patient.
Thanks. I appreciate the discussion, and especially the perspectives around this audit fee and whether audit fees are too low, if that should trigger an inspection. I just wanted to provide a little clarity and perspective around our selection process today. So there is no secret recipe for the sauce as to when an audit gets inspected. And it's a very complex process. We spend a large part of the year working on that selection process. And Greg Jonas is here in the room with me, and his group works a lot on providing the inspections division some context around issuers that they should look at for possible inspection. And that process is going on right now today for the 2015 inspections in the major firms. And I can assure you that audit fee levels and changes therein are absolutely a factor today in what gets looked at. It's one of the mix of, I'll just call it flags that get thrown on the field. If no flags are on the field, a real live human being looks very carefully at that filing to decide, do we want to look at that audit, and what would we look at? And it's not a determinative factor, and maybe there needs to be more rigor around it. Maybe there needs to be more weight around it, but I appreciate the context. It gives us another lens to look through, but I assure you today it is a factor that we consider in whether we go look at a particular audit to inspect.
And let me respond to that. Jay, I had a sense of that as I was working on this, and I think our group had a sense of that. I think our concern is, I wonder how many issuers are aware of that, and maybe you know the answer to that, but it just strikes us that better communication by the board of that fact, which your statement alone hopefully will be disseminated by the friends in the press, accomplishes part of that objective.
Steve.
Yes, I don't want to leave Mercer's question unanswered, and I think it's very important that everybody that's made a recommendation address the issue of exactly what the problem is that we're trying to solve. To me, it's pretty clear, and that is that audit quality is not what it should be. So how these recommendations will help improve audit quality, I think is one determinative in terms of why you make the recommendation. But we do need to answer the question rather than throw it out and leave it unanswered. For those of you who have answers and responses, I think it would be very helpful to create a record on that. So for all those who have submitted recommendations, what's the problem that we're focused on and why the solution?
Yeah, Mercer, I'm going to follow up on what Steve said, because that's where I put my 10 up. So this is quickly off the top of my head, but I would throw out at least a few data points. Recognizing that PCAOB inspections are not random, and I do think that's an important caveat. I think it's an extremely important caveat. But recognizing that they're not random, ballpark in the last year or two, approximately 40% of inspections of the major firms have deficiencies. That strikes me as problematic. A couple of years ago, we had a panel on going concern reporting, and I thought Ann Simpson was extremely effective in talking about this, but virtually no going concern reports were issued on the financial institutions during the financial crisis. Now, I guess the argument could be many of them didn't fail because of government subsidies, but I don't know if that was a reasonable assumption to make, because that could have been removed at any time. And then in terms of the audit report, based on some of the work that Ann and Norman and Gus Souter, who used to be a member of this group, did a few years ago, basically what we heard from users is, although they found the audit useful, they didn't even look at the report because it had no information content. And there were other things we could come up with, but at a minimum, I think those three are indicative of the fact that there are issues with both audits and the communication of the audit results that these recommendations are designed to try to be responsive to.
Does anyone on the subcommittee have anything they'd like to add? Lynn?
I would agree that there is an issue, and that issue is audit quality. When we look at the inspections and the findings in the inspections which have increased, maybe part of that is attributed to the fact you're doing better inspections today than what you were before, and I think that is in part true. So part of it's kudos to you for better inspections, but I also think it's the type of things that are cited when you go through line by line in those inspection reports and you see the problems, despite what the firms say, those are serious problems. I think they are recognition in many of the cases, not of just an audit deficiency, but an audit failure, a failure to comply with GAS. They give us an audit report saying they've done an audit in accordance with GAS, and yet we find in the inspection reports they haven't. In my mind, I think any reasonable person views that as an audit failure, not just an audit problem or deficiency. And so I look at your inspections, I look at the survey that the academics have done with CFOs, where the CFOs themselves have said they've manipulated the numbers by a material amount, 10% or more, and they haven't been caught by the auditors. That tells me there's a problem that's consistent with your findings. When I look at the audits I've seen, my experiences are very consistent with what's going on with your inspection reports. So I think they all point to the fact that you do have a serious audit quality problem, just as we did leading up to the corporate scandals. It didn't become a huge issue till Enron imploded, but it was an issue before that point in time. And I think the difference between now and Enron is a downturn in the economy with people taking, companies having a tough time. And at that point in time, people come back and say, why didn't you guys do something about it? That's what your job was. So I think you've got a legitimate problem. I think you've highlighted and documented it well. And I think you need to go turn around and address it. We've got 6 years ago an ACAP report that came out with 18 recommendations. I don't think a single one has been implemented. If we were to have a serious downturn and have corporate scandal today, there wouldn't be a rock big enough for you guys to go hide under. Because the question would be, why haven't you done anything about it 6 years after the fact, when a high-level U.S. government Treasury Commission said, go do it? And some of those are extremely important. I give Jeanette kudos on the quality indicators. I think that has to be dealt with. But I think there's some other things here in terms of standard and other recommendations in that report that need to be dealt with as well. And I find it unforgivable that 6 years down the road, neither the PCAOB nor the recommendations to the SEC in that report have been acted on. That's not why we as Americans pay our regulators, I think.
Marty, since going concern was raised, do you want to just update the group in terms of what we're doing on going concern?
I'd be glad to. So, just for level setting for those, for everybody here, reporting of going concern was always the auditor's responsibility. I think going concern uncertainties has been an auditor responsibility and has not been a requirement of management under U.S. GAAP. So our auditing standard requires the auditor to report a going concern uncertainty when he or she concludes that there's substantial doubt about a company's ability to continue as a going concern. The term substantial doubt is not defined in our auditing literature, and this group and our SAG have indicated in the past that different interpretations of that phrase can lead to very different auditor reporting, and apparently, and also have indicated, both at the SAG and IAG, that they perceive as different interpretations of the term substantial doubt. And we've heard that investors feel that the existing auditing standard is not working in terms of reporting going concern uncertainties to the extent that they should be reported. So we've heard that loud and clear, and we have a project on our agenda to address that. In the meanwhile, FASB, as has been mentioned here a couple of times, issued a new standard which requires management now to report going concern uncertainties in the financial statement when management determines it is probable that the company will not be able to pay its debts as they fall due in the next 12 months. And so the point that's been made here a couple of times is that the term probable threshold in the mind of some of the folks at this table and others has raised concern, is that going to be a higher threshold than the undefined substantial doubt in the auditing standard, resulting in fewer situations of reporting. So to avoid that, we put out a practice alert that said our existing auditing standard still applies, and that is substantial doubt has to be reported by the auditor when he or she believes, based on whatever qualitative factors they assess under our auditing standard, notwithstanding the requirement to audit what management may report as well. So at the same time, we've said, and we're working diligently on this, we're working on a staff consultation paper to be issued around year end to lay out some views around this issue to, one, improve auditor performance and how they audit conditions that could give rise to going concern uncertainties, and lay out some possible improvements for comment. And then two, to lay out in the consultation paper issues about at what point should an auditor warn investors about a going concern uncertainty. What is the early warning signal and when should they give it? And is it at the FASB level of probable? Is it substantial doubt? I mean, is there some other level where early warning should be given? And so we'll issue a staff consultation paper, I think, around the end of this year, laying out some thoughts on these matters about auditor performance and auditor reporting obligations and variations in possible thresholds there, and seek comments. So we hope investors here and elsewhere comment on that paper as to what their expectations of auditor performance obligations are and auditor reporting about early warning signals on going concern should be.
Bob? And then
Thanks, Ann. I'm going to go back to Steve's question. I think it's a question basically, what does all this have to do with quality and relevancy? And from my point of view, quality is about technical competency and it's about state of mind. And these recommendations are really going to that state of mind part. You could put in audit quality indicators on the technical side, I think. But what are you going to do to make sure or enhance the chance that these audits are being conducted with the proper state of mind? So whether it's the fee issue, the fee threshold, or the governance matter, or even the signing, to me that all gets to the state of mind aspect of quality and relevancy.
Thanks very much, Bob. Lynn, do you have anything you want to say, Lynn?
Chairman, I'm sorry. Who has it come? No, Lynn does.
Well, first of all, I found this This discussion is riveting, and I think I would consider the afternoon lost if I didn't have the chance to say something about the transparency proposal of naming and signature. Reasonable minds may differ on whether an auditor's sense of accountability is increased by either signing or naming. Those are matters in which the view of auditors and people who sign the audit or sign the firm manual have views that are as credible as any of us in the room. I may have my own view about what it meant to sign in my name a legal opinion. I may have my own views about accountability, but it doesn't really weigh in this discussion. One thing, though, that does weigh is the confidence and credibility that people have in the audit and the way they look at the audit, something Bob was just going to. And as to that, the people in this room do have an opinion which I think has to be listened to. You've been asking for years to have more information about who does the audit. You've been asking on several grounds, but I would just suggest to you that the one ground for which I think there is no reasonable negative response is that it will enhance the credibility of the audit. It will do good things for the audit opinion and the audit profession, and it will be something that investors will appreciate. With that in mind, I was intrigued by Pete Noctuay's remark for an evergreen consent. I was impressed that Pete, as a former auditor, was not bothered by the idea of a consent. Many people are. Many people are. If I am right, and it is my belief that we must join the community of developed nations who have capital markets like our own and who identify this information, we must get the information in the hands of the public, and we must do it in a way that minimizes the friction, that addresses the consents, the comments and the concerns over litigation risk. And it is litigation risk. It's not ultimate liability, it's litigation risk. But those are real concerns. And therefore, if we can do this by offering auditors an option to either put this information, the engagement name and the other firms named in the report, or should they be sufficiently concerned about litigation risk, give them the option to put it in a form filed with the PCAOB, a form which would not be subject to any constraints about the information. It would have to be public, and it would have to be proximate in time. In other words, I do not believe that the public interest is served and the goal that you're discussing is served by having a form which is filed 6 months, 9 months after the release of the audit report. So in my mind, my job is to try to get a package that very few people can really take difficult positions with and disagree with. I think such a package is to provide the auditor an option. If you don't want to put your engagement partner's name and the information about who did the audit in the report, put it in a new form. Put it in a new Form 5. Here it is. Now, I'm in hopes that we'll have a supplemental request for comments in the hands of the SEC soon. I'm in hopes that that can go out soon. I'm in hopes that we can get comments on it soon and move forward with the kind of approach I've suggested. It is not the same thing as partner signing. It is not the same thing as naming the engagement partner, because the issue of the consent remains there, and some people, Pete, are bothered by the consent. It does seem to me that the responsible thing for this board to do is to get out a package, a standard that will enable the information, which we know is important information, to get in the hands of the public as soon as we can. It was intriguing to me to hear the discussion on governance. We have spent the last week with Stephen Hadrill from the Financial Reporting Council. They have accomplished a great deal in the UK with what he calls a soft landing approach. And when it comes to the structure of the firm, governance, the board, the independent non-executive involvement of independent non-executive board members, it may be that this is the way that we should go. We first of all have the ability to begin to determine whether, in fact, with the firms that have this innovation, whether it's done something good for the audit and for the governance of the firm. We are not prohibited in urging firms to do things that we think are useful, and to urge them to do it in very strong terms. Comparing, for example, what we see to be the results of it in firms that have it, if we see those results. But I am saying that I think that, in fact, firm governance is not something that fits comfortably within the powers that we have at this time. I think that would be quite an ambitious thing for us to declare that a firm was required to make changes in its governance structure. And I think that's something that will involve us in more complexity than simply the suasion and the moral suasion that we can bring. Finally, I thought the whole issue of the low ball, the low fee, the low ball audit eventually came around to where it belongs, and that's the fiduciary obligations of directors and audit committees to keep management out. And you had it, you were all recommending that this morning. Keep management out of the negotiation on the fee. This is an area where if management has its head under the tent and the camel is negotiating the fee, that begins in my mind to partake of fiduciary obligations in addition to statutory violations of the spirit of Sarbanes-Oxley. I am willing to sit and watch while I think corporate fiduciary law is going to move in this direction. I think one of the things that we do as a board when we increase auditing standards and increase the authority of the auditor to talk to management, I think we have an upward draft effect on conduct in the boardroom. This is an area, and there are several areas where this happens, but this is an area where I think what we should do is begin to create the upward draft in the boardroom about how important it is for directors acting responsibly under SOX to keep management out of the fee discussion, negotiate the quality audit before you negotiate the fee, and then finally to avoid what appears to be perhaps a trend toward a lowball fee. If you start thinking of what we do in terms of the disclosures that we can now implement to enhance confidence that the public is getting the facts about the audit, and certainly the audit reporting model is the biggest project going in that regard. The practices in the firm that we can lobby for successfully in talking to the firms, and then the final ultima ratio of where we can say that we think responsibility comes to rest outside, those are three fairly important sticks that we have to wield. There are three fairly important devices we have for improving audit quality. And I do see the audit quality is the handmaiden of public confidence in the audit. But it seems to me that the 2008 crisis, we were told by you, what you always come back to in these meetings is that the 2008 crisis did shake public confidence in the utility and the informational use of the audit. Something Tony Sunday was saying earlier, and that, it seems to me, is where we as regulators must be worried. You may go. I'm inviting rebuttal.
Before we take the break, the chairman talked about litigation risk. I just wanted to focus for a second on liability, on the transparency issue. To what extent do you view that as a real risk?
I mean, I spent a lot of time dealing with sort of Section 11 cases, classic example in which auditors are specifically named in the statute as viable defendants. But I just don't know where the liability issue is coming from. There's simply no way that any plaintiff worth his salt is not going to be able to find out who the audit partner is. And second, there's no plaintiff lawyer worth his salt who's going to think that's where the money is if you bring a lawsuit. So, I mean, frankly, I think it's ridiculous to think there's real litigation risk exposure arising from disclosing anybody's name. And I don't know where that's coming from. It certainly sounds like a superficially sound argument from a legal point of view. I think it has no merit at all.
I couldn't echo what Bullard just said stronger. And, in fact, if you actually look at the cases, the audit partner is seldom, very seldom named in the cases. even where they do know. And the first thing you ask for as a litigator in these cases, you ask for the name. So this is a facade. This is ridiculous even to have that issue teed up as an issue. Any lawyer that knows the area knows it's not an issue and it's a facade. And on top of that, you know, when you see that they are in fact not getting named because the deep pockets, if you will, are with the firm. Individual partners aren't where the deep pockets are and where they're going to go after the money. They're going to go after the money from the firm itself, so seldom are the partners named, even when you don't turn around and have a name out there. So I just couldn't agree stronger with Bullard. This is a facade, and if that's where people go, then it's, you know, there's just not sound reasoning going on here.
Well, with that, there are clearly strong feelings on the subject, and why don't we take a 15-minute break? Ann and Joe, thank you very much for the recommendations, and why don't we come back at 20 of 3. All right, Bob Tarola and Tony Sondy, if everybody could take their seat, we'll just move on to the final topic for the day, which is the relationship and role of the auditor with the audit committee. And as I mentioned, very briefly to you, Bob, notwithstanding the various jurisdictions that are involved, this issue has traction domestically and internationally. Clearly, the role of the audit committee is something that's front and center in the area of corporate governance, and it's an issue that was taken up at IFPR last year. Chairman Ferguson, to correct me, but I think it's likely to be taken up again. It was brought up at the interim meeting in Toronto, so this is well-timed. So we appreciate your discussion and leading this group.
Okay, thanks, Steve. I'm going to set up the topic and then get to the discussion questions where the rest of the group will weigh in from their perspective on the discussion questions, and then we'll open it up for the floor. We're approaching this, most of us in this committee, if not all of us, have either been servicing audit committees or served on audit committees, and we want to give you that perspective in this discussion. So first is the current state, and these are our observations, that the role of the audit committee is fiduciary and statutorily determined, yet their work is often not appreciated or even transparent to investors. The audit committees play a key role in financial reporting, yet the report on their work does not appear in audited financial statements. And the audit committees may be made up of members who have far less training or experience than the individuals they oversee, yet they are expected to challenge these individuals. And audit committees actually spend most of their time on matters other than the annual audit, matters of risk management, internal audit oversight, and just financial reporting. Yet the oversight of the audit seems to be the one that is focused on for reporting to investors. There's multiple regulators of audit committees and the auditors. So you have the Sarbanes-Oxley Act in terms of duties and responsibilities. The SEC oversees independence and monitoring. Exchanges cover governance roles and reporting, and the PCAOB, of course, covers auditor interactions. So here's what we believe are the current state issues. Investors and regulators are seeking more discussion and analysis of financial reporting and auditing matters, but seem to be bypassing the audit committee for that information. Maybe not putting as much relevance on their role as we think they should. Governance advocates are calling for more discussion and transparency from audit committees. The NACD, CAQ, and others have endorsed a call for action. That call for action is quite involved. As a chair of an audit committee in the proxy season just passed, trying to respond to that call for action was actually quite difficult. The call for action requests the audit committee address why they hired the auditing firm, why they liked the audit partner on the audit, and why the fees were what they were. Those are quite in-depth questions to deal with from a governance perspective. As mentioned here before, regulators outside the U.S. are requiring more information about the audit committee, even asking shareholders to get involved. And regulators within the U.S. seem to be accepting the bypass instead of subjecting the work of the audit committee to greater transparency and oversight. So if you accept those current state issues, we decided to set up a potential future state. Barbara, these are sort of recommendations, although we use different words. So here's how we thought a potential future state might be set up. First of all, the audit committees could become a more transparent part of the disclosure framework, reporting on the processes they oversee within the same documents that contain the outcomes of those processes. So right now, the audit committee report is in the proxy statement, often 5 or more months after the fiscal year end, and at least 3 months after the audit is completed. So the question is whether their report should be part of the normal quarterly or annual reporting process with the financial statements. We believe the audit committee report could be required to address specific interests of investors and regulators. Many of those interests were voiced today, and conceivably they could be put in a form of expected disclosure from audit committees. And then here's the dicey one. External auditors could be required to assess and report on the design and effectiveness of the audit committee. And this goes hand in hand with the requirement of auditors to assess the financial controls over financial reporting and tone at the top. It was hard for our group to see how an auditor could make that assessment without assessing the effectiveness of the audit committee itself. And we saw that as the major dilemma. Can auditors independently and objectively assess the effectiveness of the body that hires them? So with that as a setup, these are the questions that we're going to pose for the IAG and for others to comment upon. I'll just read them more or less, and then I'm going to call on Tony Sondhi to comment first. So, should the audit committee report on its role alongside that of the CEO, CFO, and audit firm? As you all know, the other three report every quarter and, of course, annually as well, whereas the audit committee does not, and its annual report is often delayed. The second one, should the auditors be required to assess and report on the duties and operational effectiveness of the audit committee, or for that matter, should some other party report on the duties and effectiveness? Should the auditor's evaluation of the audit committee's role be reported within the board or even made public? And finally, should the auditor be required to assess the objectivity of audit committees and expect that the auditor's independence be protected by the audit committees? And this is one issue that I've had some experience with, where both the audit committee and the auditor could be at odds when it comes to independence. And it seems to us anyway that a better situation would be where each of their independent situations are protected. So with that, Tony, I'll ask you to comment first, and then we'll go through the rest of the group.
Thank you, Bob. If I take the first one, clearly both the transparency and the availability of that audit committee report would be relevant, or is relevant, to investors. And I think we'd like to see that. These, by the way, I'll make some comments on each one of them, but it's very hard to make the argument or to leave out the sense that they are definitely interrelated, and there are all kinds of interrelationships in here. The second issue is should the auditors be required to assess and report on the duties and operational effectiveness of the audit committee? Now, clearly, this is one of the issues that I'd raised this morning, that the competence, for example, or the effectiveness of the audit committee itself is a component, I think, of the internal controls. And if you don't have a good audit committee, then I think it's fair to say that you have material weakness in those internal controls. So I think that's something that we ought to be concerned about. And whether the auditor should evaluate the audit committee or whether the two of them should work together to ensure that they're independent and that they're independent of management's concerns and from the perspective of reporting the financial risks of the company. So when you look at it from that perspective, I think that the two of them can actually work together to help ensure that financial reporting risks are dealt with. So, for example, when you have disagreements between management and the auditor, that's a place where I think a really independent audit committee could be very helpful. Should the auditor be required to assess the objectivity? Well, that's exactly what we were saying earlier with respect to the internal controls. Now, I wanted to add just a couple of other things and go back into what I had said earlier this morning. One of the issues that I'd raised this morning was there is certainly an increasing reliance on non-GAAP measures, albeit very often those are based on GAAP numbers. There are adjustments to GAAP numbers. But I think it's really alarming at times to listen in, for example. You should try it if you haven't had a chance to do this. Pick a cloud computing company, for example, such as Salesforce.com or somebody like that, and then listen in on their conference call. You'll wonder what they're talking about, because they don't talk about the financial statements as much. They don't talk about some of the measures that we often think about. You look at gaming companies. You look at some of the other IT companies that are very, very new in the marketplace, and you have to ask yourself, what do those numbers mean? In fact, with some gaming companies, it's very interesting to try to figure out whether the current financial reporting model that we have actually does a decent job of telling us whether they're doing well. So there the question is, what is the role of the audit committee? How much can they help the auditor? Because management there has at least the intent to report in certain ways, and you might, from an investor's perspective, you want more and very much more useful or helpful information. The other thing, as I pointed out this morning, was as we move towards more principles-based reporting guidance, and I think that's important to have because of the complexity of contracting out there in the marketplace, you have to ask yourself, are audit committees up to the task? Are the auditors up to the task? What are they going to do as we see more and more principles-based reporting? And I realize that in the IFRS and elsewhere in the world, we've had, to some extent or the other, we've had principles-based reporting for a very long time. But I caution you to be aware of the fact that enforcement in foreign countries is a different exercise. They don't have the equivalent of an SEC. The marketplace behaves very differently there. In fact, even investors have a slightly different role in places like Germany and Japan and France, for example. And I can give you more examples of specific issues that come up, but I'll stop at the issue of this principles-based reporting and the interrelationship between the audit committee and the auditors. And in fact, to go back to our chairman's point earlier, and something that Steve has also said, what is it that we're trying to resolve here? We're trying to explain and actually delineate the role of the auditor and the audit committee in terms of providing investors with useful information. Thank you.
I'm going to go around from there. So, Norman, any comments?
Thanks, Bob and Tony. I'll just weigh in a bit further on, at least what I see. And again, as everyone knows or you see from my background, I'm not an accountant. I've never been an auditor. My life has been primarily in a legal and consulting and investor role. So I look at this more from a corporate governance standpoint, outside in, and I think this issue of how you define operational effectiveness, and to follow on to the comments that Tony just made, I think what we're looking for here, the question we're posing is, does the current state of reporting and disclosure provide enough information for investors to develop a measured assessment, have confidence in the competence and the commitment and the level of rigor and diligence that the audit committee members bring to their work? And if not, what are some of the options we might consider for greater, some form of assessment and reporting on that process? And if you think about the primary responsibilities of an audit committee, at least as it pertains to the annual audit, in the first instance, they're participants in the discussion and decision about whether to engage a particular audit firm or whether to recommend to shareholders that the auditor's appointment be renewed for another year through the annual meeting process. Responsible for negotiating the scope and the fees, as we discussed earlier, associated with the audit. Responsible for evaluating and making decisions on independence issues that the auditors may bring to their attention over the course of the year, and most fundamentally, overseeing the audit process and devoting time and effort to reviewing results of the audit, receiving reports from the auditors, addressing, pushing back on significant issues, or hearing the auditor's concerns on issues that rise to the level of management committee concern. All of those tasks and responsibilities and engagements are what audit committee members do in discharging their duties with respect to the audit. And if the notion is that the audit firm should then in turn be tasked with assessing the competence and completeness and sufficiency with which the audit committee does those things, I just don't, I don't know how you square that circle. I can't, I'm just not smart enough to square that circle. So I think it then leads to some questions which we may get into in the discussion about, if it would be viewed as valuable to investors to have more insight into the manner in which and the competence with which an audit committee approaches those tasks, then to whom do you look for some objective or independent assessment of their conduct? Is there another source within the company, perhaps, or are there insolvable conflicts involved there as well? Should there be a requirement to obtain a third-party assessment, an independent third-party assessment of some type, or an option to do so, or an opt-out option with disclosure if you decide not to? I mean, there are a lot of ways that you can go, but to the fundamental question of whether the auditor should be deemed sufficiently objective or competent to assess and report on those aspects of the audit committee's responsibility and performance, I think is very difficult.
Mike?
I won't repeat what Norman said because he did that very elegantly, but I will say that I think the reporting on and assessing would add significant value to the users and the investors. I think the report and this assessment at least should be made available to PCAOB and maybe in the public documents also. And I don't have a problem with the concept of hiring an independent outside party by the full board to do it. There's already supposed to be a self-assessment of the audit committee provided to the full board on their activities, and by having niche legal firms that have expertise in corporate governance, or the other public accounting firms that aren't doing the audit, or a non-auditing firm. There's several out there like a Protiviti and things like that. I think there's plenty of expertise in corporate governance that would allow the board to hire a firm to assess it and not put and resolve the dilemma of auditing your boss. in essence. But I think it would add significant value and go a long ways toward either restoring or maintaining investor confidence. So I think it's a good idea. It's a matter of how you would, make it work.
Kurt? So I tend to think that when we complete the work on audit quality, we will find that the number one item is competence, capability, and tone set by management. Number two is the same by the audit committee. And so I think it's important upon all of the parties with regulatory oversight to look at this issue more holistically than maybe what we've done here. I think timely reporting up by the audit committee needs to be part of that solution. I'm a little cautious about some of the others in terms of other recommendations in terms of them turning into check-the-box reports as opposed to substantive reports. And I do worry about bringing the ability to bring third parties in to make the assessment, especially because those assessments are going to be, really over confidential, difficult matters, and how that judgment is exercised is really what we're asking people to assess. And so then, can that realistically be done by bringing a third party into that exercise? The auditor's already there, but then you've got the dilemma that we've already spelled out. That said, I do think this is a critical area, as I said before, that really needs to be looked at holistically and not just a little bit by the limitations that we have for this exercise.
Pete? Yeah, thanks, Bob. Thanks for taking the lead and doing a great job at herding the cats the last couple months to get us to some closure on things. But yeah, I guess as I think about audit committee reports and maybe put this in the context of this comes from somebody who has to sign 2 certifications every 90 days on a complex global company. And Kurt, who just spoke, also has to do the same thing, but the internal controls and the quality of the financials. So to a certain extent, there's a little bit of, why shouldn't the audit committee be there with the CEO, with the CFO, although it has to be a recognition that theirs is more of an oversight, whereas the CEO, CFO role are clearly as management, we can get in and impact and do things more directly. But I look at this maybe kind of 3 levels, the why, the what, and the how, and we'll speak more to the first 2 than the latter, which is, sorry, Barbara, but that gets to the hard part of, exactly how would we do it. But the why, in my mind, first and foremost, is there's got to be an intersection between what the PCAOB does from a macro level in overseeing the profession and what the audit committees do at public companies at the micro level on a company-by-company basis. I don't know exactly, again, how we get that intersection addressed, but if we don't, in my mind, there's a gap, and do a gap with a single A. Second is, again, around the why, is there's a tremendous difference in the level of quality of audit committees amongst public companies. I happen to work for one that I'm blessed to, or cursed, to have inherited an audit committee that is the ultimate in perfectionists. From when I got there, it was led by Denny Beresford, who many know from the SAG and his role as chairman of the FASB. And one of the other board members noted that he's also a professor at the University of Georgia, and that he wanted to make sure he got straight A's as being the audit committee chair of White Mason. When he hit mandatory retirement, the former National Accounting and Audit Director of Deloitte took over, who Jeanette had a chance to work with prior to a visit with our audit committee, who's no less a perfectionist. So there isn't a best practice that we haven't tried and looked for more. And quite frankly, it's been a good journey, I think, for both the committee and for the company. But not all companies are created equally. Not all have the resources. We certainly don't have a resource of a J.P. Morgan, but we have way more resources than a company at the bottom end of the Russell or the Wilshire. But by putting out there some best practices, having the public get an opportunity to see what the best companies are doing, I think would just, I don't know if it would force a race to the top, but it ought to elevate all boats in my mind. So that's kind of the why at 2 levels. The what, when I look at the things that our committee does around the level of focus that we have on the charter and the schedule of activities and the kind of things that the committee is responsible for, that's very, very detailed. and they hold themselves accountable to make sure that they're following up on all those items on an annual basis. The one thing that the reach out from the board and from Jeanette in particular caused us to add to that charter, we realized we didn't have on there the scheduled activities, that we would actually go look at the PCAOB inspection report on PwC, our auditor. Kind of a blinding flight. We said we're going to give this to Jeanette and to Abe and say these are the key activities, yet we don't look at that report. It was just something that, again, was a blinding flash to the obvious. But those kind of things I think are really important. I think going back to what Tony's alluded to several times, non-GAAP financial measures, I'd broaden that to almost any kind of disclosure, particularly disclosure that has a dollar sign on it or a number. Our audit committee insists that if we're making any changes to those, that's something we're going to vet with the committee, and they're going to decide, along with management, whether that's appropriate information. Is that necessary information? Is it balanced? Are we just telling the good stuff? Is there another side of the seesaw that's the bad stuff we should be thinking about? And if we're going to disclose it, do we have a system of internal controls around it that's equally as good to what are around our GAAP numbers? And then the earnings release, which is another place that companies talk to the public on. That's something our committee spends a lot of time on. We actually spent about 20 minutes the last quarter debating whether we were going to allow the CEO to say he was thrilled about the quarter. They wanted to make sure that the word thrilled was something that we could. That's the level of detail that we got into. So I think different audit committees are going to have different levels of specificity, different levels of interest, different levels of scrutiny that they put on to their company management that I think are worthy of being reported out to the public. So in terms of the what, I think getting something out there right now there's a report in the proxy. Whether there's something that actually accompanies each of the financial statements would be an open question. But I think doing something that beefs up what's in the proxy and reassessing, is that the right place for it, or should there be some other place for the audit committee report?
Thanks, Pete. I'm going to sum it up and then open it up for general questions. This issue, I think, is on the table because folks believe there's a wide variation of how audit committees conduct their activities and the degree to which there is transparency about what they do. The call to action from the NACD and others, I think, has started to bring into the disclosure documents some idea of what the audit committees are actually doing and how they conduct their business. Interestingly enough, though, for a large measure, it's focused on the annual audit and the relationship with external auditors, where I would suggest that audit committees do a lot more than that, and perhaps their total activities ought to be in some way addressed in their report. And then it also is clear, I think, that the auditors in accepting a client or continuing a relationship with a client must be evaluating their confidence in governance. And Marty, I suspect that that's one of your inspection points, to see if auditors are looking at governance and making an assessment of their confidence in governance. So that part of the auditor's role relative to the audit committee could also be an enhancement, in my view, to the information that's available to investors to give them confidence that the audit committee and auditor are effectively discharging their duties. So I'll stop there and open up the floor. Damon, sorry. Right ahead.
I think this conversation has brought up, has serves to focus in a way the discussions of the entire day, because the point that was made a couple of slides ago, that it's problematic perhaps to ask the audit committee to oversee it's problematic to ask the auditors to express an opinion about the audit committee, which then turns around and hires the auditor. I think is a way, and neatly summarizes, in fact, the entire model of audit governance that we've been discussing since this morning. Meaning that the model we have is a model which, despite Sarbanes-Oxley, which sought to structure it in certain respects, is a model in which the audit committee, the management, and the auditor engage in a process that, a process whose fundamental content is obscured from the investing public, and where the ability to hold parties accountable is held by people who are in inextricably kind of intertwined relationships with each other that, again, are not visible. Now, I think that this structure then leads to a set of problems that seemingly cannot be resolved. Now, I think that the PCAOB ought to ask yourselves, as you listen to the discussion today and the range of opinions that are expressed among us, there is a clear set of recommendations designed to open up this process and create some external transparency and some external levers of accountability. And that agenda has been sort of stated and restated over and over again. Now, what's interesting about this agenda, which is different from when this agenda was first in front of this board in 2003, it's exactly the same agenda. I think I'd probably have if my files were better kept, I could find an agenda for a SAG meeting from 2003 that literally had these items on it. We could have switched them for today's agenda. Now, what's different, though, is that, and this is shocking when you think about the way the debates stood in 2004, is that basically the transparency agenda that we are arguing about yet again has now been embraced by the international auditing regulatory community. And it is shortly going to be an embarrassment to the United States that we are falling so far behind. And this is exactly the opposite of the situation as it stood when this agenda first came up. At that point, the United States was in the lead. Now, if it's an embarrassment, well, I guess we're often embarrassed internationally, but it could be far worse than that if this system again fails. And the reality is that this system did again fail. It failed in the financial crisis of 2008, but nobody paid a great deal of attention because so many other things failed. Now, I think that the PCAOB, when looking at this list of items such, and we've discussed some of them multiple times today, they include the question of how do you evaluate the strength of the audit committee given this intertwining of relationships, and there are now international examples of how to do that. There's the issue of whether or not we should continue the farce of maintaining the nominal secrecy of the audit partner. It includes the question of whether or not investors ought to have an ability through the corporate governance system to express an opinion on these issues. It includes the question of financial transparency of audit firms. All of these issues are on the table, have been on the table for 10 years. And what the PCAOB ought to ask itself when facing them yet again and hearing the same tired and frankly baseless arguments against them, the most recent of which I gather was yet another attempt to urge that somewhere in our statute book it makes a difference whether or not the name of the audit partner is disclosed before the litigation begins. There's absolutely no evidence of any kind in law or jurisprudence that that's true. The PCAOB ought to ask the question of this point. For those who urge you to maintain this current system that manifestly does not work, and is leading to the increasing irrelevancy of both the auditing profession, the audit process, and this board, those who urge you to do nothing, what is their plan? What is their solution for the diminishing importance of what we are doing here? And because there is a solution, it's been sitting on the table for 10 years. I'm not sure it's adequate, frankly. I think Lynn really raises serious issues as to whether it's adequate or not. But if you're urged to do nothing, right, you really need to pose the question to those who urge you to do so, to ask more questions, to have more dialogue, to spend another 10 years pretending the system works. With how many more financial crises involved, what is your plan? What is the alternative? Because if the alternative is the current system, Right? If the alternative is the current system, I would suggest to you that you know, as a result of your inspection reports and what you know as a board about the relationship between the failure of the auditing of public audits and the recent financial crisis, you know that doing nothing is not really an option.
Thanks, Damon. I think, Bob, you were up next.
Yes, my question is for both Peter and Curtis in your roles as chief financial officers. It was mentioned earlier in the presentation that there are some questions around the effectiveness of the audit committee results that are reported in the proxy, largely because they're 3 to 6 months past the close of the particular fiscal year. Is it even possible to do something in a more rapid time frame? And is that something that you think would help investors, i.e., as soon as that annual period closes within a fairly short period of time, maybe coincident with the press release on the annual figures, that audit committee results would be disclosed, or audit committee standards? And then the second question is, in terms of a process statement for how the audit committee looks at their responsibilities, would that be something that you think would either be proprietary to the company or a burden to provide? And if it's not, then I would think as an investor, the process by which you go through to close your books on an annual basis would be of utility, certainly to the professional investor and to maybe a somewhat more limited extent the retail investor who has an interest in these things.
So on the first, on timing, I don't see any reason why it can't be done quicker. I mean, the rest of the audit process, the Sarbanes-Oxley reporting, et cetera, kind of can align quicker. Sign-off of management, audit committee, et cetera, is done. So I don't know why an acceleration of that reporting can't occur simultaneous. Now, you get into kind of probably the extended issues around, is it a boilerplate report, or is it more customized? And the more customized, probably the more valuable it is, will take some time. But even there, I would still argue that should be done kind of timely. I think timely is a lot better than late, no matter what it is. I also think, to the extent that we're so passionate about having partners sign, then that's the same motivation, if you think about it, that an audit committee should be kind of doing the same thing. With respect to the second one, in terms of, I think it was process around closing our books and disclosures around that, I'm not exactly sure I fully grasped the question.
There was a thought advanced, or at least that's how I've seen some of this presentation, as not so much a boilerplate or checklist, but just some of the steps that the audit committee goes through on an annual basis. Obviously, some of the improvements that are made in that process on a year-over-year basis. Obviously, Peter, you mentioned something that you considered to be sort of a glaring example that you hadn't caught before, but then you subsequently caught. So almost just a process statement as to how the audit committee operates and perhaps improves upon its processes on a year-over-year basis, so that investors can perhaps compare across the industry and say, boy, this looks like a very tight process. This company either is not disclosing or is not acting in as complete a manner. And is that a burden to provide? If it's not, I would think that might be helpful for comparative purposes.
I mean, my initial reaction is I think that would be relatively easy to put together in terms of the routine process that they go through, in terms of the things that they think about. I think it is, essentially going to turn into boilerplate is the only kind of downside with it. But at least, at a minimum, the goal would be, here are all the boxes that you have to check, and they've affirmed that. Is essentially kind of, I think, what they're. So I'm not exactly certain of the total value, but it's one that can be done, I think. Pete?
Yeah, I generally agree with everything that Kurt said. I guess I think of it, again, in terms of two factors, one, timing, and then content. And so timing, our audit committees meet quarterly, and they meet coincidental with the timing around our earnings releases. They get a massive amount of information, et cetera. So the idea of them not being able to do something at the same time the company could be, I think, I'd have a hard time understanding why that would be for any registrant. The content, I guess it gets a bit that, what's done quarterly and what's, kind of an annual report, if you will. I don't think putting something out there every quarter talking about what their charter is or schedule of activities, but on the other hand, maybe on an annual basis explaining what that is or updates. And the benefit of that isn't just being able to read it, because, again, I think there would be a rush, not maybe a rush, but there'd be a movement towards the top. Once more of this information was out there and transparent, I think committees, frankly, there's going to be organizations like, Lynn's former firm at Glass Lewis and ISS, et cetera. They're going to possibly add this to their criteria, how they think about voting for board members and what they recommend, et cetera. But I think there's some, again, we're getting a bit into the how, and I want to be mindful because Steve did make sure to tell us, there are some boundaries here in terms of, what the jurisdiction of this board is versus the SEC. On the other hand, if we're all, altruistically saying we're trying to bridge the gap, we're not trying to usurp their authority, but bridge the gap. But I think a little bit of this gets into the how that we'd have to, engage with the commission on.
Joe, I think you're up next.
Thanks, Bob, and thanks for your presentation. A few points I want to make. I mean, this issue keeps coming up over and over, both at the SAG when I was on that and now on this group. I think as Pete made the point earlier, my sense, and I think the data supports this, there's huge variation in audit committee quality. And I think one of the problems that the PCAOB and the SEC deal with is the people they hear from, because I think back of the people who've been on these groups over the years, people like Denny Beresford and Mike Cook and Bob Guido and Bob Tarola. And these people are in the tail of the distribution on the good side. So hearing from them is not necessarily representative of the median audit committee member of 8,000 public companies. So then you kind of look on in a more systematic basis on things like what do we see in terms of the behavior of audit committees? And I think a lot of this, candidly, is SEC issues. So this is really for the benefit of Jim and Brian as much as anything, and the chairman, if she's still watching, is that we saw during the financial crisis when risk went through the roof, and a first semester auditing student would know when risk goes up, audit work goes up, which means fees go up, and what we saw is that fees went down. If you look at comment letters that have come in on the partner identification project, virtually every institutional investor that has commented on that is in favor of it. And a significant amount of the comment letters that have come in from audit committees opposed it. If you look at comment letters on the expansion of the audit report, most, if not all, of the institutional investors that have commented support that. Audit committees seem to be almost unanimous in their opposition. So these are groups that are supposed to represent the interests of investors, and on major policy issues are taking policy positions opposite that espoused by investors. If you look at research on audit committees, which is voluminous, the CEO, CFO still drive the process in a large majority of cases. When the governance committee lacks independence or has CEO involvement, any benefits of audit committee independence and audit committee expertise seem to vanish. There's a growing literature on social ties between management and the audit committee with the same deleterious consequences. So I would encourage the board or the SEC to look at that. So how do you deal with all of this? And I think Damon is right. I mean, I don't think this is perfect by any stretch of the imagination, but greater transparency by audit committees, which will call for expanded reporting. In fact, one of the things that might be worth considering is should the shareholders have a vote on whether to accept or reject the audit committee report to insert additional accountability. Although at the end of the day, I really think these things will only work if the very large asset managers, where most of our 401k money is invested, BlackRock, Fidelity, Vanguard, Pete, with all due respect, Legg Mason, if they step up to the table and engage very actively in the process, because at the end of the day, without them, even greater shareholder involvement is just going to be driven by the public pension funds and the union pension funds. Although they're important, they don't control enough of the votes to really sway things.
Thanks, Joe. Lynn, I think you're up next, and then Barbara.
I would echo what Pete said about audit committees having a wide variety in terms of how good they are, competency. I think it's extremely wide, and people need to be mindful of that. Also, when you talk about audit committee reporting on a quarterly basis, think back to the audit committee charter. And for many audit committees, that's a half dozen pages, 5, 10 pages long or whatever, all the duties they do. And audit committees often take those list of items and lay them and schedule them out over the course of a year so that you're making sure you're hitting each of the items over the course of the year. That means that in any one particular quarter, you're not doing everything. You're probably catching some of the items. Some of the items are probably repeated. Some of them aren't. So when you talk about an audit committee reporting on what they're doing on a quarterly basis, it is different than the reporting that you're asking the CEO and CFO to do, which runs to be the same each quarter. And actually, with the CEO and CFO, it's just here's a point in time at the end of the year, and then kind of an update each quarter as you go along. Have there been any changes? So you have to be mindful of that. It is an SEC reporting rule. This body doesn't have any jurisdiction over it whatsoever, so it'd have to be incorporated into rulemaking by the SEC, not this group. Someone mentioned, there was the issue of should the auditor evaluate the audit committee, and someone mentioned that perhaps you could have an outside party do it rather than the auditor. I've actually sat on a public board where we retained the NACD, because the NACD will come in and on an independent basis come in and do an evaluation of your board. It's a marvelous experience to go through in more than one way if you've ever gone through it. Most boards have never done that. Most boards won't do that. And so I don't know realistically if that's really a practical option or not. The NAC does a marvelous job, but most board members just, when you tell them you're going to bring in someone new, independent, and have them come in and tell you how you're doing, it's usually not viewed as a good thing amongst board members. Too much uncertainty, so most of them won't do it. So I don't know if that's realistic. The other thing is, an auditor evaluating an audit committee, that's still like, you're going to go in and evaluate your teacher. And it's actually interesting in colleges where the students evaluate teachers, and so the teachers teach down to the students to get the good evaluation, and it's not a very good process. It's a flawed process that is pretty poor at best. I'm probably not a very big fan of that idea, because you're talking about someone reporting on someone who hires and fires them. And I think just given the way people work and operate these days, that's not a real successful process or outcome. In fact, on a number of cases I've seen, prior to a company blowing up and going through an Enron type environment, the auditors and the audit committee, if you look at all the correspondence, they loved one another and they were all doing a good job. And immediately after the lawsuits start filing, the audit committees almost universally accuse the auditors of not telling them anything. And the auditors turn around and say, no, look at all the stuff we told the audit committee. And usually the truth, when you get into it, is somewhere in between the two. But whether or not you'd get an honest self-assessment out of that process, I think you're asking way too much of a human being to turn around and do that. And I just don't think that would really turn out and be meaningful in any way, fashion, shape, or form, given what our experience has been with those.
Just a comment on that before I turn over to Barbara. Right now, if I understand the way auditing works, the only recourse an auditor has if they come up with that situation, Lynn, is to resign. The notion here would be to put in a communication process. I'll now turn it over to Barbara.
Right. I mean, so this last point, it does get to the point that Damon was making. We've got this system that's so intricately intertwined that you have an auditor who needs to evaluate the audit committee in order to evaluate the internal controls over financial reporting, and yet where there is just this fundamental conflict to having that evaluation occur by the person whose employment to conduct the audit is in these individuals' hands. So I don't think there's any reason to believe that would, when you needed it to work, that it would work. But just more generally, we have been concerned ever since Sarbanes-Oxley was passed, frankly, that when we put this much responsibility on audit committees, this is a slender reed to carry the weight of responsibility that Sarbanes-Oxley placed on audit committees. And it's to this point, as been mentioned by several people earlier, that there is a huge range, inevitably will be a huge range of quality in audit committees. And that when you look at the list of things we ask these part-time people meeting quarterly, and obviously doing work between those quarterly meetings, but to be responsible for, it's hard enough at the really big companies who want to do a good job and can draw on the pool of top financial experts for their audit committees and have that function as intended. But to think it's going to function that way on the thousands of smaller public companies, I just think is completely unrealistic. So, I think it's a good idea to have this report. I think it's useful, but I also think we need to recognize that a system that puts this much faith in audit committees to make the sort of independent audit work is really fighting an uphill battle.
Ann, I think you're next.
Thanks, Bob. First, I wanted to commend the board because I think this area of trying to educate audit committees and audit committee members, you've done great work in terms of outreach, and I think trying to teach them and train them about the right questions to be asking, and I would just encourage you to continue doing that. I just wanted to share my 2 cents on the transparency piece of this, because I think the other questions are really interesting, and I don't know where I end up on them, to be perfectly honest with you. But as I reflect on today, so much of what we've talked about is transparency, and Mercer, your question sort of why. Empirically, there's a lot of data to suggest that investors and the public has lost confidence in our markets, and some are still sitting on the sidelines in the wake of the financial crisis. And I think that this is sort of one small element of restoring some confidence in that space. I guess I wanted to stress that I think there's a role for an enhanced audit committee disclosure, but I don't think that that's the only answer. And I guess I would encourage the board to work with the commission as you're thinking about the transparency elements of this, because I do worry that sometimes a convenient answer is we'll just have the audit committee do it. I worry that we're probably more likely to get boilerplate language from the audit committee as opposed to, frankly, the auditors. We've certainly had evidence that some auditors are really stepping up and providing, I think, tailored commentary as we would hope. So I guess that would be my only observation is I would encourage, I don't want to give up one to get the other. I think both are extremely important.
Mike?
For the sake of kind of being a little bit redundant, but we continue to go back to this model that some have passionately said we've ignored for many years, and others less passionately have alluded to the same thing, that with this type of interrelationship, it's hard to imagine how this could work. And I guess that's the elephant in the room for me. We've alluded multiple times here that one solution that could resolve a lot of the conflicts that we're dealing with is that the audit firm isn't hired by the company, isn't hired by the audit committee, but is hired by the regulatory body. And I know that in the United States that's not been a popular concept, but it eliminates about 90% of the conflicts that we've talked about all day long. And I'm not saying that's PCAOB versus SEC versus your next flavor of who you want it to be, but if the hiring and therefore ensuring the independence and the scope and that they could assess the entire process without having a conflict and that the right amount is paid and they're incented to be aligned with the investors, all that gets resolved if you don't have the company being audited and their audit committee hire the audit firm and it's hired by pools that are supplemented, and we have models in the United States to do that. That's what the examination bodies do for the banking industry and how they get their money to pay their examiners. It's a hybrid of that. So with that, I'll stop being redundant and go back in my house.
Joe, go ahead. Are you finished? Oh, I'm sorry. Jim, I'm sorry.
Well, to take Jim Schnurr's approach, what's the real problem? What are we trying to solve? I could suggest there being a danger that you can define the problem so narrowly that you haven't done anything. But nevertheless, I think the problem that keeps coming up is audit committees who are subservient to management. Audit committees who don't really do the hiring and the evaluation of the work they do. There is a model that works here, and it's the model that the SEC has. The auditor, and this you triggered it, Bob, in my mind, because the auditor who sees something wrong does not have to resign immediately. The auditor has the option of taking his problem up the line. And if he does not get a satisfactory response up the line, then his obligation under 10A is to go to the SEC. And by the way, he does not have a private civil litigation liability for failure to do that. He has a safe harbor. You can imagine a rule in which we said if the audit committee, if the auditor noticed or observed undue management pressure, their reporting up the line would go first to the board. If the audit committee was subservient to management, and if that were not a viable option, and they cannot get satisfaction going that way, bring it to the PCAOB. Now that's a different kind of rule, but it is a reporting rule. And we have talked at different times at the board among ourselves about how you stiffen the spine of auditors. But it is one of the areas in which, if we did it, if we considered it, the problem would be a narrow one. We're not asking the the auditor to pass entirely on the effectiveness of the audit committee under all the aspects of their charter. Do they have sufficient financial expertise? Were they right or wrong when they accepted management's risk estimate? No. We would simply be saying, does the auditor, this becomes a material adverse failure issue. Does the auditor observe something which, in the mind, in the terms of Tony Sonde, really amounts to a material weakness? Does the auditor observe conduct in the audit committee which renders the auditor unable to perform their duties because of management influence, and is that a material weakness in internal controls? And if the auditor observes that, and if he takes it up the line, and nothing happens, he has to bring it to us. Now, why I say this worked. Most of us, I think, around the room have seen in the private sector, you never get to the point of going to the SEC. You never get to that point. Once the auditor raises the finger, the warning finger, and starts saying there's a wind blowing here, something happens. Something happens. Management backs off. The audit committee is reconstituted. the CEO's golfing buddy is replaced as the chairman of the audit committee. There are all sorts of things that can happen. But maybe we ought to start considering it, and these are much broader. These are much broader reforms, but at least we ought to start working on the problem we know we have and the problem that you all identify, which is we need to start worrying about whether audit committees are under the thumb of management, and what can we do about that targeted problem. Comments, rebuttal invited.
Oh, okay. Lynn?
Jim, what you just talked about in part reminds me of the Section 10A reporting requirement. Okay? But the number of Section 10A reports that we've ever got on auditors is not only small, it's probably smaller than negligible. And we have seen where the auditor never reported a 10A violation, and then when they get into court, we find in the court documents, then all of a sudden there's a 10A. So I think it is a good analogy, but that experience has not worked, and certainly has not worked well, and has led to a false impression that auditors are in fact reporting or required to report all these 10A violations. You might even recall Dingle on a few occasions asked for an update, and they're just, the bottom line is we just don't get Section 10A reports to speak of. And so I think you'd have to go back and say, okay, why is it that we don't get the Section 10As, and what would you do about it so you don't have the same experience here? The second thing is you don't have the authority to get into governance of a public company. Not even the SEC does that. I think you would have statutory authority to do what you're doing if you're going to do it from an auditor perspective, but you would have to deal with the governance issue as well. But I still don't know that you're going to, I think you're asking for more out of that audit firm than what you're going to get given the 10A experience.
The idea that I'm playing with and that intrigues me is that part of the benefit that 10 Cap A has wrought, it seems to me, is that there have been changes in corporate conduct which never reach the SEC or reach the reporting markets. And it's certainly true that there have been cases where auditors have failed in their duties under 10A. There are cases where they have, in fact, brought things to management's or board's attention that haven't been remedied, a satisfactory response not delivered, and the auditor did not report. But we all know cases in which there were changes, and all I'm saying, as we say in Texas, is that perhaps we should start addressing this problem at least with a specific kind of targeted invitation and direction to the auditor to call a material weakness out when he perceives a weakness in the audit committee, and to follow the kind of 10A approach that would eventually result in it coming to us. Because we don't inspect everything. In other words, we're not in a position to go around and find these examples of audit committee weakness.
But don't you have that ability under your current rules? Because if it's a material weakness, you've got the issue with the auditor already reporting under internal control.
Yeah, but I'm saying we don't inspect all these audits. We don't see all of those cases. And what the advisory group here is pointing out is that really the problem is that bottom of the iceberg, that are all of these small companies and middle-sized companies. And what I'm suggesting is you start putting out on the auditor, you hand the auditor a club, and you say to the auditor, you've got to use this club when you see a case for it. And if he does not use it, the auditor then is flipping a coin. The auditor is doing what they do when they issue an audit report without a substantial basis. They're essentially taking on themselves a responsibility that they ought to be transferring to management, the board of directors, and bringing to our attention.
But if you find that, then are you going to do the morning executions so the auditor is actually going to do it, and we aren't going to get misled as investors?
That could be the basis for a referral. It could be the basis for a quality control problem. There are a lot of things that could follow short of morning execution, it just seems to me that we have a gap and that we don't make this connection.
I think, Jim, you got the point directly. So, unless anyone else has a comment, I think, as a group, well, okay.
Look, Mr. Chairman, I think you're sort of asking the question, how could we, because right now we're talking about executing people at dawn. One of the issues that is in real life present is that the auditor has a relatively narrow range of steps, and they're mostly cataclysmic. If the auditor feels that the financial statements don't accurately reflect the health of the company, or the auditor feels there's an internal controls problem, it's sort of an on-off switch, and you turn off that switch, you've really destabilized your client. A number of the things that have been proposed today are attempts to try to give some other options. Right? The enhanced audit, one could understand an enhanced audit letter as having that effect. I think to some degree what you're talking about envisions that sort of dynamic. And as you correctly point out, the outcome of doing that is to give the audit firm greater leverage behind closed doors in its relationship with the client. And I think if your model of what you're trying to get at is a circumstance where you have an audit firm made up of you have an audit engagement team made up of people who are deeply uncomfortable with what they're witnessing and want to do something but don't want to do something irresponsible. If that's the model you've got, then these types of proposals that envision largely keeping the audit process between the company, the board, between the management, the board, and the audit firm may in fact be responsive. And I don't doubt that there are a number of circumstances like that, and that anything that could be done to enhance the power of well-intentioned professionals in those circumstances is probably useful. But I'll tell you, I don't think that's actually what the big problem is. I think what the big problem here, when you talk about large cap companies and things with significant impact on our members' retirement savings, is not that at all. It is a set of relationships which everyone is quite comfortable in, and where no one, not the audit committee, not the engagement partner, not the management, is seeking to. No one is lying awake at night. Right, but they ought to be. Right, somebody ought to be lying awake at night, and getting into that problem seems to me to be really what is in front of the board, and really was what I was talking about a few minutes ago.
Well, Bob, thank you very much. You certainly have struck a chord, and notwithstanding my attempt to browbeat you not to bring it up because it's not within our jurisdiction. You clearly have struck a chord with the vast majority of the people here. So we thank you very much. I also appreciate your comments with respect to the board's participation here because Jay and Jeanette have been very active in terms of outreaching to audit committees. And Lou also, in terms of IFER, has raised this issue in the international level. And so we appreciate that very much, and the chairman has also spoken about it. Also, where credit is due, notwithstanding Lynn's remarks, I think our inspections division has done an admirable job in terms of being a crown jewel of the PCAOB, and we clearly made a difference there. In terms of moving on, Marty, if you would, maybe we didn't touch upon the audit report. I'm not sure whether there are any standards that you want to bring us up to date on. Very briefly, we touched upon going concern and transparency. But if you just want to spend maybe 5 or 10 minutes on that, and then what I'd like to do is begin to wrap up. But before wrapping up, I'd like everybody to think through. We'll go around the room, and as we've done in the past, if each of you could give us your closing thoughts and recommendations in terms of issues that you think we ought to be focusing on. You not only have the board's attention, and so I would encourage you to stay within the jurisdiction of the PCAOB, but you also have the SEC here too. So we'll take the last
25 minutes or so, just going right around the room. And Pete, why don't you start thinking in advance? And right now, we'll turn it over to Marty.
Okay, thanks, Steve. I'll touch on a couple of things just to pull them together that were talked about today, but also mention a few other items as you suggested. But because it's been mentioned so many times, I will mention again in transparency, of course. Our reproposal where the comment period ended in March of 2014 was that the audit engagement partner would be named in the audit report, along with other firms that participated in the audit over a certain threshold. Responses to that, firms' responses largely were that would increase liability to partners and the other firms because of the consent requirement, which would trigger Section 11 liability. So as was mentioned before by Jim, we will be issuing in the hopefully relatively near term a supplemental request for comment to address those concerns about liability and consider other options with respect to disclosure of engagement partner and other firms, such as either in the audit report or maybe in a new form, Form 5, which could be searchable. Or you could choose both, put it in the audit report and put it in a new form. So we'll lay out some alternatives in that supplemental request for comment. And please, this is such an important issue to all of you, please weigh in on that supplemental request for comment. We'd like to hear your views. On expanded auditor reporting, we are very committed to this project. And as was mentioned earlier, this one and some others, we were at the forefront of these issues. And some other standard setters around the world have moved ahead of us. Some of the complications of economic analysis, and which is important to our rulemaking, and other factors of the U.S. Liability regimes create some greater challenges here. But so we've issued a proposal for the auditor to disclose critical audit matters in the audit report, and also to describe what the auditor's responsibility was with respect to other information accompanying the financial statements, some of the non-audited, some of the non-GAAP measures and others which could be reported in the other information where the auditor has to read and consider that, but we were heightening some of the requirements there. We also held public hearings on the expanded auditor report in April of 2014. So our plan now is to issue a reproposal on expanded auditor reporting requirements, taking into account the comments we received during the comment period as well as at the public meeting, and to issue that reproposal probably in the first quarter of 2015. We are staying obviously very close to all of those global developments and have had many conversations with the IAASB and the European Commission and others. Just in terms of timing, as somebody mentioned, falling behind, hopefully we won't fall too far behind here. The IAASB expects to approve a standard on expanded auditor reporting at their December meeting, and that they expect to be effective for years ending on or after December 15th, 2016, such that expanded auditor reporting would take place in 2017. So if we can get our reproposal out in the first quarter, as I suggested, and hopefully move that along, maybe we can get on track. By the way, that IAAS report that they expect to approve in December, the IAASB report, does include a requirement to disclose the name of the engagement partner in the audit report. So that'll be a requirement basically around the world for all those countries, over 100 jurisdictions that follow international auditing standards. So again, please weigh in on that reproposal on expanded auditor reporting that we'll issue in the first quarter of 2015. I commented on going concern at some length, and the bottom line of that was that that the practice alert said that existing auditing standards continue to be applied to auditors, and they have reporting responsibilities under existing PCAOB auditing standards, but that also we will be issuing a staff consultation paper around year-end, December, early January, to lay out, as I mentioned, possibilities for how the auditor could improve their performance in this area and what the investors might expect in terms of early warning signals, and at what level should that early warning signal, and at what stage should that take place. Again, please comment on that. It's very important to you, so we hope you comment on it. Some other things, PCAOB inspections have identified some areas as very problematic in audits, and certainly a major one has been audits of internal controls over financial reporting. Represent a significant amount of findings from Helen and her team. They've issued some reports on the extent of those deficiencies. In response to that, what we do is issue practice alerts. And so in October of 2013, we issued a practice alert on considerations for the audits of internal control over financial reporting, and laid out what some of the key issues were and how the auditor should think about the risk assessment standards and link that into their responses to testing internal control over financial reporting, and addressed many of the deficiencies that inspections noted. And we'll be working with, monitoring closely with ORA and inspections, any improvements or the responses to that practice alert to see if we see better results, as well as through various other inspection activities. A standard we did adopt, the board adopted a standard in June of 2014, which I think is important in this area. One of the critical areas of financial reporting problems over the years has been dealing with related party transactions, significant unusual transactions, and a company's financial relationships with executive officers. So the board approved and adopted a standard, Auditing Standard 18, and related amendments to other standards in connection with those matters. And that's subject to the SEC approval in the very near term, we hope. And if so, those new standards and rules will be effective for audits beginning on or after December 15th, 2014. So that's important for upcoming audits in the next season and interim reviews next year. Another place where we've issued a paper for comment, where again we'd like to have this group's response, and we had a SAG meeting just recently on October 2nd, dealt with a staff consultation paper on auditing accounting estimates and fair value measurements. I referred to that earlier as well. This was another area, not just in PCAOB inspections, where auditing fair values has been a very high rate of audit deficiencies in PCAOB inspections, but based on the IFIAR annual global survey of inspection results around the world, auditors are having challenges and difficulties, and regulators are noting deficiencies in audits of fair value measurements and complex estimates like the allowance for loan losses around the world. So it's not just under our standards, it's under the international standards on auditing as well. So we need to look for ways to improve auditor performance in this area that works both with our standards as well as the ICEs. And the IAASB has commented at that meeting they'd like to work with us on this project to improve their own standards. So this consultation paper is out for comment, and the comment period closes on November 3rd. And we look to hear from as many people as possible on that. Another area where inspections cites a lot of deficiencies, and a really important area, it's the top line of most financial statements, is revenue. And again, significant challenges and estimates in auditing revenue, a high rate of inspection findings there. And there's also a new accounting standard on revenue recognition that's it's been issued, expected to go into place a couple of years hence. So we issued, again, a practice alert addressing these issues and ways in which auditors should improve their performance with respect to auditing revenue, and we issued that in 2014. Some other things coming up, Steve, are not out yet, but we expect to issue a staff consultation paper on specialists and the oversight by the auditor both of their own employed specialists and engaged specialists, and how they should look at the work of management specialists and evaluate that work as well. So that'll be important also for us to seek comment on what are the expectations of auditor performance with respect to the oversight of both management's auditors' engaged specialists and their own internal specialists. Related to that also is how auditors should supervise the work of other auditors on a multi-location engagement. Another place where we've seen some problems through the inspections And a place where we think standards need to be improved in terms of the lead auditor's oversight over the work of other auditors around the world participating in the audit. And then finally, importantly as well, the staff is performing extensive outreach with academics, investors, forensic accountants, prosecutors, and many others regarding the auditor's responsibility with respect to financial reporting fraud, with a goal to, as Lynn and some others have pointed out, this is an area where these matters are often found by hedge funds and short sellers, with a goal to improve auditor performance in detecting financial reporting fraud. And we are planning robust discussions on this topic at the upcoming SAG meeting. And then last but not least, I'll speak outside of my area here, Greg Jonas and team in Office of Research and Analysis, working with the other divisions as well, have before us the paper on audit quality indicators, and hopefully this will get out, Greg, around year-end time frame or so, which I know this is of importance to all of you. So a lot of things where, again, we'll be seeking comment on that document as well. So I think a lot going on where we'll be seeking comment on very important matters, all relating to the improvement of audit quality.
Marty, thank you very much for that summary. And then, as I indicated, why don't we go around the room and conclude. We welcome your input, welcome your recommendations for priorities in terms of what we ought to be focusing on. And Pete, we'll start with you.
Well, great. Well, first of all, thanks to the board, and particularly Steve, you for putting this group together, because I think it's important to get a lot of different viewpoints and constituencies. And clearly there are lots of things we agree on. There's lots of things that we differ on. And this forum's a good place to get those out on the table. Sometimes it's not as good a place to get them fully wrestled to the ground, but hopefully give you guys a broad perspective. I guess just from a 50,000-foot level, I stepped back, and it was particularly crystallizing for me as we were going through the couple of different topics that I was working on, to go back and look at what really caused the last two crises, or what do we learn coming out of that, and those being the 01 with the Enrons and the WorldComs and the Tycos versus 08. And both of those crises were typified by some massive corporate failures from bad business models. But in the case of 01, it was bad business models with bad people, many of whom are still in jail. It's clear that auditors have to share some responsibility around not catching that, not reporting that, not being more on their front foot about it. But I think Sarbox has helped to address a lot of that. I also think that the way the firms have changed, there's a double-edged sword behind the scale of the numbers. When I look at just how large the Big Four have gotten, on the one hand it's a bit scary. On the other hand, it was always a bit of a challenge of how do you have these, when there were 8 firms, how do you have these 8 relatively small firms facing off against these gigantic corporations? There's now, I think, a better scale, if you will, between the firms themselves and the clients that they audit. But I also think there's been some changes, and I don't know whether it's been this way in all of the firms. I at least know of several where one of the key aspects in my mind of what caused the failures, particularly Enron and David Duncan, who wasn't necessarily a bad guy, but in a bad structure. In the Houston office of Arthur Andersen, getting such a massive amount of their revenues from one client and getting to make the technical decisions on both auditing and accounting. And my sense is that most of the firms have moved that up to a national level, where you're now looking at firms with $15+ billion of revenue. And yeah, $50 million is still a lot, but it's not the same relative amount to the whole firm as it was just to the Houston office. So I think the lessons that we learned from that crisis, we've got to be careful now in terms of applying them to the most recent crisis, which in my mind was more bad business models, not necessarily bad people. Some would argue, well, we haven't been aggressive enough at going after the Richard Folds from Lehman Brothers or whatever in terms of putting people in jail. But I think the reality is we found from this last crisis is that it was bad business models, but not necessarily bad people. Bad business models of allowing financial institutions to get levered 35, 40 to 1. Bad business models of having highly rated products in money market funds, which I think someone alluded to earlier around the breaking of the buck of money market funds, was caused in part by the wrong kind of instruments being in those funds. However, everybody was following the rules. If it's AAA rated by one of the rating agencies, even though it might all be tranches of subprime mortgages that supposedly could be AAA rated, and when we found out that, well, Fannie, Freddie aren't going to be solvent and aren't going to be able to stand behind all that paper, then money market funds could break the buck. So I think there was a lot more complexity there than just auditors. On the other hand, I do think the audit firms, are inside those organizations. They know, what feels right, what feels like a bad business practice, or what feels like a highly risky business practice. And a lot of things that we're trying to tease out about auditor reports, I think go at that issue. But I think we've got to come at all of this stuff with the recognition that Sarbanes-Oxley did change a lot, that the way the firms have changed is important. And, Marty and I were having a conversation at lunch as to, have all the firms really kind of gotten it, that the real tough decisions in many cases should get made at the national office. At the end of the day, it still has to be an individual audit partner that's going to sign that audit report, but it should be the firm that's making those tough decisions at a very high level. So I think, again, it comes back to tone at the top, structural issues within the firms, and then on this expanded audit report that we get it right and that it's useful information and not just a lot of boilerplate at the end of the day, if we're going to have companies and the investors in those companies paying for that extra work.
Thank you very much. Bob?
Yeah, thanks, Steve. Thanks to you and to your fellow board members on engaging us in this way. It's quite interesting and robust. I think kudos go out to the board for truly improving the effectiveness of auditing. I think over the last 10 years that has proven out, and your diligence in that regard, I think, is appreciated by investors and users. I think perhaps the next focus for the board is in building the confidence of the reporting system and taking to heart some of the recommendations you heard here today about transparency and accountability and collaboration, and using those as a way to help promote more confidence in the system. I'll stop there.
Mercer?
I've sort of noticed in this meeting, the last meeting, a common theme of whether the board has jurisdiction over issues notwithstanding they're very closely related to the issues that are well within your jurisdiction. And in the securities laws and in ERISA and to some extent in banking regulation, there's a pervasive model that's essentially like the rule that you can't have any cookies before dinner unless you get your homework done. And that is the model that if you up your behavior, then we'll cut you a break on some requirements that over time we realize might be more burdensome than they're worth. And it satisfies the economic principle of revealed preferences while also allowing the parents to get what they want. And I think in the long term, you need to think about things like being able to adjust the boards of auditors as a possible benefit that would be worth giving something up. And that in the long term, I think a mature agency has to have some exemptive authority along those lines. So you probably want to be thinking, because this is going to come up repeatedly, whether that's an avenue you want to pursue to give you more flexibility to do some of the things that you might prefer and that your regulated entities might prefer as well.
Thank you. Brian, I think we'll save you and Jim the best for last, with the exception of the board, which we'll consider to be the best. Larry, your thoughts?
I am grateful. First of all, I'm just thankful for Joe, who just left, and Ann. They really prepared us really well with passion. I learned a ton. I learned how much I didn't know, and it was just really good. Not to be too weird about it all, but I'm thankful for the members who have been on this board for a long time. And I know Damon, Barb, some other people who speak with a lot of passion. You probably roll your eyes when you see a guy like me, because I'm like, oh my word, I want things to be finished, and like, you've at least don't tell me this stuff's been on the docket for 10 years. It's so sad. But anyway, that said, I'm thankful for them. But for me, the relevancy of the audit hits home for me. It really does. I mean, it seems so common sense to require a signature of the lead engagement partner or something like that. But I understand there's a lot of tentacles and a lot of that goes behind the scenes. And also for the shareholders. That's where my heart lies, in disallowing shareholder proposals and auditor issues. It's something near and dear to my heart. And that's what I'd like to leave you with.
Barbara?
Thanks. So I have two thoughts. One I've said before, but when we deal with these issues, with an audit that only has value if it's independent, and a business model that ensures that the audit will never be really, truly independent. So if you're going to stop short, and this is sort of to the point that Mike apologized for being redundant, but it's sort of some of the points that he was raising. If you're going to stop short of the kind of revolutionary reforms that would really significantly change the independence of the audit, then you can't be timid about the rest of these things. And so there have been a list of proposals that have been put forward. None of them is, some of them have technical questions about whether they'd work or not, but none of them is radical in the sense, short of Lynn's presentation on changing the business model, none of them is radical in the sense that it fundamentally changes the world. They're really about incremental change. And I think it's important to understand what you're trying to change with those. But the notion that we really need to do something significant to increase professional skepticism and the quality of the audits at a time when we have persistent problems with that, despite years of attention to those issues. And then the second point I'll make, it's not quite as snarky as it sounds, but we've talked a lot today about increasing investor confidence in financial reporting, and I think we have to question whether lack of confidence isn't a rational response to the world that investors live in. And what we want to do is give investors a basis for increased confidence in the financial reporting system, and that, again, brings us back to being willing to tackle on a fairly fundamental basis some of these issues that call into question the independence of the audit.
Thank you, Barbara. Grant?
Okay. Again, thanks for all of your assistance in getting this to here, and Nina, who I see has left the room, should also be given kudos for all the assistance she's provided us over the last couple of months. I guess I have three comments, and I'll work from sort of the macro to the micro. The first is we keep hearing about ACAP, and there are lots of recommendations in there. It's been, as many people have pointed out, a good number of years now since that report. And I think it's important for the board, the commission and the board, whatever the right combination is, to address those issues, either adopt them or give a reasoned decision as to why that can stand up to the scrutiny of public view as to why they're not going to be adopted. Because I think as more time goes past, credibility ceases to exist. And it's a good report, and there's a lot of good stuff in it. So that's my macro issue. The middle ground issue comes down to the issue that we talked about in Brandon's piece of the report, which is the consulting creep. And I think, and a number of people had mentioned this, there is a lack of empirical evidence. But I think you can do some digging, again, maybe with in combination with the commission, to come up with some things so that the next time we talk about this, we can be looking at some specific and targeted approaches that we could take to, if there are areas where we can determine that there are issues that need to be fixed. And because if you just try to do a broad-based, you shouldn't have any consulting, people are going to say why, and you got to be able to come back and say this, this, and this. So I think a targeted approach there would be more helpful. And the micro level is the disclosure of engagement partner's name. I give no credibility to the litigation risk personally, but I think you've got to come up with a methodology at the end of the day, and quickly if you can, to get a good disclosure that's not hard to find, whether it's exactly what everybody wants. I don't know why you just don't sign it on the report, but come up with something that's not hidden, because again, it goes to credibility. And if you come up with something that looks like it's succumbing to the pressures from the industry and that it's going to be all hidden, you're not going to gain much out of it, because I for one don't want to hear Barbara have to say again that she never wants to hear this issue again. So those are my points.
Well, thank you, Grant. Brandon?
I think the likelihood of structural reform is small to nil. I don't think you're going to turn accounting boards into de facto mutual fund boards. I don't think you're going to turn accountants into quasi-government employees by giving the board the power to hire, fire, and set their compensation. I think none of that is likely to happen, whether or not it's a good idea. Although with respect to turning them into government employees, I would not hold up the experience of the financial regulators in their examination and inspection programs with respect to financial institutions as an empirical example of how much better those conflict-free, self-funded examiners were than the accounting profession was. So I tend to be much more of an incrementalist, and the task I would suggest for the board is to figure out what it wants to do between now and January 20th of 2017. We're going to be in a frozen, polarized environment. It's going to be very hard to get anything done for the next 3 years. If you could get going concern, signatures on Form 5, audit escalation procedures, and the rest of Marty's agenda, you would have done a hell of a job. And I think it would be something the board could be very proud of and would make a material difference. And I worry that chasing the perfect will be the enemy of the good.
Brandon, thank you. Norman?
Thank you, Steve. I'll echo Grant's thanks to the staff for the terrific work they did in preparing for us today and making this such an enjoyable day. And thanks, of course, to all of the board members for your time and your interest in the work of this group. I'll be brief because, first of all, some of the observations that would have been offered have been covered already. I don't want to be repetitive. I'll end on the note or theme I mentioned in one of my comments earlier, and that is that I would strongly urge the board in everything you do, but in particular in the rulemaking in which you engage that pertains to the audit report and some of the other disclosure-oriented issues that we've mentioned today, to bear in mind that one of the things that the audit profession and audit firms can do, where I think there is tremendous room for improvement, is to be an additional source of valuable information that informs the investment process, as we discussed earlier. And that's why we're all here, because we all have an interest in ensuring that there is an audit process, an audit profession that provides in some way, and in perhaps a variety of ways, meaningful inputs into what it is that investors do every day, and that is fundamentally simply measuring and pricing risk. However else you want to define it. I mean, that is the essence of what's involved in the investment process, and the more information, the more intelligent or objective professional inputs that can inform a decision about what level of risk to assign to projections about a company's future performance is fundamental and essential to what investors do and to the well-being of those on whom for whose money they invest and on who depend on them. So, in particular, with respect to the audit report, I plead with you to resist frameworks or push back which lead us into a formulaic or check the box or pre-programmed language framework, and push the members of the profession to speak with a voice, to voice and articulate points of view, not boilerplate language, not pre-prescribed formats, but offer us information based on their professional judgment that actually means something. With that, I'll say thanks again. It's been a pleasure to be here today.
Norman, thank you. And Mike?
I would also echo and thank the board and the staff for everything they've done, and makes this a very enjoyable event and activity. And I'd like to thank Bob and Tony for all the hard work you guys did leading up to this. And I won't be redundant, and I do agree with you, Brandon. I'm an incrementalist also, because at the end of the day, if we can make progress and add value to the audit process and the quality and information for shareholders, that's what it's all about.
Lynn? Or should we skip you? Damon? No. Lynn.
I can't let that happen to Lynn. You have anything to say?
What's the question? The question is final recommendations and priorities for the board in the short term. I think you may have already said your piece, but we're giving everybody a last word.
I've been coming back here now for a decade, for 10 years, to these meetings. And each year about this time, in fact, we've been either on the SAG or on this group been told about things that you're doing. When I look at those list of things that you said you were working on or doing and compare it to what actually got done, I see some positive things again from what you're doing on inspections, room for improvement there, and transparency especially. But I think staff have picked it up and some good moves there. But on the rest of it, I just don't see anything. And so often I've had a expectation, given what I've heard, that great things are coming out of this board, and certainly I think great things can come out of this board. But it's gotten to where I just don't expect anything anymore. It just never gets done. The board has never really done anything big. The interim standards, I think, have become de facto final standards because they never get done. And this is 12 years after the commencement of this board, and given what's going into it, I think it's fair for the American public to expect much more in leadership from this board than what it's getting. And rather than trying to do things right, it seems to have gotten caught up in the politics of D.C. and has just become another bureaucratic, governmental Washington, D.C. board. So I really no more expectations than what I expect any other regulator like this back here. And I think that's unfortunate, because I think this board has the ability to do great things. But at this point in time, a bird in the hand is worth many, many in the bush.
I was about to say thank you, but as opposed to thank you, Damon, why don't we turn to you?
Yeah, now I'll say something positive. No, look, I'm here because I actually have a great deal of admiration and confidence in the chairman and the board and the staff, and I think that Marty's labored mightily around the agenda that he described earlier, and I, for one, and the people that I represent are grateful. So I want to sort of make that the starting point of what I have to say, because I think that that's not going to be enough. You actually have to get it done, right? I'm here because I have confidence that you're trying, and I couldn't say that about every room in Washington. Now, what are you trying to do, and what should we ask of you? And what should our stance be? It's unquestionably true that the way policy is made in every setting is usually incremental. But positive incremental change does not come from the people who would benefit it asking for little things. If you ask for little things, you get nothing. Right? So, and then I think, one's ambition, the job of a body like this is to make serious demands upon the board, knowing that the board must live in a world of complexity and politics and so forth. Now, what kind of demand should we make? Here, I had no intention of saying anything like this, but I really have to respond to the very first person who spoke, which was Peter. Peter said something that I think is, while I appreciate many things Peter says, I think is absolutely and completely inaccurate. And that is that there was some kind of meaningful legal difference between the conduct that produced the events that gave rise to the Sarbanes-Oxley Act and the conduct that produced the financial crisis of 2008. In my view, and I have studied this greatly both at the time and afterwards, the only difference in the moral or legal quality of the conduct was that the institutions and people involved in what occurred in 2008 were so powerful they could not be held to account. That is the only difference. And I could spend literally the next hour itemizing for you action after action by the executives of the firms involved, by the auditors, and by the regulators they suborned that produced the crisis. Right. Act after act, which consisted of breaches of fiduciary duty and financial fraud and bank fraud, violation of dozens of statutes. With time and with the diminishment of the stark fear that those people's conduct brought on the nation's economy, some modest steps have been taken to hold those who did these things to account, largely at an institutional level. I will just mention one because in the context of auditing, it's so amazing, and that is that the mortgage system, which produced the crisis, right, was founded on a series of transactions which, on their face, were fraudulent. Which is that the liens underpinning the home loans were not in the hands of the securitization trust. Now think about what we all know an audit is supposed to be about. Now those trusts were at the heart of a network of financial relationships underpinning the nation's largest banks. The liens were not where they were supposed to be. It's clear that auditors either knew it or should have known it, and no one said a word. And it did not become known to the general public that this was true until 2011. Now eventually that fact gave rise to tens of billions of dollars in liability on the part of the large banks once the legal system got around not being paralyzed with fear to do anything about it. Now it's simply the fact, it's only the fact that the failures were so large and so comprehensive that no one has bothered to ask where the auditors were during this period. Now that is just one example. Do you want to hear 20 more? I think not. That's where you've got to start, because the reality is, and I'm sorry to say this because I was one of the people involved in helping to frame Sarbanes-Oxley. Sarbanes-Oxley failed in the sense it did not prevent the next financially driven crisis, and the question now was, will anybody take the sorts of steps necessary to help further diminish beyond what Dodd-Frank did the likelihood of another round?
Damon, thank you. Tony?
Thank you. I won't go into it in any great detail, but I'll tell you one thing. My doctoral thesis was on the economics of securitizations, so I certainly agree with what Damon just said. I would also point out that I think it's a failure of our standard setters in accounting, financial reporting. We've had, I think, 5 attempts at trying to figure out how to account for securitizations, and it's just never worked. They don't understand it, and I don't know whether they will. And that's actually the reason I bring that up is simply because I want to point out that I think in this case, and in what you have to do, and what I would like to help you do, incrementalism isn't going to work. I think we'll have to fight to get somewhere, and we may have to do something fairly big in order to get there. In terms of specific recommendations, I think it's about time we had the partners named and signed and so on. I used to teach in Sweden 25, 30 years ago. They've had that system for a long time. I know there are differences in litigation regimes and so on, but they haven't had the kinds of problems that we seem to be worried about. I think we need to ensure that audit quality indicators are actually going to work. But I made comments on it last year as part of my committee report. And I'm looking forward to seeing what Marty was talking about, because I'd like to see if there's something in there that's actually going to help us do something about audit quality. And finally, I think it's about time we did something about the independence of the auditors and so on, and that's the work that Bob and our group did. I think from an investor perspective, it's absolutely critical that we get something done there as well. Otherwise, as some people have said, Lynn in particular, and I agree with him to a large extent as well, we're not doing enough for the investors then if we don't get there with respect to independence. And if there are things that we can do to help you, ask.
Thank you very much. Ann?
Well, Steve, thank you, and to your staff, particularly Nina, and to all the board members for getting out for such a long day. We really appreciate it. Marty, thanks for the description of what I think is a really ambitious agenda, and I guess I wish you Godspeed, and it would be, I look forward to seeing the releases and commenting, and I think if I'm my only recommendation really to the board is to smooth some things across the finish line. And if I may close the loop, I think, Jeanette, your observation at the beginning about maybe developing some sort of a framework for evaluating sort of where the board is and what's off the agenda, I think would be extremely helpful, and for this group as well, because obviously our goal here is to be helpful, and I think when things are sort of finally over, it's good for us to know, and we'll move on to other topics.
Thanks, Ann. And Kurt?
So I, too, want to thank the board and all of the staff for, I think, what really good work that's been done over the last 10 years. I mean, I think the quality of audits in the U.S. in particular is far better than it was before. It's by no means perfect, hence that's why we're continuing this process. And you particularly see, at least in my seat, when I look at quality of information from international sources, especially certain areas of the world, and the quality of information that comes out of U.S. companies is far better than what comes out of other places that you can rely upon. The recommendation that I'd have to the board is to think about your communications outward, not so much to auditors, not so much to preparers, but think about it in terms of communication to investors. So what do you think is the quality of the audit profession? You may not want to talk about that, but then think about what are the questions that you would ask investors or audit committee members to be asking. So Marty walked through a great litany of topics. That would be, I think, relatively easy to put that into hot buttons for audit committees, investors to be asking, and then essentially kind of put it into the arms of investors to be able to carry the ball forward in terms of seeking audit quality. Otherwise, all we're going to ask for is lower fees. Thank you.
Jim and Brian?
Thanks very much. I very much enjoyed the discussion today. Obviously, you've got a list of very interesting and complex topics. Many of them relate to areas that we're currently exploring either at the SEC or at the PCAOB or together. I was particularly encouraged by the discussion relative to audit committee disclosures, given the remarks Chair White made this morning on the project we're working on relative to our concept release. And we're excited about the work that we're doing there, and again, we're encouraged by the feedback that we're hearing. I would just want to step back and say that I know today was really not about getting into the details of some of the performance standards or the quality control standards, but I think a few people have now mentioned those, and those are really critical that we stay focused on as well. I know that we're working together with the PCAOB on that front, and so while these other topics, which are also important for us to be focused on, are being worked on, we need to make sure that we're moving forward on the basic nuts and bolts of the underlying audit performance standards. The discussion relative to the audit quality indicators, I think, is another very important area, and we're also encouraged by the work that's being done there and look forward to the concept release that the PCAOB is working on. So with that, again, thank you and very much enjoyed the discussion and appreciate everyone's attendance.
Steve, thanks very much for the opportunity to sit here on my 10th day. I made only one comment earlier, but I do think, the topics today, at least from my perspective, were very, very relevant in terms of the, kind of the issues. I do think they require additional,
research and fact-finding, because I think that they can be complicated, and in order to identify what you want to do in order to be effective, a good example is around consulting creep. So is the issue around consulting creep the fact that the non-audit services to an audit client are creating pressure, or is the fact that consulting is getting so big it's changing the tone at the top and the performance of the firm on a macro basis and the incentives and things like that? So I think it's important to define some of these issues within the topics we talked about today. Having said that, I am very excited about taking on my new role and working with Jim, the board, and the staff here collaboratively within the limitations of my office. We've got a chairman and 4 commissioners that Brian and I have to deal with, as well. But we are in this together from the standpoint of investor protection, and we look forward to trying to move the needle in terms of proven audit quality.
Well, Jim, thank you very much. And then I want to recognize our board, and then we'll close up. Jay?
I just want to thank everybody for all the hard work and the stimulating discussion, and look forward to getting to work.
Lou?
Yeah, I agree with this. We find these meetings tremendously valuable, and we deeply appreciate the time you put into them. They influence our thinking in major ways, so thank you.
Jeanette?
I just want to thank everybody for the time and thought that you've put into these topics. And I'm just going to go back to some of the comments I made when we opened. And I think that after sitting through today's discussion, it's really important that we synthesize this, the input, analyze it, maybe come up with some priorities and preliminary conclusions. Some of the things mentioned today, we're going to have to just say we're going to put this on the back burner for a while. Others, I think we've got activities in process, and we just need a framework for analyzing this, putting it all together, communicating back and forth with you all, holding ourselves accountable for actions, and just creating a record so that, 5 years from now, we don't have members saying we keep talking about the same topic for now 15 years. But let's create a record so that in the future, future boards and future investor advisory groups can look at what we've done and continue to take this into the future. So thank you very much.
Mr. Chairman?
I'm always impressed by the range of talent on this group. You've got people here who invest real money. I will always remember what Pete Noctaway said in the first of these gatherings that I sat in, which is that I look at this, said Pete, not only from the standpoint of an investor, but from the standpoint of a preparer and a board member. We have people who are on audit committees, who sit on boards, who make decisions for issuers and preparers, and also those who use financial statements. We have public servants, people who represent major nonprofit institutions in our country, such as the AFL-CIO. We have advocates of investor and corporate governance interests. It's a rare group. I'm delighted to know that we have one corporate lawyer. Mercer is no advisory committee can work without a corporate lawyer. But we have a wonderful skill of accounting, spread of accounting professors as well. And this has been an extraordinary day, I think, for all of us, and thank you.
Geez, I thought we had 2 corporate lawyers right here, but maybe I'm missing something. In any event, Jim and Brian, if you would thank Chair White, we very much appreciate her coming today. It means a great deal to this group. And then I want to particularly thank Grant and Ann and Joe and Bob and Tony for their leading the various sections that they did. And I think they did an outstanding job. I also, although I don't know where she is, but the person that did all the work in setting this up and the substance is Nina Majuri Assad. If any of you see her, I don't think she's in the back of my head. Please tell her that I said these things, glorious things about her. She's done a terrific job, and I thank her very much in front of all of you. Same thing with Tope Falarin. And I just part by saying I, for one, think that this investor advisory group performs an invaluable service to the PCAOB. Whether you're satisfied with the progress or lack of progress that we make, I think it's extremely important that we hear your views and that we take them under consideration. and they're invaluable. So thank you very much, and safe travels to everybody.